10 hours in Renton and Everett. And it was the most fun I've had in that I saw the Boeing Renton line, which creates the 737. That's about 50% of their sales buzzing for the first time. It was really neat to see the 3 lines cycling at 42. This is a manufacturer that was doing 25 a month in 24. So to double production at the end of this year, and the employment base was invigorated. They were happy, and I think the new CEO, Kelly Ortberg, who's been there for 18 months, is certainly making that change happen. He's changed about 40% of the leadership in order to do that. So really good news on the 737 front in that the production rate is actually going up. Airlines will have planes, and it's a matter of certification on large programs like the 777X they have, which they took a big charge for in Q3. So will that be certified at the end of next year?
It sounds like all of the airline and airplane-related executives saying 2026 will be our year. 2025 wasn't exactly it due to all of the machinations throughout this year. I do want to end with Frontier and Spirit. I know you can't talk to these specific names. I do want to get a general sense, though, about whether the feeling right now in the C-suite is that this administration will be more amenable to some of these tie-ups and be more open on a regulatory front than they have been. It's been a mess every single time that companies have been trying to, that have tried to tie up.
Yeah, this is clearly a defensive move. It'll take about 5% of capacity out of the market. It'll help remove capacity out of strained markets where you're seeing pricing down. So, I think airline consolidation is something we haven't seen a lot of. In aerospace, on the other hand, going back, a deal a day in aerospace and defense tech. It's been very prolific for transactions in that market, whether it's manufacturers or defense tech, with the administration really supporting growth in the industry. So that's been a positive.
Sheila, thank you so much for being with us. Sheila Kahyaoglu of Jefferies here in New York. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. President Donald Trump is set to address the nation from the White House tonight at 9 p.m. Eastern. Press Secretary Caroline Leavitt saying the president will highlight the year's accomplishments and preview his policy agenda for the year ahead. It comes at a pivotal time as Trump's poll numbers soften and with the economy facing headwinds. Meanwhile, Ford has canceled a multi-billion-dollar EV battery contract with Korean supplier LG. The amount is equivalent to more than a third of LG's total revenue from last year. The decision comes after the U.S. automaker also rolled back its electric vehicle ambitions. And Alphabet's autonomous driving unit Waymo is in discussions to raise more than $15 billion at a near $100 billion valuation in a funding round led by its parent company. Sources telling us here at Bloomberg that Waymo and its would-be financial backers have weighed a valuation as high as $110 billion as the company ramps up its fleet and expands into new cities. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, room to chase.
The small cap Russell 2000 index is only able to deliver 6%. There's still room for a chase within small caps, mostly if you're in this special environment where you're expecting an easier Fed and you're getting resilient growth.
Jill Carey Hall of Bank of America Securities joins us next as so much hope gets tied up right now with the small cap space. From New York, this is Bloomberg Surveillance. Good morning.
The belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are gonna kill everybody. So we gotta figure this out. And we're not gonna do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What we're seeing right now in markets is a lift pretty much across the board, trying to get that Santa rally going after 3 straight days of losses, led by the tech space up almost 0.5% here on the NASDAQ. Russell 2000 climbing back to about 0.4% gain. They have been leading, and this really has been the main question. Can we sustain that heading into 2026? Right now in the bond space, how much do you get the participation of lower yields? Right now, not seeing it. Up 3 basis points on the long end. 30-year yields 4.84%. The 10-year 4.17. Under surveillance this morning. Room to chase.
You came into the year expecting 40% EPS growth, and the small cap Russell 2000 index is only able to deliver 6%. It doesn't necessarily deserve the benefit of the doubt. There's still room for a chase within small caps, mostly if you're in this special environment where you're expecting an easier Fed and you're getting resilient growth.
Here's the latest. Investors weighing whether lower interest rates and accelerating earnings growth could extend the recent rally in small caps into next year. Jill Carey-Hall is the head of U.S. small and mid-cap strategy at Bank of America Securities and joins us now. Wonderful to see you, Jill. Last year, you were talking about how the setup was very similar. People were pretty excited about small caps heading into 2025. You weren't so much. It feels a little bit like deja vu, but do you feel differently than you did at the end of 2024?
Yeah, I mean, I think several things have changed because, last year there was a lot of optimism after the election, but at the same time, you had uncertainty over tariffs, which hurt small caps more. They have very thin margins. You had uncertainty over Fed rate cut timing was starting to get pushed out. And you had uncertainty over when the profits recovery for small caps was ever going to happen. It kept getting kicked out. So, now I think a lot of those things have reversed. We finally have seen profits start to recover, and we're seeing management actually guide above consensus more than below, which is supportive for revision trends remaining positive. That hasn't been the case the last several years. So, that's different. The Fed is now cutting. That's supportive for small caps. Tariffs, I think there's a lot less uncertainty, and, potentially we could see some mitigation, as we move forward. So I think the setup is a lot more positive for small caps. And if this is a year where, we don't see multiple expansion driving returns and we actually see earnings growth driving returns, which is what we expect, small caps are where the better earnings growth is expected to be.
Some of the small cap skeptics come on the show and they say everyone wants to love the small caps because they love the story of the small firms doing better. But that really isn't the story, because these are the companies that have just failed to get big enough to be in the big leagues, in the S&P 500. And there's so many companies that are very strong that have stayed in the private space. So this isn't as high quality as it used to be. Do you think that there is some merit in that argument?
I do think there's some in that, it is true that the index has gotten lower quality, there's fewer profitable companies, and then in terms of, companies staying private longer and going public larger, we've definitely seen that. At the same time, there has been a pickup in IPOs recently. There still are, attractive opportunities in small caps. I think we got to peak low quality a few years ago, back after the IPO boom in, 2020, 2021. But, you've seen, especially now as profits are recovering too, the proportion of non-earners go down. You're seeing, just the quality of the index start to improve a little bit. But I do think, you need to be selective. And, you see that with how dispersed the valuations are within the index, where even though the Russell's trading, a little bit above its average, within that, there's a lot of dispersion. The largest Russell 2000 stocks are actually very cheap versus history, but the micro caps are trading about 80% above average on their sales, price to sales. So we'd actually avoid the micro cap segment, which has run up a lot.
Jill, quantum computing, Bitcoin mining, flying taxis, and new energy account collectively for 10% of the Russell 2000 index. What are your thoughts? I mean, a lot of those companies have had exceptional performance year to date. Can it continue?
Well, I think there's certainly been a number of themes within small caps and pockets of the market that have gotten driven up, and some of the micro caps, like I mentioned, and retail trading has been a phenomenon that's caused I guess on one hand better performance of the overall small cap index this year, but also more concentration. So that's created a really tough year for small cap active managers, where only about 15% of them have been able to outperform the index this year. So for managers that are struggling, they're not alone. It's been a tough year for everyone to beat the benchmark, which has become more concentrated. So, I think there are still some opportunities in some of the interesting themes where, when we even look at AI, I mean, this has obviously been more of a large cap story, but an increasing proportion of small caps are talking about AI on earnings calls, and the ones that are mentioning it the most are actually cheaper and have higher expected growth than some of the large caps. So, I think it's an area where a lot of stocks have run up, but there's still a lot of opportunities, and one has to be selective. And, it's not necessarily just owning the smallest, kind of under the radar stocks. We've actually found historically that stocks that have more coverage by analysts do tend to outperform in small caps. So our analysts at BofA cover about 1,000 small and mid caps. So I think there's a lot of opportunities within the space.
When you look at the small and mid cap universe, going into 2026, would you rather be invested in small cap value or small cap growth?
I think there's more opportunity in value right now, because when you look at historically, one of the best triggers essentially for value versus growth is profits recovery. So when, growth is accelerating and becoming more abundant, you don't need to pay up for expensive growth stocks. And really, when you look at value within small caps, it's historically much cheaper than growth across pretty much any metric you look at. So, I think we'd stick with value, but definitely see opportunity for the overall index to rally as well.
Jill, how much is the whole idea of Russell 2000 outperformance predicated on the idea of a Federal Reserve cutting rates versus actual true growth in the economy, right? This has sort of been the divergence in the economic circles so far this year.
Right. I mean, we're looking for, continued economic growth, a little bit of a pickup next year. I think the fact that profits growth is accelerating a lot tends to be more important than GDP growth accelerating for small caps. And Fed cuts, I think, you kind of need both, because Russell has become increasingly sensitive to Fed expectations over the last 2 years, much more so than historically. So, we're forecasting another few Fed cuts this year that should support the index. But obviously, if you were to see economic data start to weaken substantially, we're watching the jobs backdrop, we're watching the credit backdrop, which is very important. Those would be risks. And then I think the manufacturing backdrop is, the other one we're watching closely, because, the ISM manufacturing indicator is one of the most correlated indicators with small caps. So, that's struggled to recover, but is at levels that, we are expecting manufacturing to improve.
Jill, talk to us about investor positioning in small and mid-cap equities. I mean, are you seeing institutional demand, or is it largely speculative retail?
Right. I mean, I think it's actually starting to be broad-based in terms of when we look at inflows from different investor types in recent months, especially since, August after Jackson Hole, when sentiment kind of turned a bit on small caps. We've seen, retail, institutional, hedge fund investors all buying. We've seen big inflows from hedge funds in recent months. And, this is against a backdrop where small caps, when you look at their weight in multi-cap investor holdings, they're extremely underweight. Managers have reduced their positioning in small caps for many years now, in contrast to, mid and mega caps, which are overweight.
Jill, have you ever had more interest, more inbound calls from people saying, please, tell us, what do we need to know? What do we pick in small caps?
Right, I think there's been a lot of false starts for the size segment overall, but I think, the backdrop does look better than it did relative to the past several years. And, like I said, I think there's a lot of opportunity for the index right now, as well as, a lot of the stories within the index. So hopefully this will finally be the year that we can get out of this, 10-year plus secular downturn in small caps.
Spoken like someone who's had her phone ring off the hook. Jill, thank you so much for being with us. Jill Carey Hall there of Bank of America Securities. And Jill was talking about the credit backdrop and how much that's important to continue being robust in order for the space to take off. We are seeing yields inflect higher, relative yields, but not significantly, still very much strong there.
Well, just the correlation between small cap performance and, the indicators she's looking at, like ISM, you have to kind of dig a little bit deeper when you're looking at companies which are really tied more toward bricks and mortar, the fundamental kind of root of the U.S. economy, as opposed to these large market cap growth-related equities where most investors are parked right now.
Yeah, but I'm struck by how similar it is that we're setting up for 2026, the same way that we were setting up for 2025.
Are you really surprised?
I am surprised. Well, granted, everyone is optimistic heading into the new year, but still, it feels different this time.
Except you and I.
Except for you and I, who are looking at all of the potential doomsday scenarios. It does feel different this time. People are talking about the potential doomsday scenarios and explaining why they're still bullish. So maybe that gives some people a pause. Coming up, we're going to be speaking with Liz Thomas of SoFi, Sarah House of Wells Fargo, after what we got yesterday from the labor market report, ahead of CPI tomorrow, and Bloomberg's Geetha Ranganathan on that Netflix Warner Brothers deal. Mandeep Singh also joined us to talk all about circular financing, or is it? From New York, this is Bloomberg Surveillance. Good morning.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. it means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
This year, it's all about single stocks. It's all about earnings, fundamentals.
For now, investors prefer to focus on AI.
We've got an AI-driven investment boom.
Tech leadership will continue to dominate, but alongside that, we believe you can see that broadening.
A key driver of returns in 2025 and likely in 2026 and beyond is going to be that core AI exposure.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks inflecting higher after 3 straight sessions of losses. Big tech reclaiming some leadership with OpenAI in talks to raise $10 billion from Amazon and use its chips. More on that coming up. Plus, oil prices surging from 2021 lows as President Trump orders a blockade of sanctioned Venezuelan oil tankers. Now, all eyes turn to a presidential address tonight. CPI data tomorrow. We get a host of different rate decisions around the world. And then, of course, University of Michigan sentiment. It is going to be a busy tie-up to the end of the last trading week of 2025.
Yeah, the beta regime is yet to shift. It's still about technology, and I think the market's really coming to grips with the fact that leaning into the AI theme is something that still makes money for a lot of investors.
Well, it raises this issue of at what point do the fears create more confidence that this isn't a bubble? We have heard that consistently from people saying, look, if people still are worried about the ways that things are being financed, then it's time to keep buying, because that means that you aren't necessarily seeing the irrational exuberance of all bubble eras that have come before.
And if you talk to my colleague Rob Schiffman, he'll tell you that from a fundamental credit perspective, these companies, Apple, Amazon, Meta, you name it, are in very, very solid shape.
So it goes to this question of how much can central banks continue to fuel risk appetite? We've already heard from the Federal Reserve pushing back on the idea of rapidly cutting rates. We are seeing the end of the rate cutting cycle around the world, and yet we are expecting some additional rate cuts possibly later this week.
Yeah, that's right. Well, today, Mexico is probably going to cut by 25 bips. Tomorrow, you're going to see Great Britain, but you are going to see a hike by the BOJ on Friday. So it's not all easing across the globe.
Well, it is easing right now when you take a look at financial conditions in the United States, at least ahead of the market open. 90 minutes to go before the U.S. Open, and you do see a lift across the board. S&P futures up almost 0.4%. You do see just a touch of dollar strength reasserting itself, 117.25 in the euro dollar cross. The 10-year yields now up about 3 basis points, a little less than that at 417. Crude really the one to watch, given some of the action over off the coast of Venezuela, up 1.8% off the lowest levels that we've seen going back to February of 2021. Coming up this hour, Liz Thomas of SoFi as stocks edge higher. Geetha Ranganathan of Bloomberg Intelligence as Warner Brothers is urging investors to reject Paramount's takeover bid. And Sarah House of Wells Fargo with investors now awaiting the latest inflation data. We begin this hour with stocks higher ahead of 3 days of losing streaks. We're right now talking to Liz Thomas of SoFi, who wrote, "There remains high anxiety about valuations and bubble-like characteristics, but our stance for 2026 is to befriend the bubble rather than bet against it. Sitting on the sidelines can be the greater risk." Liz joins us now. Liz, it's been too long. Great to see you.
Great to be here.
Thank you for being here. So why do you say it's the bigger risk to remain on the sidelines?
Well, if you just look at what markets have been dominated by, and this is not news to anybody, but we've got the tech sector and the Mag 7 making up almost 50% of the S&P 500. So you really can't be absent from that. And when you think about even what's gotten us to this point, it has been AI enthusiasm. Now we're seeing some really good signs of broadening out. We're seeing other sectors start to take part in this rally and carry their weight. But the reality is, in 2026, AI needs to continue its march forward. That doesn't mean that it needs to lead the entire market again, and all of those stocks need to carry their heavier weight. However, we do still need to see the potential in the future. We do still need to see productivity gains. We need to see earnings strength, and we need the fundamental strength that does exist to remain there. So it is important for investors to still be present in that theme.
So does it make you more confident in remaining overweight in some of these tech names, given the fact that we have seen some hiccups recently, that we have seen skepticism, pushback from the investor community about some of the financing plans from the likes of OpenAI and Oracle?
So we wrestled with this a lot, especially the word overweight, because if you're overweight, it means that you've got a lot. If you're just comparing it to the market, you've got a lot in tech stocks. So even just to be market weight is a big slug of your portfolio. I think market weight is probably the better way to look at it, which still ends up being a lot in tech stocks, communication stocks, basically the Mag 7 plus things like AMD, Broadcom, Oracle, and Palantir, which we're calling the Big 11 then collectively. So if you look at those, you're still going to have a pretty big slug in your portfolio. But into 2026, I think it's also important to make sure that you have exposure to the things that haven't really been a part of the conversation and could become a part of the AI conversation as productivity gains spread across other sectors. So places like healthcare, even materials, if we're looking at not necessarily AI productivity, but economic nationalism, not likely to go anywhere anytime soon. So sectors like materials can really benefit from that. And then consumer staples benefiting, hopefully, from some stimulus that's coming in the first half of the year.
Well, Liz, I know you and the team at SoFi are leading into the AI revolution, but you also referenced the valuation discount between U.S. tech shares and those in China. Talk about China's emergence as a technology hub.
Yeah, so China is it had been one of the winners in 2025. It's something that we believe can continue winning in 2026, not necessarily based on valuations, although that's a bonus, right? You're getting a little bit of a valuation discount in a time when everybody's obsessed with how much they're paying for the potential. But China, if we look at their economy, China has a government that is committed to making sure their economy can come out of this soft patch, and I think they will stay committed to that. So that says good things for the consumer in China going forward. And then Chinese tech continues to innovate at a really fast pace. And we know that U.S. companies are looking at China and trying to size them up for, are we in good competition here? Are we still beating them? And I think that race is going to be good for AI's potential in general.
Liz, I know you're also pretty bullish on gold, the structural buying from central banks. Talk to us a little bit about the place that gold has in a diversified institutional portfolio.
So gold is a topic that I did not think was going to be coming out of my mouth for 3 or 4 straight years. I was bullish on gold a few years ago. People thought I was nuts, or, grandma's trade, somebody buying gold in a time when technology was the hot thing. Gold continues to win. Gold has beat the S&P over periods of time that I don't think anybody expected. I do still think there's opportunity for gold in 2026. The demand by central banks and just the theme of gold being now the safe haven in an era of currency volatility, of a lot of central bank uncertainty, that keeps a floor on the demand because central bank demand is sticky. It's not something that they're going to change very quickly. And we've had a theme of this since Russia invaded Ukraine back in 2022. I think that remains. What's happened in gold over the last year is that retail started to perk up and also participate in the trade, drove it even higher. Now, when retail starts to take part, you see a lot more volatility because we saw almost a parabolic move at certain points this year that then we gave back a little bit. But in 2026, I expect gold to see further upside, and I still think that it can produce attractive returns.
How do you see 2026 being the most different from 2025 in terms of the investment path, given that we did see pretty huge gains in the S&P, we saw gold do very well, and a lot of the same themes that people see continuing?
So we already covered China and gold. Those are the winners that I think continue winning. And then some of the things that I mentioned before. So sectors that I think can step into the limelight: healthcare, materials, consumer staples, and then companies that are what I would call cash cows. And there are actually ETFs that represent things like that. But companies that are in good cash positions that can still finance the growth and finance the CapEx boom that probably continues into 2026. So some of those themes and the value-oriented sectors, I think, probably step into more of a strength position in 26 and will become a bigger part of the conversation than they've been in 25.
What's the biggest risk? Everyone seems pretty bullish heading into next year, and I just wonder whether it's a question of a Fed that doesn't necessarily cut, whether it's a U.S. economy that doesn't necessarily perform, or whether it's something on the geopolitical stage that everyone seems to be ignoring.
So the common answer to this would be that it's the Fed. But if you look at what the market's expecting, the market isn't even pricing in another rate cut until April, maybe even June of next year. So already we're looking forward and saying, all right, the first 4 to 6 months of the year, we're going to be okay without a rate cut. The Fed is now committed to buying $40 billion of treasuries per month until April. So there's enough support there. And then I think everybody's just anticipating this changing of the guard in the Fed chair in May. So we're okay with waiting until we get that next cut. I think the biggest risk, and this isn't all that different from 25, but the biggest risk is that AI revenue doesn't come in as strongly as everybody expects. The revenue is important in order to support the spending, in order to support profit margins. Now, you'll notice I didn't say that the spending is important. Of course it is, but we know that the spending levels are going to slow down in 2026, and that's okay. We're starting to mature in this theme and in the innovation process, but the revenue needs to materialize and the profit margins need to be there as well. I think the most important aspect of this is that we see the AI productivity starting to spread into other sectors of the economy.
As we talk about gold buying by central banks, and I wonder if we could just take that to the next step. Let's talk about the dollar. The dollar's place as the world's reserve currency, the whole dollar debasement trade. Do you think that still has legs?
That has been a discussion, I think, for my entire career, on and off. And I don't think that the dollar will suddenly be displaced as the world's reserve currency. However, we now have things like crypto as an option for investors. Crypto obviously demonstrating a lot more volatility than something like the dollar or really any other currencies, the euro, some of the majors. However, there are other options out there now for investors, and investors are voting with those options and saying, you know what, maybe we don't want so much exposure to fiat currencies. Maybe we don't like the way that central banks are necessarily handling things, and we're not loving the fiscal, I'll call it, indiscipline around the globe. So there have been worries that have come into the picture, and I think the benefit to investors today is that there are other things for you to choose from besides just the dollar if you're looking for some protection or at least just some distance from currency volatility.
I'll challenge you on Bitcoin serving as a store of value in times of distress, but to that point—
I didn't say that.
Right. Swiss franc, Japanese yen. I mean, do some of these other more historically defensive assets still hold muster in your view?
I mean, they hold muster, but they still go into that basket of fiat currencies. So I think the alternative options in the space, being gold and some crypto, are a good way to diversify that exposure. So, I mean, of course, you want a diversified basket of currencies in general. But again, to come back to the original point, I don't think the dollar goes away as the world's reserve currency. But I do think investors have a lot at their disposal today, and they're using it. And it seems as though they're using it properly.
Liz Thomas of SoFi, great to have you on. Let's do it again sometime soon. Liz Thomas there. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Warner Brothers Discovery is advising its shareholders to reject a hostile takeover bid by Paramount Skydance in favor of its original agreement with Netflix. Warner Brothers board is deeming the Paramount offer inferior and inadequate, and that the terms of the Netflix merger are superior. Warner Brothers Discovery's chairman saying it will hold its shareholder vote in either the spring or early summer. And Tricolor Holdings founder Daniel Chu is being charged by federal prosecutors with conspiring to defraud lenders and investors of the company. The subprime auto dealer is alleged to have double-pledged tens of thousands of loans amounting to massive fraud. Tricolor filed for bankruptcy back in September after shutting down more than 60 locations in the southwestern U.S. And FIFA is slashing some ticket prices for next summer's World Cup to $60. The rare move comes following global backlash over high price of entry, with the cheaper tickets to be made available for every game at the tournament in North America. Each team will receive roughly 400 to 750 of these $60 seats under FIFA's new supporter entry tier. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, the morning calls, plus Geetha Ranganathan of Bloomberg Intelligence, as Warner Brothers is urging investors to reject Paramount's takeover bid. That's coming up next from New York. This is Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
We don't think we're near, a kind of hyper speculation level that you'd see in a real bubble. And, our own view is on the Mag 7, they are the core of this era, if you will, this industrial revolution. But we're being selective there, and we think the market is too. I mean, if you look at some of the big players in that space, they're not trading at excessive valuations.
That was Stephen Auth of Federated Hermes earlier this morning, as we do see a lift across the board. Just to give some perspective to his comments, we've seen about a 20% gain so far this year on the NASDAQ. The S&P up about 16%, building on that a little bit this morning, up 0.2% on S&P futures. Yields inflected higher, but lower than they were earlier this morning, gone from 3 basis points to 2 basis point climb, below that 4.17% mark, and not seeing the rally sustain itself quite as robustly in the crude space, coming off some of its lowest levels going back to February 2021. Time now for the morning calls. First up, Baird raising its price target on raw stores to $200, expecting an improving backdrop into 2026. Those shares essentially flat. Next up, Telsey advisory analyst Dana Telsey raising her price target on Gap to outperform, noting continued progress in reestablishing its brands. Those shares up almost 3%. And finally, Barclays upgrading Hyatt to overweight, seeing 2026 as another idiosyncratic year for the gaming, lodging, and leisure space, just in time for all of the holiday vacations, up 1.4%. Turning to media now. Warner Brothers Discovery advising its shareholders to reject a hostile takeover bid by Paramount in favor of its original agreement with Netflix. Geetha Ranganathan of Bloomberg Intelligence joins us now. Geetha, what did we learn so far this morning from this latest filing?
Hey, Lisa. So this is really no surprise at all. I mean, we knew this was happening after Paramount launched its hostile bid. So Warner Brothers basically saying that the terms were inadequate, inferior, and illusory. So inadequate because the $30 a share, they think really kind of undervalues their TV networks. They also raise concerns about financing. So, you know, there's been constant talk about the bid being fully backstopped by the Ellison family. Warner Brothers Discovery Board saying that's not true and that it's going back to an irrevocable trust. So again, there's a lot of uncertainty and a lot of risks. And then finally, I think, you know, Warner Brothers saying that really the regulatory risk between a Netflix deal and a Paramount Skydance deal, not all that different. They also point to completely different financial profiles of both, you know, Netflix and Paramount, you know, basically talking about Netflix being a $400 billion market cap company, Paramount $15 billion. So, you know, just a whole lot of different concerns raised in that letter to shareholders.
Geetha, talk to us about the overlap between Netflix and HBO Max. Is this the most problematic aspect of the combination?
Yeah, Damien, I mean, definitely, you know, this is going to be an issue because just if you combine those two streaming services, they are obviously some of the largest streaming services in the world. They will make up about 30 to 35% of the market. But I think what Netflix has repeatedly argued, and a lot of, I think, investors also seem to agree with this view, that you can't consider just streamers as part of the landscape. You have to include everything. You have to include social media. You're including YouTube. You're including TikTok Reels. I mean, this is how people are spending their time these days. And if you kind of if you broaden and zoom out and look at the whole market in its entirety, then maybe it doesn't really pose such a regulatory problem after all.
Geetha, I'm sure the market is pricing in the prospect of tough antitrust scrutiny over the deal. I mean, what are your thoughts there going forward?
Yeah, I mean, antitrust is definitely going to be a big issue. We just saw, Jared Kushner's Affinity kind of pull out of the deal because of bad optics. If you kind of look at it really from a Paramount Warner perspective, yes, the box office share would be about 30%. Again, Jenry, who's our antitrust analyst, didn't really think that would be too much of a problem. Those two streaming, platforms, again, shouldn't really be so much of an issue because they're both somewhat, or rather Paramount Plus is a little bit of a subscale platform, so still under, the 200 million subscriber mark. So there are just so many different considerations though, Damien, but I think in general, the view was that Netflix would have a tougher time from an antitrust perspective. But again, it's all up in the air.
And part of this, Geetha, has been CNN. A real question of what that looks like in terms of new ownership based on what President Trump has said. What's the proposal in the current proposal from Netflix to buy Warner Brothers for CNN? Do we have a sense of who that remains with?
So with the Netflix proposal, nothing can happen with CNN because because Netflix is only buying the studio and the streaming business. So, with President Trump suggesting that there would have to be a CNN sale, Warner Brothers Discovery would have to figure out some other way to sell just that network. With the Paramount transaction, of course, we don't have that problem because Paramount is buying all of Warner Brothers Discovery, which includes the TV network business as well as CNN.
Meanwhile, there's a real question of financing, and this is clearly what was on the minds of Warner Brothers senior management when they put out this latest filing and recommended to investors that they back the Netflix deal. They said that the Ellison family is not backing the Paramount Skydance transaction. We already saw reporting that Jared Kushner, as you mentioned, pulled his fund out of the participation of this financing. Just how insecure is the position of Paramount Skydance, especially compared to Netflix?
Yeah, I mean, this has really been kind of the sticking point with the Warner Brothers Discovery Board. So, they've argued, if you are, talking about, one of the wealthiest families in the world kind of backing this deal, how are we not seeing it on paper, right? So, you have $40 billion in equity financing, about 60% of that, so almost $24 billion is coming from, Middle Eastern money. You haven't really submitted, a knockout bid. And there is this problem, this constant problem of debt. So, in the letter, Warner Brothers Discovery raises this point that Paramount would be 7 times, Lisa, 7 times levered by the end of next year if they did this deal. That really kind of puts, it just raises so many different risks. And then remember, even if the transaction does go through, you're going to have, a combined company with a very heavy leverage, with 80% of that EBITDA coming from the TV business. That is the melting ice cube business versus, you take a Netflix, which is already generating about $15 billion in EBITDA, and streaming is really in much, much more healthier shape with which much brighter growth prospects. So, everything seems to be problematic about the Paramount deal right now from at least a financing perspective.
And that's why you're seeing Paramount shares lower in pre-market trading and Netflix seeing a boost of about 2% in the pre-market action. Geetha Ranganathan of Bloomberg Intelligence, thank you so much. We look forward to speaking with you extensively about this deal as it percolates through the system. In the meantime, we are getting some breaking news. The Financial Times is reporting that Oracle's $10 billion Michigan data center is in limbo after Blue Owl, the private equity and debt firm, has said that it's not necessarily going to finance this. Oracle shares falling almost 3%, Blue Owl falling almost 4%. And this comes after big questions about Oracle in particular, how much leverage it's packed on, what its promises on the data center front look like, and how sustainable, Damien, some of this really is.
Lisa, I often ask, we're seeing all these CapEx figures tied to AI tech spending last year, this year. But, is that spending, wasn't that planned for 10 years ago when they first, because it takes 10 years to ramp up a data center, right? So my question is, have they really invested anything meaningfully today that's not showing up in 10 years' time? I just I struggle with that a little bit, like where are we in the cycle, and does this really impact what is planned for 2026? I'm not so sure.
This has to do with a 1 gigawatt center that focuses a data center that is being built to serve OpenAI in Saline Township, Michigan. Blue Owl, of course, has been the bigger backer of Oracle and all of its build-outs. It's a private debt and equity fund that has a significant proportion of its investments tied up with artificial intelligence and data centers. That's the other big question here. Have we reached the limits of some of the biggest backers of this for the time being? Does there need to be diversification in terms of sources of money to really back some of these projects?
Well, I think what you're hinting at here is the private credit market actually have its limitations? Because it has been such a, I'm talking shadow financing, I'm talking, the flexibility, the optionality that it affords small and medium enterprises here in the U.S. to fund whatever it is they're looking to do. Now we're seeing some limitations placed on that sector as a potential source of financing.
Particularly by some of the publicly traded private asset
BDCs,
managers.
yeah.
Exactly. So we'll follow the story as it develops. Coming up in the next half hour, Sarah House of Wells Fargo with investors awaiting Thursday's CPI report. Plus, Yahaira Anand with your morning movers. Lennar falling on strains in the housing sector. Those shares lower by 5.2%. Good morning.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. Well, welcome back. We're looking to build on what has been a banner year for equities right now on the 16% gain that we've seen in the S&P 500, adding about 0.25% in pre-market trading, adding a bit more on the tech space. NASDAQ shares climbing as well after, again, I mean, the rally of almost 20% so far this year. I just keep stumbling over that, baby, and the idea, it's been such a good year.
Yeah, no, it has been. And look, I mean, if you listen to any of our guests over the last 2 days, they think next year is going to be much the same. You know, I just find it so interesting that today what we're talking about is exactly the same thing we were talking about 1 year ago. And we are coming off a massive, massive year in both stocks and bonds.
Yeah, and people are looking at possibly greater participation in the bond space next year with long-end yields that have been climbing, although how much do we see the Fed put their thumb on that scale? 1 hour away from the cash open. Here are your morning movers with Yahaira Anna and Yahaira.
Hi, Elisa. We are seeing home builder NAR shares falling 5% in the pre-market as it warns that lower mortgage rates have not done enough to spark a meaningful rise in housing demand. Its forecast for orders, deliveries, and margins for the first quarter all fell below Wall Street expectations, with affordability still a central issue for would-be home buyers, even as the NAR continues to offer big sales incentives that have hurt its profits along the way. Meanwhile, moving on to Frontier shares, those are rising 7.7% in the pre-market. Honor reporting that the airline is back in merger talks with Spirit Airlines, highlighting how all these carriers are under pressure to grow in order to compete with the big three. A deal would create the 5th largest carrier in the U.S. And a big setback for Oracle. The FT is reporting that its main partner, Blue Owl, has just backed out of a deal for a $10 billion data center in Michigan. The project meant to power OpenAI now facing major financing questions as investors continue to worry about Oracle's massive debt and AI spending. The FT also reporting that Blackstone has held talks to step in, but no word on that just yet. Lisa?
Thank you so much, Yahaira. A fascinating development, given the fact that, as you mentioned before, and I think it is the right discussion to have, what are the limitations on private asset managers to really push back against financing some of this build-out?
Or to find, some sort of a syndicate or somebody else in the space to help assist with the funding of it, right? I mean, that's really what it comes down to. And it just seems to me that a lot of money is tied up in other non-performing assets, and it's going to be tough to find powder to put into these data centers and bail out places, people like Oracle.
Yeah, which is a reason why you are seeing differentiation right now within the tech space. Turning now to Washington, D.C., President Donald Trump reportedly preparing to interview Fed Governor Chris Waller for the Fed chair position today. Bloomberg's Michael McKee joins us now. Fast-paced race for the Fed chair, although it has been going on for quite a while. Mike, what's the latest in terms of who is the favorite?
Well, right now, Kevin Hassett is back to being the favorite, but Chris Waller is getting all of the attention on Wall Street because not only is he meeting with the president today, he is speaking right now, and he's talking both about the possibility of becoming the chair and the U.S. economy and what he thinks is going to happen. On the economy, he is defending the idea of continuing rate cuts going forward, saying that productivity could help, and in 2026, it could turn out to be a better year, in part because of AI, in part because of the fiscal stimulus that's coming. And he says he's not particularly worried about inflation because while he knows it's above target, it will be coming down over the next 3 or 4 months. He's referring to the tariff inflation target, inflation that we've gotten, and he thinks that works its way through the economy. He's also saying that, and pressed about it, that of course he would demand Fed independence if he were the Fed chair, but he would continue the tradition of speaking with the Treasury Secretary in whatever administration there is. He is the third contender to meet with the president that we know about. Earlier, we know Kevin Hassett was meeting with the president and tagged as the favorite. Then late last week, the president met with Kevin Warsh, and he suddenly surged into the prediction market betting favorites role. And now it is Waller's turn. He has picked up some bets on that, and he's taken away from Warsh. So Hassett back in the lead at the moment. Nobody really knows what's going to happen. Probably not going to get anything tonight from the president, but he is going to be talking about inflation and what he's accomplished this year. Something to keep in mind, inflation is expected to go up when we get the CPI tomorrow. We don't get a month-over-month reading because there's no October data, but we are going to get a year-over-year rating, and it's supposed to go up to 3.1%. And as you can see, the president's economic accomplishments haven't been all that strong. So it's going to be interesting to see what he has to say about that tonight and how much of it will be accurate.
Michael McKee, thank you so much for that. Sticking with the Federal Reserve, Sarah House of Wells Fargo writing, our base case remains 2 25 basis point rate cuts in the first half of next year at the March and June FOMC meetings, with risks skewed toward more rather than fewer cuts in 2026. Sarah joins us now. Sarah, thank you so much for being with us. This kind of builds on what we're hearing actually this morning from Chris Waller, the Fed governor, who is a contender to become the next Fed chair, where he's saying the labor market is very soft, the U.S. is close to zero jobs growth, kind of fortifying the idea of more rate cutting ahead. Why do you think that this is still the case, even after some of the conflicted interpretation of yesterday's non-farm payrolls?
Sure. So I think it comes down to what we're seeing both on the labor market side and the inflation side. So as you saw yesterday, the labor market continues to gradually soften. We've seen that unemployment rate drift up from 4% at the start of the year to 4.6% in November. And then on the inflation side, so yes, inflation has been sticky. We've been stuck around 3%. We think we'll be there through much of the first half of next year when you measure it on a year-over-year basis. But of course, a lot of that has to do with the pickup in goods inflation that we think is tied to tariffs. And if you look outside goods inflation, you continue to see services disinflate. So at least slower rate of inflation. And stepping back, I really don't see a lot of forces that are going to put even further upward pressure on inflation. So our base case is that you will see inflation improve over the course of 2026, which I think will give the Fed confidence to move closer to that neutral stance.
So do you have a better sense of what neutral is, not just when it comes to benchmark rates, but also when it comes to the labor market? I mean, this idea of zero jobs growth comes with greater participation, more people coming into the labor market, signs that there is a pickup in hiring, at least according to the latest real-time ADP indicators, and a sense that the beginning of next year should be better for the economy. So how weak do you see this labor market as really being?
I don't see it as terribly weak, but I do see it as softer than where we were at the beginning of the year. And now you're looking at the jobs market and the unemployment rate, a little bit on the wrong side of the Fed's maximum employment mandate. So the good news is we're still not seeing, really widespread layoffs. So yes, you've had the Challenger announcements pick up over the past year, but initial jobless claims remain low. But at the same time, we're just not seeing enough jobs being created to accommodate the people who have moved moved into the labor market over the past few months. And if you look at the participation rate, so even with the 0.6 increase we've seen in the unemployment rate, participation is still down 0.1. So I think even with the increase that we saw yesterday, that we're still seeing I think we're still seeing just not enough jobs being created for the broader workforce.
Sarah, you're calling for a CPI print of 3% tomorrow. The market's at 3.1%. What exactly will it take for CPI to fall toward 2% by the end of next year?
So by the end of the next year, I think that might be a tall order. So I think it would need to see slower growth than we anticipate. So we're anticipating that GDP growth next year is actually a little bit stronger, at least if you look at it on a Q4 basis. So you'd probably have to see weaker growth, probably get some help from lower commodity prices, particularly with oil and gasoline. That can lead to some pretty big moves. But I think you can at least get back that direction. So we're looking for core PCE to end the year around 2.5% to 2.6% or so. And I think that's going to come with slower housing inflation. That's already in train. You're seeing on the CPI side further deceleration in things like auto insurance, which is helping. So in some ways, I think this is just some time that it's taking, where the pandemic or inflation, there's a long tail for that, especially in services. And so I think we're going to see some of the benefits of time as we move through the year. And again, just not seeing very many sources of further upward pressure on inflation when you look at the jobs market, what we're seeing in commodity prices outside of precious metals. And so I think you will see that directional improvement as we move through 2026, even if we're not getting all the way back to 2% next year.
And Sarah, what about productivity gains, right? In last week's SEP by the Federal Reserve, we saw they upgraded FY26 GDP growth by 0.8% with no change to unemployment. That's got to be productivity gains, right? Do you think that will help fuel the move for 2%?
I do think that's part of it. So the fact that you have wage costs coming down, but also that's limiting both the ability for consumers to absorb higher prices. But then when you get into productivity, that limits the need for businesses to raise those prices. So we've already seen productivity pick up this cycle by a few tenths. But I think once you get the jobs revisions in terms of those benchmarks that we're looking for, that you're going to see even stronger productivity growth already in train. So probably somewhere a little over 2%. Wage growth right now around 3.5%. So that does point to lower overall inflation, and I think helping to get back closer to the Fed's 2% target.
Sarah, how much is the outlook for next year predicated on who becomes the next Fed chair?
I don't think it's that dependent. So I think no matter who you get, whether it's one of the Kevins, whether it's Chris, you're going to see probably a slightly more dovish skew to the committee with that new leader. But of course, they have to have buy-in from the rest of the committee. And so that's going to depend on the relationships that they build. And I think it's still going to depend on the overall data backdrop. So I think maybe you get maybe one additional rate cut than you would have otherwise, but it's not going to be a wholesale change in terms of the rate outlook, depending on who you get. I think the data is still going to be the primary determinant, given that it is a committee decision.
Sarah House of Wells Fargo, thank you so much for being with us. Have a wonderful holiday season. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The Financial Times is reporting Blue Owl will not back a $10 billion deal for Oracle's next data center. The facility is being constructed in Michigan to serve OpenAI. The FT says Blackstone has considered stepping in as a financial partner, but no deal is solidified. Oracle shares down 2%. Meanwhile, the U.S. is preparing a fresh round of sanctions on Russia's energy sector should President Vladimir Putin reject the latest peace agreement with Ukraine. The new measures could target vessels in Russia's shadow fleet of tankers and the traders who facilitate transactions, with sources saying they may be unveiled as early as this week. And the New York Knicks have won the 2025 NBA Cup, rallying in the fourth quarter to defeat the San Antonio Spurs 124-113. Jalen Brunson scored 25 points and was named the most valuable player of the tournament. While the win doesn't affect their regular season standings, the Knicks will now head back to New York with a new banner to hang in the garden. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. I have to say, when you Google Knicks, just huge fireworks come up if you want to take a look, because at least they finally won. I'm sorry, at some point they've got to win.
Yes. Come on, not finally. They were great last year, and they are great again this year.
Oh,
they are a real contender. I am a huge Jalen Brunson fan, and I am very optimistic about our prospects.
I want the Knicks to be back in the 1990s type of greatness. I mean, come on, let's bring that
yesterday
back.
was a bit of a throwback, right? It was the Spurs Knicks. I remember those days. Tim Duncan, those were great old days. Patrick Ewing. You know what I'm talking about.
Something to look forward to. Up next, setting you up for the day ahead. Plus, Mandeep Singh of Bloomberg Intelligence as Oracle shares fall on reports Blue Owl will not be backing its next data center deal. Those shares lower by about 2%. Blue Owl falling by 2.2% as well. This is Bloomberg Surveillance.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest. And this is Bloomberg.
If you just look at what markets have been dominated by, and this is not news to anybody, but we've got the tech sector and the Mag 7 making up almost 50% of the S&P 500, so you really can't be absent from that. The reality is, in 2026, AI needs to continue its march forward. That doesn't mean that it needs to lead the entire market again. We need the fundamental strength that does exist to remain there.
It is marching forward again, at least this morning. That was Liz Thomas of SoFi. Right now, futures indicating this is going to be the first positive day in 4, at least if we can maintain these gains up about 0.25% on S&P futures. Yields coming off some of the earlier highs, but still 4.16 on the 10-year. We really do want to focus on big tech. Take a look at these two names, Oracle and Blue Owl, two companies that have been very much in the data center sphere. We can see both companies seeing losses of about 2% or more in pre-market activity after Oracle's deal to potentially ink backing for recent data centers in Michigan by Blue Owl seems to be falling apart. This, to me, highlights a question of who is going to be left holding the bag, and it underscores the concerns that some people have. Bloomberg's Mandeep Singh joins us now to talk through this. This is Financial Times reporting now, and good morning, that this deal for Oracle to get financing from Blue Owl seems to be falling through. Why is this so significant at a time where financing is increasingly in focus?
Well, right now, I think Oracle CDS spreads clearly show that there is concern around the level of debt that they plan to take when it comes to building this AI infrastructure. And it's all tied to OpenAI. In my mind, you know, the entire Oracle backlog, which is $500 billion, 300 of that comes from one company, OpenAI. And if OpenAI is losing their lead when it comes to the frontier model labs, that's what Gemini 3 showed us, that they have caught up. Anthropic is doing very well. That puts into focus how much OpenAI will be able to ramp up their revenue, because they do have a $200 billion revenue target by 2030. Can they really get there? And if that's not the case, then how will they finance, you know, all the build out and the spend on Oracle infrastructure? So that's where it's all interconnected in terms of OpenAI not being able to ramp up their revenue, not being able to pay for compute that Oracle plans to bring online. And that's where, you know, the market is showing that concern in CDS spreads and now with this deal.
So it seems like Oracle is a proxy for OpenAI, but the real fear, as you outlined, is that OpenAI cannot make good on pretty lofty promises. And this is only underscored this morning by news that Amazon is in talks to give $10 billion to OpenAI in return for OpenAI using its chips. I mean, how concerned are you about the systemic risk of OpenAI at a time when its promises are getting bigger and bigger?
Well, that's where I think they probably regret talking about 26 gigawatt capacity and the $1.4 trillion in spend they wanted to make by 2030. That's where everything started to go wrong. And, you know, everyone thought, this doesn't seem reasonable, you know, and on top of that, you saw Gemini 3 doing very well. And now Anthropic, which is 2 of the 3 frontier labs, are using Google GPUs. And Anthropic is saying, in fact, for me, Amazon and OpenAI partnering is a sign that Anthropic is further moving away from Amazon and really going in that Google camp where they're going to be using Google GPUs for both training and inferencing workloads. And that, again, puts into focus what happens to the OpenAI ecosystem that involves Microsoft, that involves NVIDIA. And I think you're seeing that concerns really show up in the market right now.
Well, Mandeep, let's talk about those factors that are limiting top-line growth for OpenAI and Anthropic. Is that supply constraints tied to compute for learning and inferencing? I mean, talk to us about what that means. I mean, what are the real constraints that are preventing Sam Altman from growing his company at the pace it needs to?
I mean, so far, the prevailing wisdom was OpenAI has a big lead when it comes to their models, and it showed up in their consumer chatbot MAUs, you know, 800 million monthly active users. Now it seems like all these models have narrowed that lead, even Grok. And, you know, Gemini, Anthropic, all of them are good in certain type of tasks compared to OpenAI. And so that's where that lead has narrowed. And with that lead narrowing, everyone is questioning how will OpenAI 10x their revenue? Even if they get to $20 billion run rate by end of this year, how will they 10x by 2030, given you have got like 4 or 5 players? It's not a winner-take-all market anymore, whereas the prevailing wisdom was it is a winner-take-all market with LLMs, and OpenAI is the front runner. That has changed for sure.
Well, Mandeep, you mentioned Google's TPU, so let's talk about these custom silicon microchips. I mean, are you seeing demand for those increase at the same pace that you would otherwise have thought for NVIDIA, its Blackwell, its chips? I mean, is it rising to be sort of a real rival to NVIDIA on that front?
It certainly is, and the Broadcom earnings actually actually gave us a very clear indicator that they are ramping up with Anthropic, a $10 billion order, and that is all built around Google TPU design. So to my mind, it's a two-horse race now when it comes to accelerators. It's NVIDIA GPUs and Google TPUs, and everyone else is sort of left behind. I'm surprised OpenAI may be leveraging Amazon in a big way, because when it comes to the real performance, it still is NVIDIA and Google TPUs, and that's what's changed again in the last 3 months.
Just quickly, Mandeep, can the entire AI ecosystem see really robust gains if you don't have participation of OpenAI next year?
Well, OpenAI will still be a formidable player, but it's not the only winner-take-all sort of LLM provider, and that's where, you know, having 4 or 5 LLMs is very different from having one company like Search. Google owned Search for such a long time. Everyone thought OpenAI will own that LLM space for a very long time. Now it's 4 or 5 players. So OpenAI will still do well. It's just they can't ramp to $200 billion in revenue in the timeline that they laid out.
Mandeep Singh, it is always wonderful to get your thoughts. Thank you so much for being with us here. Mandeep Singh of Bloomberg Intelligence. Turning to Washington, D.C., President Donald Trump set to address the nation tonight at 9 p.m. Eastern. Bloomberg's Tyler Kendall joins us now from the White House. Tyler, do we have a sense of what he's planning to talk about?
Yeah, hey, Lisa. Well, this is going to be President Trump's chance to address American voters directly, as the White House is already trying to set the tone ahead of the midterms. We heard from White House Press Secretary Caroline Leavitt yesterday preview that we can expect President Trump to tout his policies from this last year, while also saying that he will tease, in her words, ahead. This could be anything from foreign policy to immigration, but of course we know policies ahead. This could be anything from foreign policy to immigration, but of course we know one issue that this White House has been playing defense over has to do with affordability related to its economic policies. And that's going to be something that we're going to be watching really closely here, considering that data and polling has showed us that sentiment has soured. Look at this new poll out from the Associated Press showing that President Trump's handling of the economy among U.S. adults, that approval rating has dropped 10 percentage points since March. And that's really why we've seen this White House roll out new policies in recent weeks, from farmers' aid to investigation into food supply chains to refloating the idea of a tariff revenue rebate check. But Lisa, there is one issue related to affordability I'm going to have my eye on, and that, of course, has to do with health care, which is really dominating the conversation here in Washington today, as it looks very likely that Congress is set to adjourn for the rest of the year without a way forward on those expiring Affordable Care Act premium tax subsidies.
Tyler Kendall, thank you so much for all of the reporting this morning. That is Bloomberg's Tyler Kendall ahead of that address. Affordability front and center, especially heading into that CPI report. Interesting that this is called in tandem with that release.
Yeah, no, I think tomorrow's CPI report is definitely going to be interesting. There's a bit of noise there, right? You're not really getting an October print, so it's kind of like a 2-month print. You have to kind of smooth things over, but I definitely think that the market's focus it's right to be focused on that, yeah.
You know, Damien, thank you so much for being with us both today and yesterday. A really interesting moment. It is the last trading week of a year that has been full of tumult, people heading into 2026 with a similar kind of optimism, but it has a different flavor, a more realistic one, as we were just talking to Mandeep about the AI sector in particular.
Yeah, and I think people are right to be a little bit more nervous about where they are. I mean, we've just come off a major year on both stocks and bonds, as I rightly point out. All asset classes are up, and the beta environment doesn't appear to be shifting all that much. So just how much juice is left in this rally?
Damien Sassower, wonderful to have you. Thank you so much for being with us. Really great to get your insights. Coming up tomorrow, Beata Manthi of Citigroup, Pooja Kumra of TD Securities, Tom Kennedy of JP Morgan, and Emily Rowland of John Hancock Investment Management. We will be taking you to that CPI report. Of course, we're also going to be getting a host of different Fed speak, parsing through that as the Fed race heats up, and a whole host of rate decisions around the world. A real focus on what 2026 will bring as we try to end the year in the green. This was Bloomberg Surveillance from New York. Good morning.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg. You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Green across the screen for equities. 30 minutes until the start of trading in New York. I'm Scarlett Fu in for Matt Miller and Danny Berger. Bloomberg Open Interest starts right now. Coming up, another circular deal. Amazon said to be in talks to invest more than $10 billion in OpenAI. Meanwhile, Warner Brothers is urging investors to reject Paramount's hostile takeover bid and back its original deal with Netflix. And the year's biggest IPO, Medline, makes its trading debut today after raising more than $6 billion. Now, stocks to watch in this early going here. Netflix moving as Warner Brothers advises shareholders to reject Paramount's hostile takeover bid due to concerns about financing and other terms. You see the stock currently up about 1.6% for Netflix. OpenAI is in initial talks to raise at least $10 billion from Amazon and use its chips. This is a potential win for Amazon's effort to broaden its AI industry presence. And Oracle dropping in the pre-market here on a report that Blue Owl will not back a $10 billion deal for their software giant's next data center. So let's begin with those AI deals with Bloomberg Tech co-host Caroline Hyde. Caroline, put this into context for us, because clearly the report about Blue Owl not supporting Oracle's next data center was a surprise to investors.
We are actually getting breaking news from an Oracle spokesperson as we speak, saying that at the moment, the equity deal on the Michigan data center, the one that we're currently talking about, is still on schedule. There had been reports in the FT that there have been some delays, there have been issues with zoning, with getting the right regulatory approvals, and it's meant to be coming on schedule, or at least start work in 2026. So they say that the Michigan center is still on schedule. Oracle is also saying Related Digital, which is actually the company that's building out the data centers, it's their partner of choice that does the digging, that does the putting together. Oracle just leases, and of course it gets the financing from Blue Owl. Oracle is saying Related Digital, it chose the best equity partner on the deal. They're also commenting on the Michigan data center by email as we speak. Now, this is all in response to the FT reporting that is saying that Blue Owl, which basically pioneered the way in which they help finance data center build out and then you lease it to a hyperscaler like an Oracle, like a Meta, like an Amazon, that Blue Owl didn't want to do do this 10 billion, 1 gigawatt version in Michigan. It was within the reporting that there's some anxiety around Oracle. The amount of debt that it's putting on, Morgan Stanley thinks it could go almost to in excess of 300 billion by 2028. At the moment, it's in excess of 100 billion. And there was worries that would Oracle be good for paying these sorts of leases in the longer term? There's also issues that basically the people that are going to lend to Blue Owl, because Blue Owl goes out there and says, yeah, I'll help you finance it, but I'm going to get other partners. I'll put equity into mine, then I'll get other partners and
Spread the
lenders.
risk.
Exactly. That lenders are looking at this saying, I want more strict terms. I want to understand exactly the risk going into this data center. The issue was Blue Owl had actually said, this deal isn't good enough for us. We're not going to do it. But more broadly in the FT reporting is saying actually then other lookers on were thinking of coming in and stepping in to fill the void, but we yet don't know whether there is an equity partner of choice, and that's still in due diligence as we speak.
So you mentioned anxiety about Oracle. Is it about Oracle specifically, or is it about the whole AI build-out?
The way that this reporting is going and the way that the market has been focused on Oracle is, yes, it's more specific to Oracle. People are being discerning. Look, they sold off Meta during its earnings season because they were taking on more and more capital expenditure without perhaps the revenue many felt to prove it out at this time. But they didn't sell off Alphabet. They're not worried about certain hyperscalers that are good for the money, that do have an awful lot of cash on hand, whereas Oracle has been deemed a little bit more risky because the $100 billion of debt, because it's turning to cash flow negative. And then there was the fly in the ointment that we got on the 10Q after its earnings, showing that they had almost $300 billion worth of data center leases going out into the future, and people are just trying to digest that this is enormous.
Yeah, absolutely.
And how is this business model going to hold?
Okay, so we talk about that. We also talked about OpenAI in talks to raise at least $10 billion from Amazon and buy some of its chips. I didn't realize that Amazon made chips.
Yes, Trainium. In fact, AWS, Amazon have been doing this for a very long time, and they've been using their own chips for a significant amount of their own work, but it's also been why they work with Anthropic so closely. They had an enormous deal with Anthropic to bring on and help them develop and train their own models using Amazon's own chips. This is another story of vertical integration. Alphabet's doing it. Amazon has been in many ways pioneering it, but maybe had lost a little bit of the limelight of the prowess of its chips to the likes of Alphabet and certainly to NVIDIA. But here is another case that OpenAI is wanting to get cloud and compute from wherever it can. But can it afford it with the current revenue run rate of about 20 billion for this year, as we understand? Probably not. So they're getting creative. Once again, they're turning to Amazon for equity to be able to pay Amazon in the future for its cloud deals. And of course, it helps Amazon to say, look, we got yet another key LLM designer and maker here using our chips. Maybe it's a competitor to NVIDIA longer term for the inference part.
So for those who are worried about circular financing, they can add this one to their list as well.
It's still coming.
All right, Caroline Hyde of Bloomberg Tech. And of course, be sure to check out Caroline in the 11 a.m. hour. In just a few minutes as well, we will be joined by Wedbush's Dan Ives on his latest note about AI in 2026. Now, in other deal news, Warner Brothers is urging investors to reject Paramount's hostile takeover bid in favor of its original deal with Netflix. Warner Brothers deemed the Paramount offer inferior and inadequate. Joining us now is Geetha Ranganathan of Bloomberg Intelligence. I guess this is not a huge surprise given that Warner Brothers made clear that it backed Netflix's deal from the beginning, yet they have itemized some of their specific concerns. Geetha, how justified are these concerns?
I think it's pretty justified, Scarlett. So they obviously, there's constant referencing to very shaky financing terms. They talk about the Ellison family kind of misleading investors, saying that the deal is completely backed by the family when in fact it goes back to a revocable trust. And the problem there is that those assets can be pulled out at any time. They talk about the language in the agreement having a lot of different loopholes with, Paramount, reserving the right to amend its conditions anytime. Basically, leaving Warner Brothers shareholders to kind of hold the bag, suggesting that much. So lots of risks all over painted by the Warner Brothers Discovery Board, apart from the fact that, of course, the deal itself is somewhat inadequate because it undervalues the TV networks and it's inferior to Netflix.
Now, one potential risk seems to have disappeared because Jared Kushner's private equity firm, Affinity Partners, has pulled out of the bid completely. I think it was supposed to play, somewhat relatively minor role, providing about $200 million to the financing. Does that change the scope of the offer here from Paramount Skydance?
I think a little bit, just the optics of it was really bad, considering his affiliation with, President Donald Trump. But again, I don't think it necessarily changes the calculus all that much, Scarlett. It was interesting that, Warner Brothers Discovery basically saying that they don't really see much of a difference in terms of the regulatory risk for either the Netflix or the Paramount deal, thinking that, they both can ultimately pass muster with regulators. But again, that's all up in the air. We really don't know how that's going to play out. Right now, what they're really, really stressing is that the financing seems very, very shaky.
All right, good stuff. We will continue to monitor this. Geetha Ranganathan of Bloomberg Intelligence. Now, our other top story is the biggest IPO of the year. It's Medline, raising more than $6 billion, pricing the shares near the top end of the marketed range. It gives the medical supply manufacturer and distributor a market value of about $39 billion. Joining us now is Bloomberg's Bailey Lipschultz, who covers IPOs. And Bailey, this was an upsized IPO as well.
Yeah, this was an upsized deal that really kind of surprised some people on the buy side in terms of the fact that they did pretty much maximize the amount of shares that they could sell without having to refile. So, as you mentioned, biggest deal globally this year, biggest U.S. IPO since Rivian back in 2021. So a big deal for a number of reasons, and a big deal getting out of the door in the twilight of 2025, and at least for now, delivering a big win to these private equity firms. It'll be interesting to see how today unfolds and how the remainder of the year unfolds for the company.
Yeah, to that end, biggest private equity-backed IPO as well. In this initial public offering, there are a bunch of cornerstone investors who lined up for a sizable part of the commitments.
Yeah, they stepped up for at least the initial launch, about half of the book. So what that can really signal to investors is, A, there are a number of investors who are kind of a who's who agree in this company's prospects, and also we're basically saying that wherever bankers decided to sell the deal, it would make sense. Not a surprise. We've seen this play out a number of times, but again, when you have a deal that ends up selling more than $6 billion worth of stock, you need people to show up in size, and it certainly doesn't hurt when you have kind of a laundry list of investors who, again, are willing to put their name on the line and are willing to go on the cover. Again, we should get some of the book color in the coming hour or so around how this deal ultimately was allocated, but that kind of is a step that you normally will see when we are in a market that maybe is has less conviction, or, to be blunt, has less than 2 trading weeks left in the year.
Yeah, absolutely. All right, MDLN going public today, and of course we will bring you the numbers when they begin trading. Bloomberg's Bailey Lipschultz covering IPOs for us. In terms of where things stand in the broader market, you are looking at gains here for futures, although we did give back a little bit of the advance following that report that Oracle, cannot line up financing from Blue Owl, at least for the next data center. Plus, Brent crude and gold, you could see they're positive today. A lot of concern about geopolitical risks. The U.S. is preparing new measures against Russia if Moscow rejects a Ukraine peace deal, and President Trump ordering a blockade of sanctioned tankers going into and out of Venezuela. Gold approaching that record high level of 43.81. Now, coming up on Open Interest, Wedbush's Dan Ives sees AI spending in the $600 billion range next year, including plenty of spending from governments and non-tech players. He joins us to discuss his 2026 outlook next. This is Bloomberg Open Interest.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal,
with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
good-looking trophy.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Now to high interest, a look at what's making headlines around the world. Tesla hitting a record intraday high yesterday on optimism around its self-driving and robotics push. But the company's EV business, its main business, still faces challenges. California's DMV warned that it could suspend Tesla's sales for 30 days unless the EV maker stops marketing its full self-driving in ways that the agency says overstates its capabilities. Tesla can avoid the halt if it changes how the technology is described. Waymo in talks to raise more than $15 billion, pushing its valuation close to $100 billion. The Alphabet-owned robotaxi leader is expanding quickly, now generating more than $350 million in revenue. Waymo says the new funding would help widen its fully driverless ride-hailing services across more cities in the U.S. American consumers are spending less on video game consoles, such as Nintendo's Switch 2 and Sony's PlayStation 5. Sales fell 27% last month. That is the worst November in 2 decades. Tariffs and rising component costs have pushed prices to record highs. And OpenAI in early talks to raise at least $10 billion from Amazon. This is a deal that could push OpenAI's valuation north of $500 billion and shift some of its AI training to Amazon's Trainium chips. The move would boost Amazon's young chip business and strengthen AWS as it battles rivals for AI dominance. Talks are preliminary and could change. Now, sticking with the AI trade, in a new note out today, Wedbush analyst Dan Ives says, quote, the AI winners should be bought, given our view that this is year 3 of what will be a 10-year cycle of this AI revolution build-out, with 2026 set to be an inflection point year for AI monetization. Joining me now at the desk is Dan Ives. So year 3 will be when we really see the rubber hit the road. Who's likely to be the winners here? Because it feels like the market's already designated Oracle as a loser.
Yeah, and I disagree that Oracle is a loser, just given my view. When you look at the AI revolution, I mean, for the first time in 30 years, U.S. is ahead of China when it comes to tech. And I think what you're seeing here play out is like, yeah, there's some white knuckles, but the reality is you have $3 to $4 trillion that's going to be spent in the next few years. Oracle is going to play a huge role in that. And I think right now, in the penalty box, I think we sit here a year from now, and it was a huge buying opportunity. Just like the view, if you go back a year ago, New York City cab drivers bearish on Google. AI is going to destroy the model. It's going to get broken up.
In a completely different area now.
Now look today. I mean, you know, everyone's super bullish. So I'm just saying this is a bull market, 2 more years left. And I get it, we're going to have some of these moments, but I don't think in any way that this is sort of the moment where you head for the elevators. It seems that you buy some of these names, in my opinion.
But Oracle's balance sheet looks very different from the other hyperscalers, right? It's not an Alphabet, it's not a Meta, it's not an Amazon when it comes to its cash levels and its cash flow. So there is reason to be at least a little bit more dubious or suspicious of Oracle's finances.
No doubt, but look, when OpenAI calls, you pick up that phone. And I mean, if you look at what that growth's going to look like, I mean, the next few years, you're not seeing the next quarter or two, but in terms of their RPO, we're talking 400 or 500 billion. And obviously, OpenAI, 300 billion of that. But to me, it's just one of those where we're going through one of these periods where it's a glass half empty. And I get it. And I think it's healthy for the overall tech trade. But I think when we look out, I mean, I think tech stocks are going to continue to rip into next year because we're still early days in this AI build out. You only have 3% of U.S. companies that are going down the AI path. And I see it on
It's highly concentrated.
Well, it's concentrated, but now it's spreading. I mean, I see it like authentication, what we see with Orbs in terms of, authentication on that side of the area. You look at cybersecurity, CrowdStrike, you see Palo Alto, you look at other names that are playing it out. I think it spreads to second, third, fourth derivatives that we're going to see play out across tech.
Okay, before I let go of this Oracle story that the FT reported Blue Owl will not back the $10 billion deal for Oracle's next data center, how are you thinking about this reporting? What does it signal to you?
Look, I think there's a better chance of me playing in the NFL this weekend than this data center ultimately not getting built out. Now, I'm not saying terms, partners, it goes through some negotiations, but my view is like in moments like this, just like DeepSeek moments, just like Liberation Day, just like, U.S.-China worries, I get the bears are going to sort of own the day, especially when it comes to like a name like Oracle, but Oracle actually here is a compelling name to own, given the risk reward.
All right, let's talk a little bit about the Amazon discussions with OpenAI about letting OpenAI use its Trainium chips, also investing at least $10 billion in OpenAI. Talk about Amazon's role in the whole AI build-out.
Sure. I mean, look, Jassy is an AWS guy. So if you think about where we are in terms of this arms race, the Dell and Microsoft clearly at the top. You look at everything that Google has done in terms of Curry and how they've successfully built, especially on the cloud side, and really, that's been a huge turnaround. But for Amazon, this is a huge opportunity for them on the data center side, given their cloud customers in AWS to go after them. They got to jump in the deep end of the pool. You do with OpenAI. So I think to some extent, even though right now, if you look at the diversion that we're seeing with stocks, tied to OpenAI that are negative, Amazon, they want to be more associated with them because that is really going to be the build out when we talk about this AI revolution and you're still in the third inning. Amazon wants to ultimately, really build this out with a partner like OpenAI and not be on the other side.
I get that, but will the Trainium chips actually be a real competitor to NVIDIA's chips?
See, my view is today, there's only one godfather of AI. He's wearing a black leather jacket. His name's Jensen. So at this point, 12-to-1 is demand to supply for NVIDIA chips. But the reason AMD, the reason you're going to see other players in, you see Google in terms of what they've done on, from a chip perspective, they'll play in that game. That's a long-term bet. It's no different when Apple bet on chips in terms of they're going to ultimately seed out Intel. It took 5, 6, 7 long-term plays in this arms race that's playing out. But we're in year 3 of an 8 to 10 year AI revolution.
Year 3 in an 8 to 10 year revolution, there's going to be bumps along the way. What do you see as the biggest risk to your bullishness, to this positive story?
Energy. I don't worry about things like the Oracle data center build out. I don't worry about capital in terms of, I don't worry about the use cases. To me, as someone like that's seen it, firsthand, traveling around the world, this is a true fourth industrial revolution. This is not a bubble, this is an AI revolution. The biggest issue in the US is energy. 3% of US companies gone down the AI path. When you get to 20%, kind of clock strikes midnight. So that continues to really be the issue, in my opinion. That's why I think nuclear continues to be the answer. And I think that's something right now, from a U.S. perspective, we're ahead on tech. But relative to China, China's ahead when it comes to energy.
So does the concern about the limitations, the restraints on energy show up in 2026? And if so, how does it show up?
I think I think this is a huge inflection point. You guys see government in terms of administration get fully behind it. You're going to need to see a lot of innovation from a nuclear perspective. Look, solar, grid, things like that, I mean, that's maybe stopgaps, and that could help a little. But in terms of, there's more data centers under construction today than active data centers. Nuclear is going to be the answer. And it comes down to, how do you actually get at what are the private companies out there? What's the innovation? To me, that's the biggest thing that could be the aha moment. Energy is the biggest constraint in the U.S.
Energy is the biggest constraint. So within the AI tech world, the tech name specifically, is there any one that you think maybe has gone past where it should, at least for now. In the near term, you can kind of back off a bit.
I mean, look, there's some
Tesla near record high?
Look, Tesla I've talked to. I mean, this is going to be a golden year for Tesla. And I think $2 trillion, ultimately $3 trillion bull case, because in my view, you talk about everything in AI, autonomous, robotics, it's just starting. Now, Musk, wartime CEO, and I think you're seeing investors understand what the future is going to look like from Elon and Tesla. Look, are there ones that could get over their skis from a stock perspective? Yeah, but right now, it's my view that like investors are underestimating the scale and scope of this AI revolution. And like me and you have talked about, AI party started at 9 p.m. It's now 10:30 p.m. Party goes to 4 a.m.
All right, 10:30 p.m. until the party ends at 4 a.m. Wedbush's Dan Ives, always a pleasure. Thank you so much for joining us on set. A lot more to come here on Bloomberg Open Interest. In the next hour, we've got more on the AI trade with Ann Berry of Threadneedle Ventures. This is Bloomberg Open Interest.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Bringing you up to the minute news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. A check on futures ahead of the opening bell here in New York. We're looking at futures higher, pointing to a positive open for the S&P 500, potentially a rebound from a 3-day decline. The S&P yesterday testing its 50-day moving average, its short-term trend line, but did manage to stay above it. All right, let's take a look at some of the other movers on our radar. Homebuilder Lennar's forecast for quarterly home orders missed estimates as affordability and the weakening job market puts buyers on the sidelines. General Mills, its sales topped expectations as it improved packaging costs and lowered some prices. And we get Micron earnings after the bell. This is the memory chip maker who has nearly tripled in value this year as it capitalizes on price increases for its products. And Robinhood unveiling a suite of new betting features, including parlays for football games. It says more than 1 million users have traded roughly 11 billion contracts so far. The CEO, Vlad Tenev, will be joining Bloomberg Markets today at 12 noon with Tim Stenovic and myself. All right, less than 4 minutes ago before the opening bell, our next guest is Seema Shah. She says the same growth drivers that proved resilient in 2025 will continue to reshape the macro landscape in 2026. She joins us next. This is Bloomberg Open Interest.
cidade estava sitiada.
Nisso, ao começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Moments away from the start of trading, and this is Bloomberg Open Interest. I'm Scarlett Fu, stepping in for Matt Miller and Danny Berger. All right, we have futures rising right now. They did close higher before the market begins opening, and what we know is that they are up, and this could be the end to a three-day decline in U.S. equities. Medline's CEO is ringing the opening bell over at NASDAQ. Of course, we're waiting for those shares to begin trading under the ticker MDLN, and members of accounting firm Andersen celebrating its IPO at the New York Stock Exchange. Let's take a look at some stocks to watch right now. Netflix moving as Warner Brothers advises shareholders to reject Paramount's hostile takeover bid due to concerns about financing and other terms. OpenAI is said to be in initial talks to raise at least $10 billion from Amazon and use its Trainium chips. That's a potential win for Amazon's effort to broaden its presence in AI. And Oracle dropping on a report that Blue Owl will not back a $10 billion deal for its next data center. Oracle is now saying that final talks on an equity deal for a data center project in Michigan is, quote, on schedule. The stock lower by 2.8%. Big picture, my next guest says that the global economy proved remarkably resilient in 2025, weathering policy shifts, trade tensions, as well as inflationary pressures. Principal Asset Management's Seema Shah says that moving into 2026, the same forces that underpinned last year's growth, strong household and corporate balance sheets, agile policy responses, and accelerating AI investment are reshaping the macro landscape in significant ways. Seema joins us now. So Seema, we talk about some of those driving forces. Do you see them waning or picking up steam in 2026?
So they actually stay fairly consistent for this year, for 2026. There's a couple of changes. So we are expecting the household balance sheet to stay pretty strong. Corporate profit margins are at cycle highs. So that's providing this cushion. Now, we know that that's at the surface level, particularly in the household balance sheet side, because we keep hearing about the K-shaped economy. And certainly from the Trump administration side, that will be, I think, a key focus for 2026. So there could be some deterioration. There could be some strains for those lower income earners in terms of the way that they spend, the magnitude of their spending. Thankfully, we should have, well, we will see the government fiscal stimulus coming through with the One Big Beautiful Bill having a nice bit of injection, cash injection almost for households, as well as pushing down the effective corporate tax rate for corporates in 2026. So those are the kind of the new things that are coming through. And then, of course, there's a very, very important pillar, which is relatively new, which is AI CapEx. And we're not really seeing any clear signs that there's going to be a meaningful slowdown. So as we're looking through to 2026, this is still a really constructive macro backdrop, ideally with less policy uncertainty that was shaping part of the first half of this year.
This constructive macro backdrop, that definitely appears to be the consensus. People are really looking ahead to 2026 and saying that they see more of the good stuff, more of the tailwinds that we got in 2025. How much of this is all priced in? I mean, is the best scenario priced in right now?
You're right. So this is very much a consensus view. It's almost a struggle to find anyone who's very, very negative about the growth outlook. The kind of the key risk, which is sometimes being flagged, but I don't think with any significant conviction, is really around inflation. What questions around, are we underpricing the risk that inflation is going to take off? We're not seeing any clear signs of that, but we do admit that that is a risk, particularly when we're coming off the back of tariffs and we're ultimately just looking for how companies are going to be behaving in the first 2 quarters of next year. The other big risk, of course, is going to be around AI, and we have seen that narrative shift where there's more and more questions. So I'd expect that every earnings season will be looking for proof of delivery. Really, are these companies delivering on these expectation earnings? And can they continue to reassure concerns from investors that there is a bubble building up? So we think that they will prove, I guess they will continue to deliver on those earnings, but I do expect that caution, that concern to persist through 2026.
That persistent caution will persist. It's going to be something of a backdrop for investors. So do investors start to broaden out their focus beyond the big tech names in the U.S. to the rest of the market in the U.S., to other companies outside of the U.S.?
Yeah, and as you can imagine, this is really the key question for investors. No one really wants to be left behind in the tech story. There are concerns about the bubble, about a bubble, but that still doesn't mean that they want to necessarily move away from tech exposure. And certainly that is our view as well, that we do think it will continue to be a leader. But there are other ways of positioning the portfolio, kind of adding some elements of diversification, as well as trying to build on something that could be fairly impressive gains for next year. So with a positive cyclical backdrop, we should see this broadening out of gains. We're expecting it to see in areas such as financials, just from a general positive macro side. There's also going to be other sectors which are going to be performing well as they feel the benefits of the AI adoption that they've been taking on. Even on a cap side basis, we think that with a strong macro backdrop, as well as you can side that with a couple of Fed rate cuts, that is typically good news for small cap. And then, of course, there's the rest of the world. So really looking outside the US, typically we're seeing investors still trying to stay with the tech theme, but they're looking to Asia, saying, well, look, there are slightly cheaper valuations. There's some really good news stories. And if you really want to be outside of tech, or at least have some diversification, then they're looking to Europe and saying, look, there isn't as much exposure to technology within Europe, but they are still set up to benefit from AI adoption gains. So there's a lot of positive stories out there that you don't just have to be in the mega cap tech story in the US.
Got it. But because so much of it is concentrated in the mega cap tech space in the U.S., that's really helped bolster GDP, at least here in the U.S. How are you thinking about this differentiation and what that means economically for the U.S. and for other countries?
Yeah, we still think that the US is going to be the strongest performer for next year. You know, I think it's one of the few countries where you're seeing this combination of monetary stimulus as well as fiscal stimulus. There's not many of them out there. And then, of course, with, as you said, the composition of GDP really made up so much of AI and the capex that's going on there. That's another propeller. So the US is still the strongest performer, but that doesn't mean that other countries, other regions aren't going to do well, particularly from a valuation perspective. So, for example, for Europe, valuations are not are quite attractive relative to the US. It doesn't have as much exposure to tech, though, but the fundamentals of those valuations almost balance out to have an attractive offer for some investors.
What is your biggest concern, Seema, as we head into 2026? What's the one thing that you can't shake? You mentioned inflation. You mentioned, of course, the whole AI narrative and how it's shifting a little bit. But what seems to be the thing that could really disrupt the consensus view?
Well, I think the biggest risk is still going to be the AI concerns, but I think the most pertinent risk potentially is going to be in the fiscal side, partly because the US story is so much intertwined with what's going on globally. So let's say that there were a bad news story in another major developed market around the world in terms of their fiscal stance, their fiscal positioning, then that's something that I think the US is fairly vulnerable to. So that is probably the most the highest risk, the most pertinent risk, I guess. But the biggest risk would certainly be the AI story really starting to fall apart.
Starting to fall apart. We'll see how it all shapes up. Oracle, perhaps the poster child for a lot of that anxiety. Seema, really appreciate your joining us. Seema Shah of Principal Asset Management. Thank you so much. All right, let's get a check on the stock market right now. You are looking at a net change that's in the red here for the S&P 500. In terms of the moves, we were set up for a higher open here, but you're looking at Amazon, Apple, and Netflix as the biggest point contributors to the S&P 500 at the moment. On the negative side of the ledger, NVIDIA, the biggest company here in the S&P 500, Alphabet and Broadcom are the big decliners at the moment. Let's take a look at the sector performance here. Within the S&P 500, you have 11 industry groups, and energy leading the way, up almost 1%. Consumer staples up by 0.5%. General Mills, a big part of that story, and financials gaining 0.5% as well. On the downside, communication services losing about 0.5%. Tech down 0.4%. Utilities lower by 0.2%. Add it all up, and you have an S&P 500 that is currently unchanged at the moment. Coming up on Bloomberg Open Interest, Oracle dropping this morning as Blue Owl bails on a $10 billion deal for its next data center. We've got details next. This is Bloomberg Open Interest.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15%. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
It's time now for our top calls, some of the analyst action and focus this morning. First up, Wells Fargo cutting its rating on Sweetgreen, warning that the salad chain's 2026 outlook remains pressured as fast casual demand softens. The stock up about 1/3 at the moment. Next up, Telsey is upgrading Urban Outfitters and Victoria's Secret. The firm sees an improved path of momentum at Victoria's Secret. The upgrade on Urban Outfitters reflects new concept growth. Those shares both higher right now. And finally, Jefferies downgrading Constellation Brands, the parent company of Corona Beer. The analyst warning that prolonged weakness among Hispanic consumers weighs on sales and erodes its earlier confidence in a near-term recovery. Constellation Brands now down about 1.6%. And turning to tech, Oracle dropping on news that Blue Owl will not back a $10 billion deal for its next data center. Oracle is now saying that final talks on an equity deal for a data center project in Michigan is, quote, on schedule. Bloomberg Intelligence Global Head of Tech Research Mandeep Singh joins me now at the desk. Yet you see Oracle shares down, and Oracle's been kind of the poster child of anxiety over AI bubble fears. What does this latest headline mean for those concerns?
That if you're a neo cloud or someone like Oracle, funding your data center build out may get harder because everyone sort of needs AI data center capacity now. No one wants to fund it to build something that's going to be live 3 to 5 years out because you don't know the shape of the revenue curve that an OpenAI may have, because in the end, Oracle's more than half of their backlog is linked to one company, OpenAI. And if OpenAI is partnering with Amazon, partnering with AMD and everyone else, then what does it mean for the demand that Oracle may have 3 years from now? And I think that's the big question mark here.
And you see that reflected in all, not just the equity, of course, but also in its bonds and in the credit default swaps. I'm so glad you bring up Amazon, because OpenAI is in talks to raise $10 billion from Amazon and use its Trainium chips. Where does this place Amazon in that circle, in that chart of circular financing around OpenAI?
I mean, right now, OpenAI's approach seems to be to, get chips or funding from whoever they can. They even got $1 billion from Disney. And, so they are doing partnerships, with any and everyone they potentially can on the chip side, on the content side. But I think what really triggered this for Amazon is Anthropic really moving very clearly towards Google GPUs. In fact, Anthropic has a $10 billion order with Broadcom now to ramp up Google TPUs as their own chips for training and inferencing workloads. And so from that standpoint, Amazon, having invested $8 billion in Anthropic, didn't really result in that partnership getting bigger in terms of Anthropic using more Amazon chips. And to me, NVIDIA GPUs and Google TPUs are way ahead of AMD and Trainium right now in terms of the accelerator chip capacity that everyone wants to deploy their AI on.
Is it fair to call these Trainium chips from Amazon AI chips, or they're not quite there yet?
Well, they are still in their 3rd version. So when you compare that to a Google TPU, which is in its 7th version, and really, obviously, NVIDIA is way ahead of everyone else in terms of the number of versions they had with their chips, and every version has a performance upgrade. So from that standpoint, Amazon still has some ways to catch up to these two, NVIDIA and Google GPUs.
Okay, got it. We've seen investors start to really make a discernment between NVIDIA and Amazon and certainly Oracle. who's coming out ahead? Who surprises you in terms of a company that's kind of shot up to the top of the list?
I mean, right now it's Google this year, and that's reflected in their stock performance, not only because they've been able to defend their search business, they've done phenomenally well when it comes to their own chips and the vertical stack integration. Look, for someone like Amazon, I mean, clearly they want to add as much cloud capacity and partner with, LLM providers because they don't have their own LLM like a Gemini for Google. And so from that perspective, Oracle trying to build just the GPU business, again, for a demand that's further out, that's the concern. But look, everyone still believes that there will be $3 trillion in aggregate spent on AI infrastructure through 2030. The question is it going to be winner take all when it comes to LLM side, which was the the narrative with OpenAI, but that seems to have shifted because all these 4 or 5 LLM providers are neck and neck when it comes to new model releases and functionality.
Okay, so from cutting edge technology, let's go back to something that's a little bit more old school, which is memory chips. Micron will be reporting earnings today after the closing bell, and this is a stock that has done phenomenally. It's up almost 180% this year. Based on memory chips, what is the tie to AI here for Micron?
I mean, look, how does AI work? AI can do a lot of personalization if it knows a lot more about you, and that's where, a Meta is trying to apply a lot more AI chips to their ad targeting. And, all these companies that are developing virtual assistants need, chips with a lot of memory. And that's what we are seeing in the demand. I mean, Micron is sold out for 2026. And it's still an oligopoly, so it's not as if you're going to have a new memory chip player. It's still SK Hynix, Samsung, and Micron, and all of them are sold out because for inferencing, you need a lot more memory. For training workloads, you needed a bigger compute cluster. For inferencing, you need a lot more memory, and that's a nice tailwind for all these memory players.
You said they're sold out for 2026. Demand is certainly seen as robust. The competitors are those in Asia. What does the supply globally look like then?
Well, so all these companies, I mean, Micron, for example, doesn't have a big China business. So, SK Hynix is still the primary provider for someone like NVIDIA. And so when you look at the DRAM market share, that's how it's translating into, the market shares that we are seeing in HBM, which is the memory used for these AI accelerator chips. And so from that standpoint, all these companies are adding capacity, but we are not at a point where we feel like we'll be oversupplied anytime soon when it comes to memory chips.
All right, Mandeep Singh, thank you so much. Mandeep Singh of Bloomberg Intelligence answering all of our tech questions here this Wednesday morning. Coming up, Lennar, the home builder, disappoints. Affordability pressure is mounting on the home builder as it navigates what it calls a challenged market. The stock, you can see they're down about 5.5%. That's next. This is Bloomberg Open Interest.
up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. We're 20 minutes into the trading session here on this Wednesday morning, and you're looking at stocks, at least for now, in the red. Not by a whole lot. The S&P 500 marginally lower. The NASDAQ 100 losing about 1/3 of 1% here, as you see some big decliners in the biggest name, NVIDIA. And in terms of actual names, OpenAI said to be in initial discussions with Amazon to raise at least $10 billion from that company and use its Trainium chips. You could see Amazon getting a bit of a lift, up 0.3%. And of course, the other big story that we're continuing to cover, probably through the next year and a half, is Warner Brothers Discovery bidding war. Netflix moving as Warner Brothers advises its shareholders to reject Paramount Skydance's hostile takeover bid due to concerns about financing and other terms. Paramount Skydance currently off by 3.5%. Jared Kushner's Affinity Partners private equity firm also pulling out of that deal as well. And keeping an eye here on Zillow and Lennar. Both shares are in the red right now. Lennar's forecast for quarterly home orders missing analyst estimates. Those results came out yesterday after the bell. So for more on those results, Bloomberg's markets correspondent Nora Melinda joins us now. And Nora, when it comes to Lennar and the home builders, it all comes down to affordability concerns.
Absolutely, and that's what we're really seeing being displayed here through Lennar earnings. Of course, we know Lennar does focus on first-time home buyers. They have move-up buyers and just your traditional, any sort of buyer here. So they really do have a diverse group of a target audience here. But we are really hearing a forecast for the first quarter that's not positive. They're reporting first quarter earnings, gross margin, and deliveries that all are falling short of expectations. So this really is just underscoring the pressures that we've really been seeing in this market as you think about affordability pressures, as well as a lot of job insecurity that's going on right now in this time period, Scarlett.
Yeah, the softening job market can't help, but it is notable that interest rates have moved somewhat lower, and this is something that Lennar pointed out in their results.
Right, and we are seeing a pullback in rates, as you're mentioning, but we are also seeing some increased competition from the resale market. So that's also adding to luring the buyers, trying to figure out what makes the most sense for them. But what's really also been weighing on Lennar in particular, we're looking at shares of Lennar down about 17% so far this year, and we've really been seeing them dealing with a lot of incentives that's weighing on margins. So they are trying to lure buyers in by saying, hey, let me take your mortgage rate and bring it down by about 1% to make it more affordable, enticing for the buyers to come and purchase from them. But it also is weighing on profit here.
Yeah, absolutely. Those incentives, bring the volume up, but at the expense of profitability. So how is Lennar adapting to this new normal of affordability concerns and the fact that it needs to offer all these incentives to buyers?
That's the balance that we are hearing investors really looking for them being able to see displayed as whether or not they're able to strike this balance here. I mean, we had Barclays saying that even though deliveries may rise, this also does come at the expense of margins as we look ahead to the first quarter. So it's about whether or not they're able to adapt and also maintain competition, a competitive edge against the resale market. And then also we are seeing, of course, a lot of demand as we think about the competition that's coming from its direct competitors as well.
Yeah, so I think it's really interesting you point out about the competition from the resale market, because that is the bigger part of the housing market.
Absolutely.
New construction is not giant in terms of market share.
Right, and if you think about the fact that home builders had been doing well in years past, just off of the fact that there was a scarcity of available homes on the market that were previously owned. But now we are seeing people who are trying to shift a bit, and actually we are seeing people who were owning homes previously now putting it there on the market. But of course, rates still remain high. We've also got tariff concerns that still remains an issue when we think about the access to materials for this market in particular. But additionally, just the consumer right now, they're incredibly strapped. And for a lot of people, as much as they may want a home, it may not be the first on their priority list right now when they think about financing.
Yeah, so in terms of inventory, we see more listings in the resale market. What does inventory look like for the builders themselves, for a Lennar, for a Pulte Homes?
Yes, so they certainly have a lot of inventory. So we are also seeing that as a competitive push against Lennar when we think about the fact that a lot of its competitors do have a lot of inventory on the market, which makes it more challenging for the likes of Lennar. And you're definitely seeing that reflected in the trade. I mean, of course, we do see Lennar leading a lot of these home builders lower as we are looking at the trade so far this morning.
All right, good stuff. Nora Melinda, thank you so much. Bloomberg Markets correspondent Nora Melinda with Lennar's latest results. They came out yesterday, and a disappointing read, at least if you were looking for a rebound in the housing narrative. In terms of what we're seeing right now in the early trade, you're seeing a mixed picture. The Russell 2000 gaining 0.5%. So all those predictions of the market rally broadening out, perhaps that's taking place, the rotation away from the mega cap tech names and into some of the smaller names like the Russell 2000. The S&P 500 currently lower by 0.1%. This would mark a fourth straight day of declines if we hold on to these declines. The NASDAQ 100, the leader here in terms of declines, lower by 1/3%. We'll continue to keep an eye, but NVIDIA among the decliners here. Amazon holding on to a gain of 0.6%. Coming up in the next hour, Threadneedles Ann Berry joining us next on what she sees as a true hidden gem in Netflix's bid for Warner Brothers Discovery.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
CBS News on the Hour, sponsored by Eggland's Best.
I'm Deborah Rodriguez. Rob and Michelle Reiner's son Nick is expected to appear in court in Los Angeles next hour to face charges of first-degree murder in his parents' deaths. Those charges could make the 32-year-old eligible for the death penalty or life in prison without parole. Meantime, there's new footage of his arrest. Correspondent Jonathan Vigliotti.
New video from a convenience store here in downtown Los Angeles. Surveillance video showed Nick Reiner on Sunday evening around 9 o'clock entering that store wearing a striped shirt. Shortly thereafter, LAPD cruisers arrive on scene and officers take Nick Reiner into custody.
President Trump set to address the nation from the Oval Office tonight after ordering a blockade of sanctioned oil tankers into and out of Venezuela. CBS's Charlie D'Agata.
He says it won't be lifted until, quote, our oil, land, and any other assets are returned to the United States, making it clear this is more than just about drug trafficking.
In Australia, 2 of 15 funerals have been held for the victims of Sunday's terror attack at a Hanukkah celebration on Bondi Beach. 6 of the 22 people injured are in critical condition. Prime Minister Anthony Albanese is vowing to take whatever government action is needed.
We want to stamp out and eradicate anti-Semitism from our society. We want to also stamp out the evil ideology of what would appear to be, from the investigators, an ISIS-inspired attack.
The surviving shooter has been charged with 15 counts of murder. Colder weather and rising electricity and fuel costs could set you back a bundle this winter.
The average U.S. household is projected to spend $1,000 to heat homes this winter, up nearly 10% from last year. Georgia Public Service Commissioner Tricia Pridemore says people should check their utility provider website.
There's a lot of flat billing options available. There's a lot of cost savings and energy efficiency items available on those websites.
With utility costs rising, the Trump administration has sharply cut funding for a program that helps low-income residents pay for heat. Jim Crisula, CBS News.
Paris Premier Museum is back in business despite an ongoing walkout. CBS's Haley Ott.
The Louvre is bowing to the pressure of a lot of, frankly, angry tourists and partially reopening today after staff voted this morning to extend a strike that began on Monday. It's been closed since the start of the week after unions representing the roughly 2,200 Louvre employees voted to picket for better working conditions.
This is CBS News. Police in Mississippi have arrested a woman who allegedly shoved razor blades into bread at 2 Walmart stores.
It's a really strange thing to do.
Biloxi Police Lieutenant Candace Young says several customers complained last week, but police weren't notified until Monday.
They also, at that time, found a muffin that had a fish hook in it. Somebody had poked those items through the plastic packaging.
Police checked surveillance video and arrested 33-year-old Camille Benson of Texas. She's been charged with attempted mayhem. Her bond was set at $100,000. No injuries have been reported. Michael Wallace, CBS News.
Lots of people are lining up for a shot at winning tonight's $1.25 billion Powerball jackpot. These players in Hammond, Louisiana have big plans.
Disappear. Disappear. Get a house with it.
I'll probably go to Australia.
Get a car, because I don't have a car.
The odds of winning tonight are 1 in 292.2 million. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube. Head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. It is Scarlett Fu, Paul Sweeney, the Bloomberg Intelligence Program. Coming up, we're going to check in with Geetha Ranganathan, Bloomberg Intelligence Media Analyst, on this whole Paramount, Netflix, Warner Brothers Discovery red headline just crossing the terminal. Paramount says it's good with its $30 bid out there. Thank you very much. Warner Brothers has advised its shareholders to go with Netflix, so we'll see what the latest is there. Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. She's going to join us and get her thoughts on these markets as we look ahead to 2026. George Ferguson, Bloomberg Intelligence Senior Aerospace and Airlines Analyst. Talk to us about Spirit Airlines. They're looking to merge with Frontier. I would think the regulators would let these little airlines merge just to survive.
Didn't they try something like that before?
Yeah, and they blocked it for antitrust. I mean, are you kidding me?
So what's changed?
I don't.
New administration.
New administration. That's good enough for me. So we got a lot coming up in the next couple of hours. Let's kick it off with Lisa Mateo and a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around the clock. For traders, they're just gearing up for inflation data. Federal Reserve Governor Chris Waller signaling support for further rate cuts. The November CPI report comes out tomorrow. Right now, stocks are mixed. We have the Dow up about 0.5%, 251 points. The Nasdaq down 0.2%, 45 points. The S&P 500 little change, down just a fraction. The two-year yield 3.49%. That's little change, and the yield on the 10-year 4.15%. We have oil jumping right now. We'll look at Brent crude, $59 a barrel. That's up nearly 1.5%. Gold higher. COMEX gold at $4,375 an ounce. That's up about 1%. The Bloomberg Dollar Spot Index strengthening by about 0.1%. Over to company news. OpenAI is in initial discussions to raise at least $10 billion from Amazon and use its chips. Now, that would be a big win for Amazon's effort to grow its AI presence, also to compete with NVIDIA. We look at Amazon shares. They're up about 0.7 per share. We look at NVIDIA. They're down nearly 2%. You mentioned it, Paul. Netflix, Warner Brothers Discovery, Paramount, Skydance. Let's check in with their shares. We have Netflix up about 2.5%, Warner Brothers Discovery down 0.5%, and Paramount Skydance down more than 3.5%. And finally, shares of Oracle, they're lower. They're down about 4%. The Financial Times reported that Blue Owl Capital will not back a $10 billion deal for its next data center, but Oracle is responding. They're saying final negotiations on an equity deal for that data center project in Michigan are on schedule and does not include Blue Owl Capital. There you go. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu. We're joined by Bloomberg's Carmen Reineke. Carmen, what are you looking at?
Yeah, so the first thing I'm looking at today is General Mills, ticker GIS. So shares are up about 1.5% right now. So this is off highs of the day, but so what happened is the company reported sales that beat Wall Street expectations, really signaling that a strategy to improve packaging and marketing while lowering prices is paying off. The company also made some comments about economically strained consumers. So basically they said that they're seeing those consumers making more purchases on sale than at regular prices. They own Cheerios, Betty Crocker, and Old El Paso brands. They also reported there's been an increase in cooking at home among value shoppers, so it's pushed some of the sales to things like Betty Crocker, you know, the things that you make at home versus, you know, maybe the Cheerios.
I'm Honey Nut Cheerio guy, big time.
Oh, they're so
good. We have that on the 6th floor.
I go for the generic ones.
You do?
But yeah, I'm part of that wave of consumers seeking value.
Private label.
Yeah, there you go. All right, let's talk some AI, Carmen.
Yeah, a lot of movement in the AI stocks today. So let's look at Oracle first. It's down 4.5% today. So the company said final negotiations on an equity deal for a data center project in Michigan didn't include Blue Owl Capital. So this is a firm that's helped finance a lot of major data center projects for other firms. other than Oracle, including like Meta Platforms. So they said that it doesn't include Blue Owl, but that overall negotiations are on schedule. Their development partner, Related Digital, said that they chose the best equity partner from a competitive group of options, which in this instance was not Blue Owl.
NVIDIA.
Yes.
What's happening there?
NVIDIA, we're also seeing fall today, so it's down right now about 2%, which is a $92 billion move in the stock. I always like to point that out because even if the percent doesn't...
So massive.
Yeah, sound high. It's very significant. So OpenAI is in discussions to raise at least $10 billion from Amazon and use its chips, which is a major competition for NVIDIA. So they have been using NVIDIA chips, but the deal under discussion would use Amazon's Trainium chip. And probably, in conjunction, right? They're not just going to use one kind of chip, but yeah, definitely sort of ramps up some competition for NVIDIA.
All right, Carmen, thank you so much. Carmen Reinecke giving us our market movers for the morning. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. And Paul, you were just telling us about the red headline that crossed about Paramount updating its bid for Warner Brothers, but it did not increase its price.
Yeah.
It's sticking to that $30 a share offer for Warner Brothers, but what they did do is offer some more commitment on financing, $41 billion new equity backstop. Geetha Ranganathan is Bloomberg Intelligence analyst on U.S. media, and she's here with us now. Does this move the needle at all here, Geetha, for Paramount to basically talk about the financing and how it's going to backstop it by the Ellison family, but not change the actual price?
Yeah, not completely sure, Scarlett. I do think that they need to up the price. Warner Brothers Discovery, of course, the main concern that they raised was financing, but they also called the proposal inadequate, inferior to Netflix, and illusory. The inadequate really stems from the fact that they feel that Paramount Skydance is undervaluing their TV network business pretty substantially. Plus, they also talk about the extra almost $2 a share that they would need from Paramount if they were to walk away from a Netflix. This is to cover both the termination fee that Warner Brothers Discovery would owe Netflix, as well as some of the financing costs. So there's all of that. You kind of put all of that math together, and we come up with at least a $32.50 increased bid that Paramount would need to present in order to kind of get the Warner Brothers Discovery board back to the table. So yes, the financing helps a little bit, but not sure it really changes the conversation.
We haven't heard a whole lot from Netflix recently. Are they just quietly sitting on the sidelines and confident in their bid?
So they did, put out a letter to employees, shareholders, just kind of reiterating their commitment to the deal. They think that it will go through. They don't think they will have, huge problems with the regulators. And it was interesting today, even in the Warner Brothers Discovery letter that they put out, suggesting that, they don't see, rather that they view both of the deals as equal from a regulatory perspective. And one of the key numbers that they highlighted, the Warner Brothers Discovery team, was the $9 billion in synergies. So Paramount Skydance basically talking about $3 billion in synergies from its Skydance deal, $6 billion from the Warner Brothers Discovery deal, saying that will actually put a lot of, that's bad for Hollywood.
Sure.
It would result in a lot of job losses, whereas the Netflix deal might actually be better. So who knows?
Who knows? And I mean, this is something that's going to play out over the next 1.5 to 2 years. Geetha, we know that Jared Kushner, the president's son-in-law, his private equity firm Affinity Partners was involved in the Paramount Skydance deal. It was supposed to contribute $200 million to the financing, but it has since pulled out of this bid, perhaps because of potential conflicts of interest. Does this change the scope of Paramount Skydance's offer? Does it make it more attractive, less attractive, or does it not really do much?
I think, yes, you're right, Scarlett. The optics were definitely bad, and it kind of, looked a little bit questionable. So now they're kind of removing that, which is definitely good. I think I think it's more positive for the Paramount Skydance deal. That said, though, I think they really, really need to deliver a knockout bid, and the knockout bid that we're kind of looking for is something like $35. I think that really then gets Netflix thinking about, okay, do we need to re-up our offer? And everybody gets excited at the Warner Brothers Discovery Board again. Until they do something really significant on the pricing front, I don't think the Warner Brothers Discovery Board is going to want to come back to the table to re-engage.
Geetha, one of the comparable deals out there for a spin-off of Warner Brothers Cable Networks is what Comcast is spinning out its cable networks into a company called Versant. Is that publicly traded yet? Have they done that spin-out?
Yeah, they did. They have a when issued trading. The actual the complete distribution will happen sometime in January when it will start trading. But we do, with the when issued trading, we do have some price discovery for that stock. So right now, if you kind of look at where Versant is trading, we get a forward EBITDA multiple of about 5.2 times, which is higher than what Paramount Skydance had suggested for the valuation of the Warner Brothers Discovery at 4.5x. So already there, we're kind of seeing some signs that the valuation of the global networks business should be slightly higher.
Do you see any other M&A taking place in media? I know we're all fixated on the bidding war for Warner Brothers Discovery, but at one point, Comcast was a potential bidder, and it dropped out fairly early. But are there any other deals kind of percolating in the background that you would keep your eye on?
I think there's just a lot of consolidation that's waiting to happen, Scarlett. I think people first want to wait and watch a little bit, see what happens with the Warner Brothers Discovery situation, kind of test out what's happening with the regulators. But yeah, there are absolutely a lot of smaller players, and Netflix becoming bigger or Paramount becoming bigger really kind of forces everybody to take a hard look at their portfolios and see what they should do next. As you rightly mentioned, NBC is the one name that definitely comes up to mind, Comcast NBC. They need something. Their Peacock platform is really subscale, so it's really going to depend on whether they want to do some kind of partnership or they actually need to go out and acquire some other smaller networks, maybe AMC networks, maybe some other kind of streaming business. So a lot of deals waiting to happen, but I think this is really the big one that everybody's focused on at the moment.
Geetha, thanks so much for joining us. Appreciate it as always. Geetha Ranganathan, she is the media analyst for Bloomberg Intelligence Research Platform. I'll tell you, if you're Paramount and you don't get this deal, then the pressure really builds on you. Then what do you do?
Right.
I think you need to
It needs to scale.
Yeah, you need to scale. So you need to call up the folks at Comcast and say, all right, you got this NBC Universal business, and we've got our business. Maybe we can
Neither of us really were looking at each other before, but maybe we should hook up.
Yeah, exactly right. So that might be kind of the next phone call if Paramount does not succeed here with Warner Brothers Discovery. And right now, the Warner Brothers Discovery Board is saying, no, we're comfortable with this Netflix deal, and we're ready to move forward.
Although Mario Gabelli has made clear that he thinks both Paramount, Skydance, and Netflix should raise their bids and move this into the next stage.
Absolutely, and he is a very influential shareholder, particularly in the media world. His word carries a lot of weight. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We have oil jumping, gold on the rise. U.S. blockades sanction tankers off of Venezuela and also prepares new measures against Russia if Moscow rejects a peace deal. Right now, we'll go to gold. We'll go to COMEX gold, up 0.8%, $4,370 an ounce. We go to oil, Brent crude, $59 a barrel. That's up more than 1.5%. The Bloomberg Dollar Spot Index strengthening by about 1/10%. As far as the markets, we have the NASDAQ down 0.2%. The S&P 500 little change, down about 5 points. The Dow up 0.3%, 175 points. In the yield space, we have the 2-year 3.49%. That's up 1 basis point. The yield on the 10-year 4.15%, and that is little changed. Let's go to shares of home builder Lennar. They're down nearly 4%. It forecasts orders, deliveries, margins all below expectations. That said, D.H. Horton, their shares are down about 2%. General Mills, sales in the latest quarter tops expectations. The company lowered prices on a lot of products, and its chief executive said more consumers, they're just buying food when it goes on sale because of economic pressures. Their shares up 2%. And kids retailer Children's Place taking a hit, down 37%. Posted third quarter sales fell about 13% from the year earlier period. After the close, more action from Micron Technology. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney were live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. S&P 500 year-to-date, plus 15. NASDAQ, plus 20. Fixed income across the board, kind of high single-digit time return. So 2025, any way you look at it, was pretty darn solid here. So now the question for a lot of folks is, okay, now what do we do for 2026? And our next guest, I'm sure, has some thoughts there. Victoria Fernandez, Chief Market Strategist for Crossmark Global Investments, sporting the holiday attire, which we appreciate. Holly Jolly there. Victoria, what's the conversation you're having with your clients as you think about 2026?
Yeah, so Paul, it is a Christmas sweater day here at Crossmark, so that's why we have our Holly Jolly going. But when we look at 2026, a lot of our clients are wondering if we should be making some allocation changes in their portfolios. We were somewhat conservative, and you and I have talked about that before, with our clients over this past year, because there were a lot of what we would call warning flags that were out there that caused us to be concerned. We wanted to take advantage of the market. We wanted to be in the market, but we also wanted to be a little bit conservative in our allocation. And I think that's going to continue into 2026, although we are having a rotation right now. And so you want to be looking at some of these areas, these poor performers for most of this year, kind of that decile 3 to 10 year to date, those are turning around and you're seeing positive trends. You're seeing it in transports. We've been seeing it in healthcare for a little bit. You actually started to see it a little bit last week in home builders, materials. There's different areas where I think you can look going into 2026. You want to be in that market, but do your homework and be choosy. You can't just say, I'm just going to go into any sector anymore and assume every stock is going to do well.
You talk about the rotation between different sectors. Tech is certainly a weak link today. What about rotation among size factor? The Russell 2000 currently up 0.8% today, while the S&P 500 is looking at a decline. And a lot of the concerns have always been tied to how the Fed moves, because these smaller cap companies are more indebted than the bigger cap names. Is this really just a play on rate cut outlook here?
Scarlett, I think that's a lot of it. Our portfolio manager, Andrew Cullivan, who handles our small and mid cap funds, he says, how go rates? That's how small caps are going to go. So you're right. There is a big tie there. And we like to see the breadth open up. We like to see small caps do well. Obviously, it's positive for the economy. What we need to watch for, though, is earnings for small caps. They have not been producing on the earnings side. And so you're not going to get these positive movements improvements in pricing really sustained unless they can support it with earnings. And obviously that's going to come from the consumer as well. So that's what we're watching: rates, consumer, and earnings. If those all start to move in a positive trend together, then that should be positive for small and mid caps in 2026. Plus the fact that you're going to get quite a bit of incentives coming for corporations from the One Big Beautiful Bill, those elements coming through on R&D, on CapEx, that should be beneficial also.
Victoria, you mentioned earnings, and boy, we've had some really good earnings so far in 2025. I mean, the last couple of quarters have been double digit here. Is the earnings outlook from your perspective, I guess, solid enough to support this market?
It's interesting, Paul, because we would have said we didn't expect earnings to be double-digit growth here in 2025, and yet they came through again. We really thought a weakening labor market, a weakening consumer was going to pull back earnings expectations, and it just didn't. And now we look into 2026, you've got 14% for earnings growth expectation, and even larger for small and mid-cap from some analysts, Bank of America, for example. So we have to look and see how are they going to support that. If tariffs stay where they are, roughly, then I think corporations have kind of priced that in. We've seen companies push through about 50% of their increase in cost to consumers. We could see that go up a little bit more in 2026 in order to protect that profit margin. And if they do, and consumers continue to spend, especially the high-income consumer, then I think you get support for earnings. But man, 14% seems like a lot to me. I would expect something maybe high single digits or right at 10%.
How are you thinking about the continued absorption of tariffs and passing along the cost to the ultimate customer, whether it's the consumer or another company? Because what we've seen so far is a lot of concern that inflation would really pick up, and that hasn't been the case, although it is above the 2% target that the Fed has identified. So when you think about how inflation will continue to be an issue, higher costs will continue to be an issue, which kinds of companies are best positioned in this environment?
Yeah, it's one of those issues where everyone thought, okay, tariffs will be this one-time jump in price. Companies will raise their prices, we'll get through that, and then we'll move on from there, and it won't be inflationary over time. I don't think that's right. I think, as we discussed just a moment ago, we're seeing it in bits and pieces. So we saw part of those prices get passed through to consumers this year. I think we're going to continue to see companies pass through more and more of that pricing, which means we continue to have upward pressure on inflation. Yes, things like housing may be coming down, wages are stagnating some, those would all help inflation come down, but I do think we'll continue to have this price component. So you have to look at companies that, one, either produce more here in the US so they're not as subject to those tariffs, or that have the pricing power in order to sustain it. So you're looking maybe at, larger companies that have that scale or that can maybe take a little bit of a hit. I mean, look at Walmart. They have the ability to do that. Being the low price leader, they can put pressure on the people that they're importing from in order to lower their prices to keep prices to their consumers lower. So I think you have to look at that scale. Who has pricing power, and where are their products coming from?
Victoria, thank you so much for joining us. Victoria Fernandez, Chief Market Strategist, Crossmark Global Investments. Enjoy the holiday spirit down there in Houston, Texas here. Let's switch gears to the airline business. Bankrupt Spirit Aviation Holdings, remember them, is in revived discussions to merge with Frontier Group Holdings in a deal that could rescue the deep discount airline from insolvency. Let's break this potential deal down with George Ferguson, Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence. George, does it make sense putting these two, I'm going to call them struggling regional airlines or discount airlines, does it make sense to put them together?
You know what, I think it might, actually. So this is, Back to the Future. Originally, sort of, I think, what we saw sort of set off a little fight for Spirit Airlines was the initial, merger or purchase from Frontier taking Spirit. JetBlue decided they didn't want to let those two coalesce, merge together and become a major competitor to them. So they stepped in the middle, tried to grab Spirit, and after that, everyone, Spirit, Frontier, JetBlue, just went through some pretty rough times as fares weakened in the market. I think the economy flyer kind of faded out a little bit on higher inflation and other problems. And so, I think where we're back to, though, is that Spirit and Frontier had very similar business, types, similar cultures. Mm-hmm. I think if you put the two airlines together now, you'd have an airline that has something like 350 seats. I think there's enough other markets they could go after. I mean, in comparison, Southwest, which is a domestic and sort of near to the U.S. kind of market airline. Mm-hmm. They have 700 airplanes. They find a place to put all those airplanes. So I think it could sort of charge growth up pretty quickly for Frontier, sort of help them lay in an extra 100 airplanes. Might not be a bad idea, and they might get a really nice price on it.
But do two weak airlines make a strong airline?
I mean, look, right now I think the economy portion of the business is reeling. It has too much capacity. Spirit is shedding some of those airplanes. Are going to go elsewhere. So we're talking about an airline that only has 100. And I think if you want to be competitive in the market, you have to be able to fly sort of coast to coast, offer your customers, a full complement of destinations. I think you need more heft for those loyalty programs that help drive some better results as you sell them credit cards and they buy their groceries and things like that on it. So I don't think it hurts for Frontier to try to get larger and to do it, to supercharge it through taking 100 airplanes out of Spirit. I don't think it's a bad idea.
Will the regulators allow this, George?
I don't think it's going to be a problem, right? I don't think it was originally a problem when JetBlue was looking at Spirit and when Frontier was looking at Spirit, but now Spirit's even smaller. We kind of put them together today, looking at available seat miles in one queue. A combined airline looked to us to be the 6th largest in the country. It was just ahead of JetBlue. If it adds, I don't know if it adds, some premium seating and knocks some seating out of some of those airplanes, it might not even beat JetBlue. I don't think this is a big issue for the U.S. market.
What would this mean for jobs? Jobs at Spirit, jobs at Frontier?
I mean, I think it could probably preserve some jobs because I don't think they're going to want to shrink the airline operations. But I do think if Spirit doesn't find someone to go with soon, they may cease to exist, and that obviously hurts jobs.
All right, George, thanks so much. We appreciate it. George Ferguson covers all the airlines and aerospace companies for Bloomberg Intelligence. Here's my Alaska Airlines story. For up until very recently, I thought the image of the person on the tail was Jerry Garcia. I'm not kidding. And so literally a few years ago,
It's an Eskimo, right?
I'm sitting in Seattle-Tacoma Airport, and an Alaska Airlines pilot sitting next to me, and I said, boy, it must be really cool working for an airline that's so cool as Alaska. You got Jerry Garcia on the tailpipe, and he's like, no, knucklehead. It's an Eskimo. I said, but it looks exactly like Jerry Garcia.
They should make they do have a branded credit card, but they should have Jerry Garcia as part of that branded credit card for someone like you.
So that was my bubble popped. And again, I was well into my adulthood when I learned of that. So anyway, yeah, I would think they'd allow this deal to go through. I mean, geez, you think about some of the markets those two airlines serve. If they go under, I don't know what happens to those
what
markets.
happens to the consumers in those places.
Yeah.
Are they going to come up with a loyalty plan that, actually gets people excited to fly Frontier/Spirit?
I've never flown either of them, I don't think. I'm captive to United here in the Newark market. So there you go. S&P 500 off 11 points. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got oil jumping. This is as the U.S. prepares new measures against Russia. We look at Brent crude up more than 1%, $59 a barrel. WTI crude, $56 a barrel. We move on to gold. COMEX gold up nearly 1%, $4,369 an ounce. The Bloomberg Dollar Spot Index is little changed. Over to the NASDAQ, leading the losses, down about 0.5%, 133 points. The S&P 500 down 0.3%, or 19 points. The Dow up 0.1%, 88 points. The two-year yield, 3.49%. That's little change, and the yield on the 10-year, 4.14%. Over to company news. We'll start with Tesla because their sales in California in jeopardy. The DMV says the company faces a 30-day suspension unless it changes its marketing that allegedly misleads consumers about its driver assistance technology. Tesla does have 90 days to appeal or comply. Its shares are down nearly 1%. And Waymo, that's Alphabet's autonomous driving unit, is said to be in talks to raise more than $15 billion. That's at a valuation near $100 billion. That's in a financing deal round that's led by its parent company. And after Ford said it's going to roll back those EV ambitions, well, the company now scrapping a $6.5 billion EV battery contract with South Korea's LG Energy. Ford shares down nearly 2%. And shares of Frontier, they're up nearly 4%. Sources saying the airline revived talks to merge with bankrupt Spirit Aviation. They say the deal could be announced as soon as this month. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much for that Bloomberg Business Flash. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu, and we're looking at cannabis stocks soaring right now. Aurora, higher. Canopy Growth, higher. The ETF that tracks cannabis stocks, MJ is the ticker, of course, also higher. And this is all on the ABC News report.
Of course, MJ.
MJ, because MJ. ETF.
Okay.
Ticker.
All right. Very good. Just checking if you guys know.
All the ETFs have great tickers.
Right,
that is their selling point.
They do.
Okay, so let's talk about what's driving all of this. According to ABC News, President Trump is expected to sign an executive order, maybe today, that would reclassify marijuana to a Schedule III drug. We need to get some more perspective on this. Let's bring in Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, typically in Washington, but joining us here in our Bloomberg Interactive Broker Studio in Midtown Manhattan. Is it as simple as that, Nathan, for the president to just sign an executive order to make marijuana not a big deal?
So this is a symbolic order, but it's a very powerful symbolic order. And for what it's worth, I checked the president's schedule this morning. There's no formal ceremony on the docket. So if this does come out, it's going to have to be one of those things where it's just released out to the public. So just something that we're keeping in mind. But what this order most likely will say is he's going to direct the Justice Department and specifically the DEA to restart this process of reschedulization. Now, they're about 60 to 70% of the way through. This started under the Biden administration, so they don't have to go back to the beginning. But the question that we have is that how quickly will the DEA and the Department of Justice want to move on this? They could forego a hearing. They could actually speed it up. I think the quickest they can get it done is probably mid-2026. The question, though, is President Trump really serious about this? Because we've heard this playbook before of where he goes out and makes a positive statement about marijuana equities. And these equities, I like to say that they have hot sauce because there's lots of volatility. MSOS is up 60-some% since last week. The question is, how serious is this? And I think what we're telling our clients is that when this executive order comes out, we will have to see how politically this plays out for President Trump in the midterms. Is this something that he wants to drive out voters? Because we've heard that in the past. Or is this something where he's just trying to incrementally move it closer to getting reschedulization?
I told you, Scarlett. Nathan Dean, based in Washington. We get him in New York. My radar went up. He's not coming up here unless somebody's buying him a dinner or a lunch.
Did you figure out who?
I figured it out. Team lunch today at a very nice Midtown steakhouse for the litigation and government.
Are you going to invite Paul?
He's always invited.
Exactly. I'm probably going on my credit card. Nathan, what are we looking for 2026? I mean, I think you've got to keep the government open in January, right? Isn't that an issue?
Yes.
Yeah, I'm at 30% chance of a shutdown in January. So, I mean, right now, 9 out of the 12 appropriation bills are only funded through January 31st. So if they come back in 2026, and they don't figure out a solution, then obviously we have a shutdown. Now, Republicans, I don't think, want a shutdown at the moment just because they've seen the playbook of what's happened in Virginia, New York City, New Jersey. Miami. And this is something where they are getting blamed, or at least they got the blame for the shutdown that occurred earlier this year. And I think Democrats are looking at the situation from the same lens, saying, look, we did well in Virginia, New Jersey, New York, and Miami. Let's not rock the boat here. But ultimately, shutdowns during midterms are bad politics. That's not really good news. But also, I would just say is the one thing from an investing point of view, keep your eye on, is that it's probably the last chance in 2026 to get something done by attaching, we call them Christmas tree bills, where you attach a bill as like you would attach an ornament to a tree. You attach a bill to the funding bill to try and get something passed. And one of the perfect examples, I think, is this bill called the Credit Card Competition Act, which raises competition for Visa, MasterCard. So you could see some headline risk related to the banks and Visa, MasterCard in January. It's just something we're keeping an eye on. I don't think it's going to happen, but just something to keep an eye on.
Okay, so that could happen. Is there going to be anything that happens on the Obamacare subsidies? Because the Democrats shut down the U.S. government over that, and they were supposed to get a vote in return in the Senate, but that didn't really go anywhere.
Well, you know, we had breaking news this morning. So the Republicans signed the Democratic discharge petition and got enough votes. So what a discharge
English, please.
Yeah, what a discharge petition is that it essentially allows the minority to force a vote in the House over the Speaker of the House's objections. Now, you need a majority vote. The Republicans, enough moderate Republicans, Representative Lawler from Long Island was one of the big leaders of this, signed on with the Democrats for a 3-year extension to Obamacare with no pay-fors or anything like that, just an extension. Now, Speaker Johnson's in a little bit of a pickle now because in January, they're most likely going to have this vote. And the question now goes to what is the Senate going to do? What is Senate Majority Leader John Thune going to do? Because if it does pass the House, it now becomes a Senate issue. But my colleague Dwayne Wright has been really looking at this, and his thesis, which I completely support, is that if President Trump wants these subsidies done, they're going to happen. And President Trump ultimately is going to have to be the one that makes the call on this because both, you know, I think the House Republican leadership wanted no extension whatsoever, no additional subsidies. But ultimately, it's going to come down to President Trump and his decision.
And we think he wants it because otherwise it'd look bad politically?
Well, it's going to be extremely bad politically when 22 million Americans have higher premiums. I mean, just to put it in perspective, we had a client, you know, just say, you know, that his wife's on Obamacare and their premiums are going from $1,000 to $4,000 a month because without those subsidies. And so, you know, this is going to impact a significant amount of Americans, including many of those in Republican-led districts. And so that's why these moderates are extremely pushing the issue here because at the end of the day, you know, the writing on the wall in terms of momentum at the moment for these midterms is going towards the Democrats. And if you think that there's going to be a Democratic takeover of the House, these moderates on the Republican side are going to have to try and fight tooth and nail to keep those extensions going.
The president is scheduled to give a speech later today. I'm presuming it's going to focus on the economy because it's been made clear that that's what voters are really concerned about. What are you hearing? What are you thinking?
So think of this as the first opening salvo of the 2026 midterms. This is a way for President Trump to say, here's all the accomplishments we've done in 2025. Let's start talking about affordability because that's the one issue that really has been resonating with both parties in terms of what voters care about in 2026. So I think tonight's speech isn't going to be really much of a forward-looking speech, even though he did say that he was going to, or at least the Bloomberg News is reporting that there's going to be some elements talking about what's going to come up in 2026. But I think it's just going to be more of a campaign-style speech because 2026, legislatively, we don't anticipate much happening. And it's going to be really much a gridlock year from the congressional perspective.
30 seconds left here. It is going to be an election year next year. Is the feeling like what usually happens is going to happen again, which is the party that's out of power gets back some power in the midterms?
Yeah, so, you know, the minority always usually does really well in the off-cycle elections. Okay. And, you know, with how we've seen in Virginia, New Jersey, Miami, you know, in the New York City, you know, there's a lot of Republicans. But I tell my clients, track the retirements and track the staffer retirements. When staffers start leaving the House and they start looking for lobbyist jobs, that's when you know that party feels like they're in trouble.
That's a good idea. I didn't think of that. And they just go round and round, government to lobbyist, government to lobbyist. And that's kind of,
that is lucrative revolving door.
That is the economy, yes, of Washington, D.C. I mean, there's like, that's it. You guys are a company town. Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence. up here for the holiday lunch at a very nice Midtown.
I heard it's at Bobby Dan's.
Yep, very nice. I'm a big fan there. So
you'll be showing up there at 12:15?
I might. I know these guys, and they're going to ask me for my credit card, as they typically do. So we'll see how that goes. We got more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube as well. Well, home builder Lennar reported some earnings today. A little bit disappointing here. The stock down 5% today, down 18% year to date. This is a big company. It's got a market cap of like $28 billion. But I'm looking at some of the home builders. A lot of them are down double digits on a year-to-date basis here. Let's break it down with Drew Redding, home building analyst for Bloomberg Intelligence. Drew, talk to us about Lennar. What did they say to the street here with their latest earnings?
Yeah, this was a tough print for Lennar this quarter. They came into the quarter with a pretty low bar. Investor expectations had been coming down, but they still disappointed on both orders and margins. And even more concerning was the guidance they issued for the first quarter, which was short on orders, closings, and margins. So we think that consensus needs to come down pretty sharply here. What this tells us is that even though rates have fallen to kind of that low 6% range, I think we're about 6.3 now, it doesn't appear that they're significantly catalyzing demand. Which was what a lot of people had been expecting. So I think that points out that, there's other things going on. It's, we've said in the past, it's not just rates, but it's prices and overall affordability. But something we've heard pretty consistently from the builders is that consumer confidence is really holding the market back. There's concerns over the direction of the economy and concerns about the labor market. And if you don't have a job, you're certainly not buying a house. So we expect in this environment the use of sales incentives to remain elevated, and that's going to continue to pressure margins.
Yeah, I mean, they get volume, but they don't get the profitability. So home builders are facing a lot of challenges. They also face competition from the resale market. Talk a little bit about the numbers involved here in terms of new construction versus existing homes.
Yeah, that's a great point. The lack of for sale inventory in the resale market was a huge benefit to the builders over the last couple of years. There weren't a lot of options, so it funneled buyers into the new home market where, builders have been able to make monthly payments more attractive for their use of buy downs. That dynamic has shifted over the last year where we're starting to see pretty significant increases in for sale listings in the resale market, particularly in the most important markets for the builders. Think Florida, Texas, California. So all of a sudden, there's this new competition for them. And in order to get a sale, they're having to fight harder for each one, which means higher incentives, more pressure on pricing.
Drew, I'm looking at the existing home sales in the United States. They've been running at about a 4 million home rate for the last few years. But historically, that's been a lot higher, hasn't it? So there's just not a lot of supply of existing homes out there in the marketplace. And is that an interest rate story?
Yeah, it's partly an interest rate story. The one thing that we've consistently pointed out is that if you look at the composition of outstanding mortgages, you have a majority of current mortgage holders who have something well below the prevailing mortgage rate, which is around 6% now. A lot of people during the pandemic were able to lock in rates in the 4s and even the high 3s, some perhaps in the 2s. So the existing home market has really been frozen. If you look at total volumes, you mentioned we've been hovering around this 4 million annualized rate for about 3 years now. That's about 20% below what a normalized market would look like. I think rates coming in will certainly help as we look out to next year. We do think that you're going to see perhaps mid to high single-digit growth in the existing home market, but keep in mind we're coming off historically low levels. So some improvement, but I think context is certainly key there.
Lennar is certainly not the only builder facing these challenges. How is the company specifically saying or explaining to investors how it's adapting to this new normal of persistent affordability concerns due to softening consumer confidence and a weakening job market, all these macro headwinds that it has no control over?
Yeah, Lennar has been a pretty interesting example. Remember, they're the second largest builder by volume in the country, and they run a production-first business, which means their goal is to push volumes. And over the last couple of years, they've been willing to sacrifice margin to get volume. So, they'll tell you they're bringing a more affordable product to the market, but what we've seen is a dramatic drop in their gross margins. In just 3 years, they've gone from a gross margin in the high 20% to something in the high teens percent in 2025. So a very sharp fall. And what they told us last quarter is that, they can only push so hard on this market. The demand just simply isn't there. So in order to get more sales, the incentives have to keep ratcheting up. So what they told us is that they're making some sort of a pivot into where they're looking to sustain their gross margin. So what we want to hear from them on the call is, where do we think that gross margin floor ultimately lands? And is the pullback in production that we've started to see, has it normalized?
Yep. All right. I don't know. I keep hearing about a housing shortage in this country. I don't know how we got to that point, but Drew Redding will figure it out. Drew Redding.
Blame it on the financial crisis.
Yes, we're still using that one. Drew Redding, he's a home builder analyst for Bloomberg Intelligence from Princeton, New Jersey. Earlier today, we had Stephen Kim, the home building analyst from Evercore ISI, saying a lot of the same things about the housing market here. The housing affordability, particularly for young people.
Yeah.
It's such a bummer.
So out of reach.
Yeah, it's such a bummer.
Are we just going to become a nation of renters?
I don't know. I mean, everywhere you look, I see people putting up these, condos, things in apartments and all over the place. So I don't know. We'll see how that plays out.
Actually, you hear a lot more about petitions from people, existing residents who don't want those to go up.
Yep, and they just pop up seemingly everywhere. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in just a moment with the S&P down 45, the Dow down 78, and the NASDAQ down 250 points. That's 1.1%. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Coming up, we're going to check in with Miami Mike McGlone. He's a commodity strategist for Bloomberg Intelligence. We're talking about all things on the commodities front here. Jonathan Palmer is going to join us, senior equity research analyst at Bloomberg Intelligence, on the Medline IPO. I'm just going to guess it hasn't begun trading, but this is the biggest IPO of the year. Medical products maker Jonathan Palmer's out with a research report. He's been out there for a couple of weeks with that, so we'll get the breakdown on what is the biggest IPO of the year in the U.S. Julie Beal, chief market strategist and portfolio manager, Kane Anderson Rudnick, is going to join us to talk to us about her market outlook. So a lot coming up in the next hour. Let's kick it off right now with Charlie Pellet in a Bloomberg Business Flash.
Thank you very much, Paul Sweeney. Absolutely right. Medline yet to begin trading, but the Dow, the S&P, NASDAQ, all in the red right now. Not just lower, worst level of the session right now on the S&P 500 index, looking at a loss of 48 points, a drop right now of 0.7%. A slide in big techs weighing on stocks. NASDAQ down 1.1%. NASDAQ 100 index down 1.3%. Dow Industrials down 97, a decline there of 0.2%. Traders gearing up for the CPI report. That's driving bonds away from session lows after Fed Governor Christopher Waller signaled support for rate cuts. 10-year right now at 4.14%, with a 2-year that's currently yielding 3.49%. Gold up $28 the ounce, 43.31, up 0.7%. The surge in silver continues with a $65 handle now. Silver up 3.1%. West Texas Intermediate crude 56.16 a barrel, up 1.6%. And Bitcoin now down 0.3%, 87,483 on Bitcoin. Warner Brothers Discovery, the parent of HBO and CNN, is advising its shareholders to reject a hostile takeover bid by Paramount Skydance in favor of its original agreement with streaming giant Netflix, deeming the Paramount offer, quote, inferior and inadequate. Warner Brothers Discovery shares down now by 1.1%. Netflix shares, they're up 1.5%. And the Paramount Skydance shares, they are trading lower by 4.4%. Keep it locked into Bloomberg for the latest on any and all developments involving Warner Brothers Discovery, Paramount Skydance, and Netflix. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thank you so much, Charlie Pellet. Bloomberg Intelligence, second hour here with Paul Sweeney and Scarlett Fu in our Bloomberg Interactive Brokers studio. We are streaming live on YouTube, and it is time to take a look at some stocks on the move. And for that, we bring in Bloomberg Television correspondent Nora Melinda. Nora, what do you have?
Well, let's take a look at the housing market. This is something we've been talking about a lot lately. We're looking at shares of Lennar, that's ticker LEN, falling more than 5%. This, of course, is after the company forecasts quarterly home orders, also margins and deliveries that miss expectations for the first quarter. We're really seeing a lot of challenges being weighed right now, especially given the job insecurity that we're seeing in the market. Rates still remain high, and while we did see them pulling back just a bit, we are still seeing a lot of competition from the resale market and other competitors here. So we're looking at shares of Lennar really really declining right now and bringing a lot of its peers down lower. About 14% of sales incentives account for the average selling price of each home that we did see for the quarter for Lennar. So we are also seeing a lot of incentives really weighing on gross margins here for this company.
All right, how about Frontier Group?
Frontier, of course, this is ticker ULCC. This one's been in focus, and it's funny because I feel like we haven't talked about this story in a while between Frontier and Spirit Airlines. But of course, we do know that Spirit actually trades over the counter. That's ticker FLYYQ. But we did see that the bankrupt company Spirit is in revived discussions to merge with Frontier. This is, of course, according to people familiar with the matter. This is a deal that could potentially rescue the airline from insolvency. So we are hearing from analysts on Wall Street saying that this could be positive in terms of coming up with some sort of challenger to larger network peers, but it still is more of a survival move rather than more of a strategic move.
And last one?
Lastly, I'm looking at shares of Oracle, that's ticker ORCL. This is one of the biggest laggards in the S&P 500. Shares are down just as much as about 5.9% right now. And this is after we did get a report from the Financial Times that reported that the Blue Owl Capital will not back a $10 billion deal for the software giant's next data center. Also, an Oracle spokesperson said that Blue Owl is out of the data center deal, but it still remains on schedule.
All right, there you go. Norma Linda, thank you so much. Norma Linda, markets correspondent for Bloomberg Television, giving us some of her valuable time here. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, and anywhere you listen. Well, when WTI crude oil was $80 a barrel, our next guest said it's more likely to go to 40 than it is to go to 100, and he's looking pretty right here. That would be Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence here. Mike, you know, at WTI at 56 here, we're getting right around the cost of production for our good friends down in the oil patch. What's going on?
That's the key point, Paul. It's nice to get one right once in a while, but typically you have to get below the cost of production for an enduring period. And that's where, if you just look at the last 20 years of crude oil trading, the lows have been around 40 or lower, starting in 2008. I made that call a couple of years ago. Yeah, I was wrong for a while, but it's the key thing to remember is the elasticity of price. Prices are going down now because they went up too much to the 2022 peak. It's that autocorrelations that's kicking in. The key question is what stops it. My main fear is what might accelerate is maybe a little detente in the Russia-Ukraine war, but a key thing that will accelerate this downward trend is just a little uptick in stock market volatility, and it looks like that might start just be happening towards the end of the year.
Okay, so interesting that you are looking at the correlation with equity volatility rather than headlines out of Russia, for instance, or Central America. We're looking at Brent right now, almost approaching $60 a barrel, WTI now above $55 a barrel. Talk a little bit about the geopolitical risks and the kind of havoc that they do wreak on oil prices.
Oftentimes, Scarlett, when you get these spikes potentially because of supply disruptions in the Middle East, prices spike, people sell forward, bring on more supply. See the trend there, rinse and repeat. Now, we've had those for a while. The high this year is around 80, and we had issues in the Middle East, and it heads lower. So that's the key thing. That geopolitical, it doesn't matter so much when the U.S. is a net exporter. That's what's changed over our entire lifetime. Yes. So we're net an increasing exporter, and the supply out of Canada and Argentina and Brazil and the U.S. and Guyana is all picking up. And so demand out of China is stagnant or declining. You see the trend there? So typically you got to get that trough to a low price cure. But I have to open the stock market because typically they roll together. And when crude oil is going down at this velocity with stock market going up, I'm really worried about a deflationary domino when we just get a little bit of maybe, let's say the 200-day moving average, get the S&P 500 back to that level, which is about a 10% correction. That's one of those things I think can get crude oil towards 40, but I don't know what's going to keep it above 70. Stuff I can't predict.
Interesting. All right, so that's the that's oil. How about gold here? It seems like after a little bit of a pause back down to 4,000, it's bounced right back.
That's a key thing about this year that emboldens me about these views, Pauls. We've never had an annual year with gold up this much, almost 70%, and crude oil down this much. That is a warning. I think it's telling us something's going on in the global economy that's potentially heading towards a normal deflationary period. But the thing that scares me about gold is I've started to use the word frightening because it's just the velocity of the rally in gold versus, say, 60-month moving average has never happened at this high velocity with stock market volatility to this low. So I think gold's telling us stock market volatility is going to pick up as we head towards next year, which means potentially pressure on everything except potentially treasury bonds.
What about silver? I'm just looking at today's gains, and I know we shouldn't look at these movements in isolation, but silver up more than 4% right now. We know that it was kind of, there was a bit of FOMO going on with silver during the rally in gold because people were like, you know, gold has rallied so much. Let's take a look at the other precious metal.
I'm glad you went there, Scarlett. It's known as the devil's metal for a reason. This year's low, well, here's why. This year's low is 28. The last time we had a stronger year than this year, it's up almost 130%, was 1979. It was up 400%. That year's low was 32. So this year's low is actually lower. That's the key thing to remember about silver. It just have to be very careful, be more tactical. But buying, holding silver from these levels is history does not show that it does very well. So it might, maybe it gets up to 70 or 80, but then if history isn't a guide, it might, these peaks we can put in might last for decades.
Mike, I've been seeing on social media feeds for weeks now, the intercoastal waterway flooded with boats coming from the north heading down to Miami. Do you notice that in your neck of the woods?
Yeah, it's a normal winter season. And it doesn't really bother me too much because the key thing is that so much so shows in traffic, but I love riding my bike in those bike lanes. I get right through the traffic.
See, there you go. And he's got like an EV. He's one of those guys.
To be based in Miami.
So what you do is a pandemic comes along and you just move. And then you tell us that you've moved. And we're like, and if you're so good like Mike Malone is, we just say,
So
all right,
that's
whatever.
the strategy.
Yeah, whatever. You just do what you need to do. Just keep
so
writing.
fair warning, I'll be in Florida in the next couple years.
Exactly. Mike McGlone, one of the best out there. We appreciate getting a few minutes of his time. He's a senior commodity strategist for Bloomberg Intelligence. We'll talk about pork bellies the next time. The biggest IPO of the year, priced last night, Medline. It's not really sexy. It's like a medical device company, but it's like a $6+ billion IPO. It's just extraordinary. It got some blue chip private equity folks behind it. I have no idea what this company does, but I know who does, and that's Jonathan Palmer. He's an analyst at Bloomberg Intelligence. He covers all the healthcare device companies and things like that. And the good thing about Bloomberg Intelligence, we're not an underwriter. We're not a broker-dealer. We can write on private companies. We can write research on private companies. We can write research on IPO companies, and that's exactly what Jonathan did. So he's out there with a definitive view on this company for investors. Jonathan, what does Medline do here, and why are they coming public?
Thanks, Paul, for having me. So Medline is what's traditionally thought of as a distributor, but I'd argue it's more than that. So really, this company's been around for decades. It started by the Mills family in the 60s. In 2021, they sold to private equity, and now they're coming back to the public markets. What they traditionally did was provide distribution and logistics to hospitals. But over the years, they actually started making their own products. So things like masks, drapes, sutures, all the stuff that kind of you need in a surgery or to take care of patients. It's not too sexy, but has a much better margin than logistics. So half the company today is their own Medline brand products. Half of it is distribution services. The secret sauce here is that they basically they don't give it away, but they can essentially give away the distribution and logistics piece while capturing all the margin on the product side.
How much market share do they have? I mean, I've gone to hospitals before and seen the Medline name attached to, I don't know, like a bed, for instance, or, the canister on the wall where you get your gloves.
Yeah, that's a good question. I mean, I think it would depend on the product category. I mean, from the distribution side, they're just a little bit bigger than their peers like Cardinal Health and what was Owens and Minor. It's kind of a oligopoly where those big three players are distributing to all the healthcare facilities. In terms of products, it's about half of revenue, so roughly 12, 15 billion right here.
What about tariffs? How affected by tariffs are they? Because I can't imagine that these items, gloves, masks, swabs, syringes, are made in the U.S.
Well, they do have a fair amount of manufacturing in the United States. They have talked about tariffs, a couple $100 million impact this year and next year. I mean, to be honest with you, for a company this size and this scale, that's a pretty surmountable hurdle. It'll get priced in the next round of contract negotiations, and it'll be, business as usual going forward.
As a former banker, I just look at the deal dynamics here. Upsized offering. Offering finished north of 10 times oversubscribed. Top 10 investors in this allocation took more than 50% of the shares. Top 25 investors took about 80% of the deal here. Are the private equity guys, are they selling here, or is this just company shares?
It's a combination of both. Okay. And then the Mills family still owns about 20% of the company, and they're not selling any shares.
Good. So what are use of proceeds here, do you think?
I'm sorry, what?
What are the use of proceeds here? What are they going to use the money for?
Primarily to pay down debt. They had about $16 billion of debt, that they levered up on the private equity transaction, and they're paying down a pretty healthy slug of that right here.
The stock hasn't even opened yet.
I know.
Mean, Jesus.
Well,
when I was doing this,
MDLN is the ticker to watch for.
When I was doing this 10:30, if I didn't have it open by 10:30,
It's usually not till the noon hour now.
I know. My boss would come over and smack me with his tennis racket. That's happened many times.
You're not allowed to do that anymore either.
We're opening up this kid. Let's go. Let's go.
You had mentioned that some of its traditional competitors, like Cardinal Health, for instance, is that still a competitor in that does Cardinal Health also make its own products and sell it under its own name?
They do, but not at the same scale as Medline. And that's, like I mentioned before, really been their secret sauce and how they've outcompeted their peers. The other thing that's interesting is Cardinal. Cardinal is much more of a drug distributor with this medical division. I don't think they want to be in that business long term. Owens & Minor actually just sold their business for a couple $100 million to private equity. So Medline's the clear #1 gold standard player in this space.
15 to 17 times forward EBITDA? Are you kidding me? This isn't a technology company. It's a healthcare company.
Well, to put it into context, though, product companies, the Medtronics, the Becton Dickinsons, the Abbott Labs, they're all trading 20 times. So really, it's getting a discount relative to product companies, and it's kind of priced in line with the healthcare distribution companies like the Cardinal Health, the McKesson, so forth.
I'm looking at the cornerstone investors. There's at least 8 of them. They lined up more than $2.3 billion in commitments. What does that tell you about the investor base of Medline?
Well, to me, it says that this is a very stable business. I mean, they've talked about growing the top line high single digits and adjusted EBITDA by the same or better. I mean, I think this is a story that's going to unfold over multiple years where, they're going to come out of the gate, they're going to hit their numbers, they'll pay down debt so their leverage goes down, post this private equity era. And then we'll probably see some more shareholder-friendly capital deployment, whether it's buybacks. This would seem like a good business to have a dividend ultimately.
Does the healthcare industry broadly define, do they like this administration, or are they concerned that maybe some regulatory risk might be out there?
I think it depends on who you ask.
Okay.
I mean, I think nobody likes uncertainty in the business world, right? And there's been a lot of uncertainty around healthcare in particular. I mean, these companies in the service industry have been maybe a little less in the spotlight than, let's say, the drug and pharmaceutical industry. But, at the end of the day, people get sick, they need to go to the hospital, they need operations, they need to see doctors. It's business as usual.
All right, there you go. I mean, Jonathan Palmer, he's all over it. He's got the research out there, so you have an interest in this big company, Medline, that's priced last night. We're waiting for it to trade here today. BIGO, then I'll get you to the Bloomberg Intelligence research portal and go find the research report for Medline. It's out there. You can kind of see where it's valued versus its comps. I had no idea these companies had such rich valuations, what I consider to be rich valuations.
Well, we have a very frothy stock market on top of that,
great
right?
Point. Yep.
And this was already slated to be the biggest U.S. IPO, but now that the IPO has been upsized, it's become the biggest IPO this year in the world, and in fact, also the biggest private equity-backed IPO as well.
Yeah. And boy, the private equity, this is good news for the private equity world because they've had a hard time monetizing their assets.
Yeah, they want to see more things like this.
Yeah, exactly. They've been selling them to other private equity companies to get some liquidity.
That's not how the business model works.
No, not in the long term, but we'll see how it goes. They've been levering these things up, paying themselves dividends, trying to generate some type of return for the limited partners because you can't, or it's harder to raise new money when you haven't kind of generated returns on your old money. And that's kind of how that game works. So we'll keep an eye on that one. S&P down 50 points. The Dow down 78 points. The NASDAQ down 270 points. That's 1.2%. 10-year Treasury yields holding steady right around 4.15%. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide, goldencrestmetals.com/guide. We're looking at a slide in some big tech stocks with the Dow, the S&P, NASDAQ all in the red right now. S&P is down 0.6%, lower by 42 points at 62.57. Dow Industrials right now at 48,090, down 22, a drop there of under 0.1%. NASDAQ down 256, down 1.1%. The NASDAQ 100 index down 1.2%. Our Mag 7 index trading lower as well, down right now by 1.3%. 10-year 4.15% with a 2-year that's currently yielding 3.49%. Spot gold up $21 the ounce, 43.23 up 0.5. Silver up 3%, 65.69 the ounce. West Texas Intermediate crude 56.23 up now by about 1.7%. And Bitcoin down 1.4%, 86,550 on Bitcoin. Oracle says final negotiations on an equity deal for a data center project in Michigan are on schedule and does not include Blue Owl Capital, a firm that has helped finance massive data center projects for firms including Oracle and Meta Platforms in recent months. Oracle shares down now by 5.1%. Coming up after the close of trading, we will be hearing from Micron Technology ahead of earnings. That stock right now down by just about 2.1%. Medline's IPO is said to end more than 10 times oversubscribed. We'll keep you up to date on the Medline IPO once trading gets underway. Shares indicated to open at $32.50 each. The IPO price, $29. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. There's a Bloomberg Business Flash.
Hi, Charlie Pellet. Thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. 2025, pretty much in the books. Now it's time to take a look to 2026. Where do we go from here? Stocks, bonds, commodities, all that stuff. Julie Beal's going to join us. She is the Chief Market Strategist, Portfolio Manager at Kane Anderson Rudnick. She's out there in Santa Monica, I think somewhere like, I don't know, Century City, something like that. You're one of my favorite golf courses. Wherever it is, it's warm. One of my favorite golf courses, LA Country Club. They love me there. Julie, thanks so much for joining us here. If we have a clean slate here for 2026 after what's been a really good 2025, where do we start here?
Well, I mean, I start with that we really have pretty good fundamentals in place. You know, we have a great sugar high that's coming to the U.S. consumer in the form of refund checks at the beginning of the year. And then I think we kind of see how things play out. It looks like the setup for corporate earnings looks pretty sanguine. And if you look at how earnings estimates have trended, they've actually been more positive than you typically would see seasonally at this time of the year. I'm hopeful and optimistic that we finally get a stronger small cap resurgence that's focused more on quality. But for the most part, I think the setup looks pretty good.
And perhaps we're seeing a little bit of that today in that the Russell 2000 is down only 1/3%, whereas the NASDAQ, by contrast, is off by more than 1%. However, you also note, Julie, that there's just not enough stuff to buy. And I think you're talking about more than just the Mag 7 in equities. It kind of goes across asset classes.
Yeah, I really think that where we're at right now is we just have so much liquidity, so much demand that's chasing after very few assets. And I think that that's really going to be the thing of support that just, you know, the sheer blunt force of having this much demand and this much liquidity with still people with cash on the sidelines. It really does create an environment where asset prices can remain quite high and elevated. The trick is just there are so few good companies out there to buy. And that's not just true on the equity side, but it's really true, I think, in terms of private equity. You have so much money chasing after only a fixed number of assets. So I think until we see a real supply boom in terms of IPOs and companies that can kind of come to market, it probably portends that we have higher asset prices overall.
What's an allocation for you as you go into 2026 here? Stocks, bonds, commodities, alternatives. How are you guys thinking about it broadly?
You know, I think the most important thing is just to be able to recognize that we cannot predict the future, right? If I had told you all of the headlines month by month for 2025, do you really think you could have guessed that gold would be where it is, Bitcoin would be where it is? No, right? It doesn't necessarily tie in the way that you would think so. I think that the most important thing is that you really didn't get paid to have any kind of diversification. You didn't pay to have international stocks for a few years. And I think what we're seeing right now is, given the spread in performance and finally a little bit of breadth in this market, you do want to be diversified because it's pretty unpredictable. And I would say it's even more unpredictable when you have a huge technology transition like what we're undergoing right now.
What do you think of the fact that investors are now starting to pick between winners and losers in the whole AI trade? Oracle, rightly or wrongly, is seen as kind of a problematic player in the AI space. You know, its CDSs have blown out, its bonds have not been doing as well, and its equity price action certainly reflects that. Is that justified, or investors are just looking for kind of an example?
I think it's great. I mean, I think that I'm always anxious when we're using narrative to drive the stocks rather than the economics and the fundamentals. And to me, the fundamentals for Oracle are challenging for multiple reasons. You have, you know, customer concentration for sure, and you have underlying economics that I think are not great. You have assets that you're taking on that are perhaps depreciating at a faster rate than we had seen historically, when we weren't running these chips as hard as we're running these AI chips today. So I think, to me, it's a great sign that people are actually starting to think less pie in the sky, you know, AI is going to take over all of our jobs. And we're thinking much more about, okay, like, what are the underlying cash flows of these businesses and what are the underlying risks of those cash flows? So to me, I think it's a great thing that people are starting to think more deeply about this rather than just saying, hey, all CapEx is good CapEx and more CapEx is good CapEx.
All right, Julie, thanks so much for joining us. Really appreciate it. Julie Beal, Chief Market Strategist and Portfolio Manager at Kanye Anderson Rudden. Let's get to our big take story of the day. You know how much we love these big take stories. Are really interesting topics, compelling topics, deeply researched, well reported, lots of cool graphics in them for me, which I like. You know, a good buddy of mine, who's a double cancer survivor, said they're never going to come up with a cure for cancer. The business, it's just too big business.
They'd rather go after something niche-y?
No, they'd just rather keep raising money, spending money on cancer research. It's just a big machine.
I see.
So that's a cynical view, but that's from a double cancer survivor. So
that's kind of sad.
It's an interesting take. It's kind of part of the big take here. Cancer doctors are making a fortune off of drug trial participants. Robert Langrath joins us here, senior medical reporter for Bloomberg News, joining us here in the studio. Tell us about your story, Robert. What did you come to learn about these cancer doctors and big trials and all that kind of stuff?
Yeah, so this year, as part of a series of stories called Cancer Capitalism, we've been taking a look at sort of like the cancer industry, so to speak, and the fact that, you know, many cancer drugs are approved and sold at ever higher prices, and they've never been proven to extend patient survival. We even show like more than half of all recently approved cancer drugs have never been shown to improve patient survival, even if its prices go up to $25,000 a month or more. And so as part of that series, you know, and reporting for that series, I kept hearing about how, you know, drug companies were designing clever ways to design their clinical trials to help make their drugs look better, essentially limiting therapies in the control group that would make their new drugs look better. It was called straw man control groups, is what one of the critics called. And that led us, me, to collaborate with Caleb Melby on looking at the whole clinical trials industry for cancer in the U.S. And, you know, a couple decades ago, you know, most cancer clinical trials, most spending on trials was from the National Cancer Institute. But that stayed roughly flat, and the amount of trials that's been sponsored by the drug industry, it just surged. So now most trials are done by the drug industry, and the pay for these trials is, you know, much more. The going rate is much more than you'd get typically for someone in just clinical practice, and sometimes it can be, you know, the pay can be $250,000 per patient or more for a trial between all the different tests and the overhead and everything. So it's very kind of, you know, lucrative arrangement now, and, you know, sometimes critics say that is producing dubious science.
Right. Okay, so the cancer doctors get paid. according to your reporting.
clinics
What
get
about
paid, yeah.
what about the drug trial participants themselves? What do they get out of it?
You know, they get a chance at a a new agent, a new drug, that's not on the market right now. They may end up in the control group. And one of the things we found is that people in the control group, there may be limitations on what you can get. Some trials should limit what you can get in the control group. But some of the patients that my colleague Kayla Melby talked to, weren't aware that the clinics that are being treated, are compensated very significantly for, enrolling and doing the trial. They weren't aware of that. Now there is disclosure of, like doctor consultancies from the drug industry and stuff like that, but sort of like disclosure in clinical trials is somewhat of a kind of a gray area, and there's like less disclosure, like less agreement of like what should be disclosed about how much your clinic is getting paid for enrolling you in that trial and performing that trial.
Well, I have to ask, where is the Food and Drug Administration? Isn't that the regulatory agent here?
Yeah, the Food and Drug Administration does regulate trials, but it's like more interested in like, here's a proper trial like needed for approval and what we need to see. It's less focused on the day-to-day practice of like patients being enrolled in these trials and what do they know about the trials, and like what is proper disclosure, over like compensation over the trials. Like I think some of the overhead rates that doctors can get in clinics can get is like 30 or 35%, and there is more paperwork. That's not all profit or anything, but there is more paperwork. But still, the going rate now, has become very high, and it's become essentially a big industry.
It's become a big industry. Is there anyone pushing back against it publicly in a way that action might be taken?
Yeah, there's definitely a group of critics that are, criticizing. They're mostly a small number of doctors, I would say, that are pushing back on how some of these trials are designed. And interestingly, one of these people that's been, one of the staunchest critics of the whole kind of cancer trial system has been Vinay Prasad, who's now head of Chief Scientific and Medical Officer at the FDA. And prior, he was a hematologist oncologist at the UCSF prior to going to the FDA. And he was heavily critical of the system, like, of trials. And basically, he said on the record on podcast, you're going to go back, we look back, 10 or 100 years from now, and some of these trials are going to look so unethical. So he's been heavily critical in the system. Now he's at the FDA. He's not in charge of cancer per se, so it's not totally clear what he might do there. But interesting enough, there are other doctors that essentially agree with his criticisms of the cancer trial industry.
All right, Robert, thank you so much. Great reporting here. Robert Langrath, senior medical reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. And the big take story today entitled, Cancer Doctors Are Making a Fortune Off of Drug Trial Participants. You can read more of this story on the Bloomberg Terminal and at Bloomberg.com/big take. We always love highlighting the big take stories because they are really compelling reporting there. So again, it's just a monstrous business, just the whole cancer business and all.
Yeah, but it's preying on people who
Exactly.
have run out of chances and are looking for anything at this point.
Yeah, and that's kind of one of the risks, I guess. S&P 500 down 50 points, the Dow off 100 points, and the NASDAQ off about 290 points. That's 1.25%. This is Bloomberg Good Morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long. Here are Bloomberg losses for the Dow, the S&P, NASDAQ. Despite a bounce in treasuries, equities under pressure as NVIDIA and Alphabet lead losses in mega caps. Right now, we got NASDAQ down 286, drop there of 1.2%. The Dow is down 112, down 0.2%. S&P 500 index at 6746 on the S&P. It is down 53 points now, down 0.8%. Dow Industrials, by the way, at 48,003. 10-year yield 4.15%, with a 2-year currently yielding 3.49%. Spot gold up $25 the ounce, up 0.6%. Silver up 3.3%, 65.83 right now on silver. And Bitcoin today trading lower by 1.6%, 86,373 on Bitcoin. So tech stocks are selling off. Julie Beal is portfolio manager at Kane, Anderson, and Rudnick. And right here on Bloomberg Intelligence, she told us she welcomes the scrutiny over AI CapEx spending.
To me, it's a great sign that people are actually starting to think less pie in the sky, AI is going to take over all of our jobs. And we're thinking much more about, what are the underlying cash flows of these businesses and what are the underlying risks of those cash flows? So to me, I think it's a great thing that people are starting to think more deeply about this rather than just saying, hey, all CapEx is good CapEx and more CapEx is good CapEx.
Julie Beal of Kane, Anderson, and Rudnick, interviewed right here on Bloomberg Intelligence. Keeping an eye on home builder Lennar shares after earnings, down now by 5.7%. Among other home builders, D.R. Horton down now by 2.5%. Pulte lower by 1.3%. Toll Brothers, that's the luxury home builder, up by 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. That's the internet. Head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. I don't know, it feels like when I look at NASDAQ and I think about the tech story, the AI story, which has been such the theme, such the driver over the last several years, maybe if nothing else, it's taken a little bit of a pause, maybe.
It's fading a little bit?
It just feels that way a little bit. I don't know. Dan Ives joins us, Global Head of Technology Research, Wedbush Securities, joins us live here in our Interactive Broker Studio. We appreciate that. Dan, is that the type of feedback you're hearing from your clients when you're out there talking to them?
Yeah, look, I think you're going through a white knuckle period. I think it goes back to worries about circular financing, OpenAI too big to fail. If Oracle sneezes, the stock's down 2%. So it's sort of analysis of how the build out looks out. Look, in my view, and we've talked about it so many times in the show, this is going to be an 8-10 year build out of the AI revolution. In that period, you're going to go through these moments. Then it's sort of prove it, what the use cases look like, what the spending looks like. And I think that's ultimately what this is. But in my opinion, this is the tech bull market has 2 more years left, and it's not the time to panic. These sell-offs create the opportunities. That continues to be our thesis.
So when investors start to take a closer look at an Oracle and really question whether it belongs up there, at least its share price movements belong up there with the Alphabets of the world and the Microsofts of the world, are they justified in identifying a weak link like Oracle? Does it ring true to you?
I think they're justified in terms of why you'd separate out Oracle versus the others, because just given they've never really built out everything from a data center perspective. They're not a hyperscaler like a Microsoft, Google, or Amazon. But my view is you have 475 to 500 billion in deal flow, 300 billion of that being OpenAI, the next 5 years, 6 years. You're going to take on some debt. You are going to build that out given the opportunities. And I think that's going to be a thesis, right? And that's going to be a theme as we've seen with Meta spending on CapEx. Investors don't like to see it. They want to see free cash flow EPS going up next year. But the reality is Zuck, in wartime CEO mode, focus on how do you monetize the 3 billion users over the coming years. And I think that is what we're going to see play out across, over in 2026.
How does OpenAI fund itself and all the money it's spending?
Yeah, I think, look, if you look at it today and you're like, how are they going to fund that much, 10, 15x of what they generate today? See, Paul, my view is you're going to look at a company over the next 5 to 10 years that the revenue and the monetization opportunity is probably 4 or 5x what they've already committed to. So if you take a longer term view over the next 8, 10 years, what they can do, I think it's ultimately, given the centerpiece that they're going to play in AI, the monetization is going to be there and more. So I don't view it as like are they making big bets? Yeah, and it looks like they could be making another bet with Amazon. But for them, they're more than just an LLM model. They're trying to build out the stack. They're trying to be in Microsoft, be in Amazon. And I think if you look, that ultimately is their vision, and the deal flow ultimately, I think that supports it.
Will they get there?
I think they're going to get there, and probably they're going to get there more accelerated than investors even are anticipating. It speaks to my view, like when you think about like IPOs, let's say SpaceX going IPO next year. If I told you 2 years ago SpaceX is going to go IPO, you'd be like, well, no, like, I'm just giving all the data. You go back, like me and you've talked about, if you go back earlier this year, New York City cab drivers bearish on Google, AI destroying their business model, DOJ is going to break them up. That right now they're just going to a gut check moment. But when you look at the AI revolution, for the first time in 30 years, U.S. is ahead of China when it comes to tech. This is the time, it's go mode, fifth gear, not the time to be right lane going 45 miles an hour. And I think that continues to be sort of the issue right now in terms of what we see with tech. And investors clearly are a little sort of wheezy relative to what we see play out.
It seemed like Elon's got his mojo back. Tesla back to an all-time high. Again, SpaceX valuation, the valuation numbers out there are just extraordinary.
Never mind what's happening with Tesla vehicles.
Exactly. So what is, that goes right to your point, what is the Tesla story these days?
But
That's what you've been talking about.
But to your point, it's like, okay, because it's like ultimately deliveries and vehicles that fund the business. And then anyone that's in the stock today, it's all about autonomous and robotic, because the view is like, look, when it comes to physical AI, the two best physical AI plays in the market, it's NVIDIA and then it's Tesla. Now, is this a gut check moment for them? Of course, they got to show 30 cities, you got to need robotaxis 2026. You need to have actually volume production when it comes to what we see with cyber cabs. But in my opinion, this will be a historical year for Tesla. Like, I think at the end of the year, Tesla base case $600, bull case $800.
Okay, you are notoriously bullish on all things AI. What worries you, Dan? What makes you pause? What makes you think maybe we won't get there?
Look, the biggest thing that worries me, it's not articles that talk about, Oracle, they're going to be able to build out data centers. It's not circular financing. My biggest worry, it's energy. Because the reality is, like, China is way ahead where the U.S. is when it comes to energy, nuclear build out. Right now, 3% of companies have gone down the AI path in the U.S. When you get to 20%, it's not enough energy. So, and I think nuclear is going to continue to really be the answer. But that's the biggest thing that stops us, is purely the energy.
All right, let's get to this important stuff. Matt Campbell, new Penn State football coach. Do we like him?
I think we got a dog right there in terms of Campbell. I think he's exactly what we need in terms of toughness, recruiting, understanding NIL, who he brought in. And obviously, look, a tough year for all of our Penn Staters, but I think Campbell's exactly the piece of the puzzle we needed that I think brings us back to glory days, over the coming years, and eventually a natty, probably, 2027, 2028.
All right, very good. Like the enthusiasm there. Dan Ives is a big Penn State football supporter, so we appreciate that. Dan Ives, he's in his day job, he's global head of technology research for Wedbush Securities, joining us live here in our Bloomberg Interactive Broker Studio, getting an update on the world of technology. Again, it seems to be maybe a little bit of a gut check here for some of the investors in the AI theme. But again, I think long term, the bulls remain very much intact. Looking at the S&P right here, we're down 50 points. That's about 0.8%. The Dow's off 90 points, about 0.2%. And again, NASDAQ once again taking it on the chin, down about 295 points. It's about 1.25%. 10-year Treasury yields 4.15%. WTI crude oil, $56 a barrel, hanging in. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube as well, so check us out there. Let's get a preview of a sector that is not technology, although there's a lot of technology getting into the sector. Talking about the U.S. machinery producer industry, broadly defined. Think construction equipment, farming equipment, all that big stuff, John Deere, all that good stuff. Big American companies making big stuff. We can do that with Chris Ciolino. He's a senior U.S. machinery analyst for Bloomberg Intelligence. Chris, I know your business that you cover, the machinery business, the ag business, cyclical businesses. Where are we here, and what's the outlook for next coming year or so?
Yeah, so we believe that the U.S. machinery earnings are likely approaching a inflection point in 2026, really after a multi-year downturn. Despite lingering tariff headwinds, the prospect of lower interest rates, policy and regulatory clarity, normalizing inventories, and better pricing have really provided a favorable setup for most machinery producers heading into 26. I would say the outlooks do vary a little bit by end market. We're most constructive on the outlook for construction equipment next year, particularly as non-residential construction markets approach a trough. You also have favorable secular trends around power generation, infrastructure and mega projects, as well as some of these reshoring investments. So we have really good visibility in terms of 26 and really even beyond. On the flip side of that, we're a little more cautious on the ag equipment outlook. And then I throw, commercial vehicles somewhere in between there.
Equipment companies, I think about Caterpillar, for example, and that stock's up 54% year to date. So has the market already discounted the cyclical upturn, or is there more to go?
Yeah, I think there's a lot of runway here. There's been a lot of optimism around their power gen and exposure to the data center market. But I think we're still very early innings in this story playing out. They're going to double their large engine capacity here through the end of the decade. Gas turbines are going to be up 2.5 times. You're just beginning to see some of these products come to the marketplace. And really, there's just insatiable demand for power generation. And I would say Caterpillar and Cummins are somewhat uniquely positioned within the machinery space to kind of capitalize on these longer-term secular stories.
Yeah, that is a long-term secular story, power generation. So do they disclose backlog information or anything like that to get a sense of kind of how big this business could be for them?
Yeah, so Caterpillar's backlog for the enterprise is at a record level, and it just continues to, set new records with each passing quarter.
Wow.
In terms of their actual power generation business, no, they keep that pretty close to the vest. But it does extend multiple years, and the fact that they're making, essentially more than doubling their large engine capacity through the end of the decade, just I think lends support to. They have very good visibility for several years out. And same thing, I would allude to that as Cummins as well. They have very good backlog visibility in terms of their power generation business. And then you throw on, the cyclical recovery that we should see in these businesses. It's a pretty favorable setup, not only for 26, but beyond.
All right, you mentioned the other part of the business, or a different part of the business, that one that focuses on the agricultural sector of the economy. We know the farmers in a really tough spot these days, and when they face financial difficulties, they're not buying Deere tractors and things like that. So what's the outlook there over 26?
Yeah, right now we anticipate that the large ag market here in North America will be down another 10 to 15% in 2026. So this is going to mark the third year of a downturn. And really, to put things into perspective, assuming we're down another, double digits in 26, volumes are going to be at the lowest level in more than 4 decades, or as long as we've been tracking the industry. So I do think there's pretty high degree of confidence that this will mark the trough of the cycle. And we actually think that downside risk is probably limited here and relative to a lot of the other sectors that we cover. The problem is, farm fundamentals still remain quite weak. Crop prices are still low. While the government still continues to, hand out additional aid payments, farmers historically don't use this to go out and spend on new machinery. But we think really the bigger overhang here is still the lingering export market uncertainty. You know, we did have a U.S.-China trade agreement. I think farmers are really just going to take a wait-and-see approach. And until we get tangible progress on, you know, China executing on some of these purchase orders and commitments, I think farmers are just going to be hesitant to go out and spend on equipment. When we do see that come to fruition, hopefully then you'll start to see a rebound in crop prices, and then maybe we could become a little bit more constructive on the equipment outlook there.
So just to put a bow on that, Chris, we got about 30 seconds left. What is the export market for the U.S. farmer generally on average, and what is it today?
Yeah, so we export the vast majority, particularly our row crops. Soybeans, China is still the largest buyer of our beans. We do send a lot of corn to Mexico and Japan as well. But those big row crops, corn, soy, wheat, that's what really drives farmer profitability. It's more than half of U.S. crop cash receipts. And we need to start to see some kind of a rebound there before I think we become a little bit more positive on the outlook.
All right, very good. Good stuff as always. Chris Ciolino, Senior U.S. Machinery Analyst for Bloomberg Intelligence, located down in there in our Princeton, New Jersey, HQ for Bloomberg Intelligence. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment, with the market continuing to sell off towards the bottom of the intraday trading ranges. S&P down 51 points, 0.8%. The NASDAQ down 280 points. That's 1.2%. More Bloomberg Radio coming up right now.
This is CBS News on the Hour, sponsored by Steel.
I'm Vicki Barker. The state of California hasn't executed anyone in close to 20 years, but that may change if Nick Reiner is tried and convicted over the stabbing deaths of his father, Rob Reiner, and mother, Michelle. Here's CBS's Adam Yamaguchi.
The DA is clearly going after maximum charges here. The death penalty is a possibility. They haven't ruled it out yet, but it is on the table. One conviction on the first-degree murder charge carries a maximum sentence of life in prison with the possibility of parole after 25 years. But this being a special circumstance, 2 murders, that elevates the maximum charges to the death penalty.
Police in Providence, Rhode Island have released new video footage of the man they're seeking in connection with the Brown University attack. CBS's Samantha Cheney is there.
The video is still blurry, and you can't really see any identifying features, but this is the best look we've gotten so far of the person of interest, who police say neighborhood cameras caught walking near Brown University's campus Saturday from about 2 o'clock in the afternoon until just after 4 p.m. when that shooting happened inside of the school, killing 2 students and injuring 9 others.
On Capitol Hill, 4 rebel GOP lawmakers have signed on to a Democrat measure that would renew Obamacare subsidies for another 3 years. Here's CBS's Caitlin Huey-Burns.
What you essentially have is a group of moderate Republicans revolting against the Speaker of the House for not allowing them originally an amendment to extend these Obamacare tax subsidies that are set to expire in just a few weeks from now.
TrumpAccounts.gov. That's where parents can learn more about those Trump investment accounts for kids. Here's Treasury Secretary Scott Bessent.
Starting on July 4th, our nation's 250th anniversary, parents, family members, employers, and friends will be able to contribute up to $5,000 to each Trump account each year.
Warner Brothers turns hostile to a hostile takeover attempt. CBS's Jim Krasula has that.
Warner Brothers is telling shareholders to reject a takeover bid from Paramount Skydance, saying that a bid from Netflix will be better for them. Paramount Skydance, the owner of CBS News, says it's sticking with its hostile bid offering of $30 a share. Netflix is offering $27.75 a share.
Amid the uproar over the eye-watering prices being charged for next year's Soccer World Cup, this pronouncement from New York City's mayor-elect Zoran Mamdani.
I am going to appoint a World Cup star.
The Democratic socialist and ardent soccer fan says he will use his platform to shame FIFA into lowering prices. This is CBS News. penny for your thoughts.
Every time it rains, pennies from heaven.
The very last pennies pressed at U.S. mints have sold for a pretty penny. The Treasury Department has auctioned off 232 sets of 3 coins for a total of $16.76 million. The final set, containing the last 3 pennies ever made after they were discontinued in November, went for the most $800,000. Each is marked with the Greek letter omega, signaling the capstone to a 2-century-long legacy. Deborah Rodriguez, CBS News.
And finally, Richard Davis and Faye Stevenson Davis won't be counting their pennies for a while. The British couple just won their second £1 million lottery jackpot, worth about $1.3 million in 7 years. The odds of picking the correct 5 numbers and bonus ball twice, approximately 24 trillion to 1. I'm Vicki Barker, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
It's a Republican jailbreak. Welcome to the Wednesday edition. As moderate members of the GOP conference in the House break from Speaker Mike Johnson to sign onto a petition that will force a vote on extending Obamacare subsidies. This story is evolving in real time, as we'll discuss ahead with Bloomberg's Megan Scully, with analysis this hour from our political panel. President Trump set to address the nation tonight in prime time and says Venezuela is now completely surrounded by American ships. We'll get the latest from Becca Wasser on our geoeconomics team, and Cliff Young from Ipsos will join us this hour with fresh polling on affordability. We hope the president's listening, and it's all after a look at Wall Street. To that end, we turn to Charlie Pellet, his view on the markets on the Wednesday trade, live from New York. Hey, Charlie.
Oh, hello there, Joe Matthew, and you got us right at the lows of the session right now. The Dow, the S&P, NASDAQ all declining. S&P 500 index in the red. NASDAQ 100 index right now down 1.5%. S&P down 0.8%. S&P at 67.43, looking at a drop of 55 points. The Dow down 110, a drop there of 0.2%. And again, NASDAQ down 1.3%. The NASDAQ 100 index down just about 1.4%. The 10-year at 4.15%. The 2-year 3.49%. Spot gold up $31 the ounce, 43.32, up by about 0.7%. Silver now higher by 4%, 66.30 for an ounce of silver. West Texas Intermediate crude up 1.6%, 56.17 on WTI, and Bitcoin down 1.3%, 86,644 on Bitcoin. Warner Brothers Discovery, the parent of HBO and CNN, is advising its shareholders to reject a hostile takeover bid by Paramount Skydance in favor of its original agreement with streaming giant Netflix, deeming the Paramount offer inferior and inadequate. Right now, we have got shares of Warner Brothers Discovery down 1.4%. Netflix shares are advancing. They're up 1.3%. Paramount Skydance lower by 4.9%. Again, recapping, stocks lower. NASDAQ 100 index down 1.4% as AI winners lead the tech rout. Balance of Power continues right now, and back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, thanks for starting us off. We'll have more on the markets with Charlie Pellet in just about 15 minutes' time here on Balance of Power. Welcome to the Wednesday edition. A lot has changed since we last spoke. So good to see you here on Bloomberg Radio. If you like to watch the radio on TV, we're streaming live on YouTube right now. If you're cool enough to have YouTube TV, find us on Bloomberg Originals. Unless you're on satellite radio channel 121. We've got a lot to talk about when it comes to healthcare. Things are actually happening on Capitol Hill. Remember, we told you we've already gone over the cliff. That's what they told us. This thing was said and done. The bill came and went. Democratic proposal, DOA. Until now. Like the hand coming out of the water at the end of a horror film, the Obamacare subsidies reemerge with the help of 4 Republicans. They've all walked across the aisle to sign the discharge petition that we talked about yesterday with Catherine Clark, the Democratic whip in the House of Representatives. Let's go back to where we were last evening when we checked with Clark on the number, remembering you have to get to 218. Here she is.
We are at 214, which means we only need 4 Republicans And there are far more than 4 who are saying we should extend these tax credits. So we are saying to them, now is the time to do it. We have 3 days left of session before we recess for the holidays, and just days before this tax credit expires. This is a healthcare crisis the GOP has caused. We have the vehicle for them to fix it today.
Ah, well, we have 4, and we'll say their names. Representatives Brian Fitzpatrick, Republican, Pennsylvania. Robert Bresnahan, Republican, Pennsylvania. Ryan McKenzie, Republican, Pennsylvania. And a guy you know from this broadcast, Mike Lawler, Republican from New York. Frontliners, as we call them. As Lawler suggested that the idea to not bring this to the floor yesterday was BS and said the word out loud talking to reporters. We better get with Megan Scully. She runs our Capital Influence team here in Washington, and they've been running today. Megan, it's great to see you.
Thanks for having me.
These 4 decided to cross over because they would be punished for doing otherwise?
Punished by voters, yes.
In the midterms.
Absolutely. This is becoming, sort of the crux of the affordability argument that Democrats are waging in the months leading up to the midterms, which are less than a year away now. And with people set to see their Obamacare premiums double or even triple in some cases starting January 1st and having to make those decisions right now, it is a very tangible bill that a lot of voters, more than 20 million voters, are seeing before too long.
So this would extend subsidies by 3 years, right?
3 years.
This is the Jeffries. This is the full reach by Democrats, not 1 or 2 years. Say this, in fact, passes the House, and I guess we've got the votes. That's pretty much already said and done. When would this hit the floor? And does the Senate have any reason to pick this up? What would happen in the other chamber?
So the timing is a little tricky. A discharge petition, which this is, essentially an end run around leadership, has 7 legislative days, sort of a waiting period. So that kicks us into January with both the House and Senate expected to leave by the end of this week. Right. It would then need to pass the House. There could be some maneuvers where Johnson, does some backdoor efforts to kill it, certainly. So it's not a guarantee yet to pass the House, but it certainly looks likely. But then it needs to go to the Senate, where a test vote on this very thing failed just last week.
It did. So maybe this would spawn some sort of gang of 8 come January, and senators and members of Congress or members of the House are talking together on a whole new bill. Is that the logic?
So Susan Collins, a Republican in the Senate, who's been at the center of these negotiations, actually just told our reporters just now that this is a good thing for her efforts for there to be some kind of a negotiation on this. They're talking about things like salary limits or time limits, essentially ways to curb the expense without eliminating it altogether.
She was on the Moreno bill, if I remember correctly.
Absolutely, yep.
There's so many of these floating around to keep track of. The fact of the matter is, though, Megan Scully, we're going over the cliff, right? It's just a question of whether we fall into Chuck Schumer and John Thune's arms by the end of January to see if rates could then somehow come back down later in the year?
Yeah, so open enrollment lasts until January 15th. So that does provide a little bit of a buffer zone. The concern, though, is that this ship has already sailed, that for a lot of people, they've already gotten their letters in the mail. These subsidies expire in less than 2 weeks. They're not following this necessarily every turn of the screw of what's happening on the Hill. So for many Americans, they've already decided whether they're going to forego insurance or whether they're going to roll the dice and keep it into next year.
Wow, really wild moment here. Megan, thank you so much. Megan Scully runs Bloomberg's Capital Influence team here in Washington, and the perfect voice to get things rolling. This is happening right now, and we'll have more on this later on in the broadcast. The other major story that we're following has to do with what's taken place in the Caribbean. Now a full-blown blockade, says President Trump. James and I figured this would be the lead this morning when we were getting ready talking about the program, and that's before the jailbreak happened in the House. So here we go, Truth Social, last evening. We're learning, by the way, how to read these really long posts. Your eyes just go right down, just about 2/3 to the all caps. Today, I am ordering a total and complete blockade of all sanctioned oil tankers going into and out of Venezuela. The illegal aliens and criminals the Maduro regime has sent to the U.S. during the weakened, and that Biden administration now being returned to Venezuela at a rapid pace. He talks about the massive amount of hardware that we have discussed on this program floating in the Caribbean right now. And Becca Wasser is covering all of this for us. Bloomberg Economics Defense Geoeconomics Team Leader. We went to the top, Becca. It's great to see you. Thank you for joining us here. Did we not already have a blockade? Is this just a matter of semantics?
Well, there is something to be said about the semantics. I think right now what we see is not a complete and total blockade, despite what Donald Trump says. What it is technically, in military doctrine, a quarantine. And the real important distinction here is that a quarantine is not an act of war the way a blockade is. And then we also essentially have had a soft quarantine for some time. For the most part, we don't see a lot of aircraft going over Venezuelan airspace. We've already seen that ships are starting to avoid the area, so we've had a soft quarantine essentially already in place.
What's the difference between a blockade and a quarantine? The fact that we're targeting a specific type of vessel in this case?
Absolutely. The fact that it is about sanctioned oil tankers as opposed to a broader array of any ships that are coming in and out of Venezuelan ports.
So it's interesting, Becca, because the president's been talking about land strikes, talking about regime change. We kind of oscillate from day to day, but clearly he's been briefed on potential targets inside Venezuela. Would this be a prelude to such an action, or is this completely unrelated, therefore not an act of war?
It could be a prelude, or it could just be an additional way of exerting pressure on Nicolas Maduro. So I think here what we do have is the fact that there is no requirement for congressional approval for a quarantine. There would be a requirement for congressional approval if President Trump were to enact land strikes. So this is a great way of exerting pressure and trying to move more toward that stated end goal of trying to force Maduro from power without having to involve Congress, and hoping that eventually not only will this political pressure, this military pressure, but also this economic pressure now placed on Venezuela because of the restrictions on oil will achieve that goal.
I know you're consumed with framing global impact around events like this, and your team does incredible work. But I'm just curious, when you consider the amount of resources that we're spending just to keep this crouched position in place. We've been down there for a couple of months now. We've got the biggest aircraft carrier in the world. There's a naval armada, whatever you want to call it. We're burning a lot of gas in the Caribbean. Do we have any sense what this operation is costing?
Well, we don't have a full sense of what it's costing, but the fact that there are 11 warships just operating in the region, just in the Caribbean, frankly, alone, let alone some of the changes to basing around the region, some of the aircraft that we've also seen deployed, it's going to be really sizable. And so there's going to be a monetary cost for all of that, but there's also going to be a broader military cost, and that is military readiness, or the ability to have the military strength when you might need it to deal with other crises that could emerge around the globe. So right now, it's not only financial cost, but it's cost to future preparation and the ability of America's military to be strong and deter adversaries.
That's a great point. Remembering we took the Jerry Ford out of the Mediterranean for this, right? And it's showing no signs of leaving anytime soon. Becca, thank you so much. Great job at Bloomberg Economics. This is the smartest team, and we're lucky to sit next to them here at the Bureau. We try to listen in on their phone calls. Who's calling Becca right now? Becca Wasser with us on Balance of Power. We're going to turn to the latest polling because the president speaks to the nation tonight in prime time about, yes, affordability. And Cliff Young at Ipsos has the latest on this. It doesn't look great for the administration right now. We'll have details straight ahead, only on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. At the Dow, the S&P, NASDAQ 100 index, all declining as AI winners lead a tech rout right now. The NASDAQ 100 index is down 1.3%. NASDAQ is down 1.1%, keeping it all in context. S&P down 0.7, the S&P down 48 at 67.52. Dow Industrials down 85 on the Dow, a decline of 0.2%. The 10-year yield, 4.15%, with the 2-year currently yielding 3.49%. Gold is up $34 the ounce, up 0.8%, $43.36. Silver up 4.3% right now, $66.49 on silver. West Texas Intermediate crude, $56.20 a barrel, up 1.7%. And Bitcoin now down 0.8%, just above $87,000. Oracle says final negotiations on an equity deal for a data center project in Michigan are, quote, on schedule, and does not include Blue Owl Capital, a firm that has helped finance massive data center projects for firms including Oracle and Meta Platforms in recent months. We'll have a whole lot more on the Oracle story coming up at 12:30 Wall Street time, 8 minutes from now, with our Christine Aquino. And BlackRock says it will match government contributions to Trump accounts for its employees, making it one of the first major American companies to lay out plans for supporting the Early Childhood Savings Program. BlackRock shares, they're up 0.6%. Recapping, S&P down 0.7%, tech stocks selling off. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, we thank you. We'll be back to Charlie Pellet and the latest on the Wednesday trade in about 20 minutes here on Balance of Power. Thanks for spending part of your Wednesday with us. You staying up late tonight? You watching this live? I read this morning this is the big Survivor finale tonight. They still have Survivor, and the president's going to interrupt it. We're wondering if he has something to say. We're also remembering how difficult it used to be for former presidents to get on in prime time. Maybe the honeymoon is still on. Barack Obama, Joe Biden, not always so much to get roadblock coverage. It's not just Bloomberg, by the way, and yeah, I'll be up late with you. Fox, yes, Fox, NBC, CBS, ABC, Fox News, CNN, yeah, Bloomberg, TV and radio, all taking this thing live in prime time. Starts at 9 o'clock. God, that's late for me, but, you know, I'm old. I do prefer the hours of 12 to 5 that we try to keep on a regular basis, but in all seriousness, this is a big question about why now and what's he going to talk about? Could it be affordability? Look no further than the latest polling from Ipsos with our friend Cliff Young standing by to join us. The headline, he sends us these great decks. The headline, Economic Concerns Resurge. There he is, Cliff Young from Ipsos. Welcome back to Bloomberg. It's great to see you, sir.
Yeah, it's great to be here.
I'm going to scroll down here and I see consumer confidence remains muted. And more importantly, the economy reemerges as the main issue facing America today. I don't know when it ever faded. I know it was confused a lot with immigration and other big issues on the campaign trail, but we could argue the economy is what brought Donald Trump back into the White House. Is it what will bring Democrats into power on Capitol Hill?
Well, it was a critical issue that Donald Trump surfed in 2024. He won the 2024 elections, as you said, Joe, based on the economy, more specifically inflation. And for the first little bit, the first, let's say, semester of 2025, the issue wasn't the economy. It became political threats to democracy, political extremism. They kind of outstretched the other issues. A lot of it had to do with the friction that the Trump administration was causing, especially when it came to tariffs and DOGE, for instance. But in the last little bit, over the last month, our polling has shown that threats to democracy has dropped by the wayside, and it's the economy front and center. And more specifically, based on a lot of the polling that we're doing, what keeps reemerging? Affordability, affordability, affordability.
Yeah, it's amazing. As the president refers to that as a Democratic hoax, it's hard to argue with what you're seeing here. His approval rating saw a little bit of a bump in December. It's still underwater, though?
Yeah, I wouldn't say it's underwater. So where is he right now? He's about 43% or so. What does that mean historically?
Does that not count as underwater anymore? Or is that
well, I don't call it underwater. Others may call it. I see it as, marginal. If you dip below 40, then you're in a really bad place. A sitting president at 40% approval rating has about a 50% chance of winning the next election. That's just a proxy for your ability to push forward your agenda. At 43, you're not in a great place, but you're not in a terrible place. An incumbent wants to be in the mid-40s. But what we can say is he only improved a point or so, but tariffs are rearing their ugly heads. Americans are beginning to feel that on the margins, and I would expect in Q1 of next year the tariff issue to really have an impact.
So 40 is the new 50. Just kidding. The president's approval when it comes to cost of living. There's a headline in here asking whether he's losing the MAGA base. What do Republicans think about the economy?
They think it's not doing so well either. I mean, there are across the board Americans of all stripes, all colors, all places really feel the economy has taken a hit, more specifically affordability. When you look, kind of peel the onion away, who is he losing? On the one hand, he's losing those that lean Republican. They're not staunch MAGA people, but they lean Republican. They voted for him in 2024. He brought them into coalition. They do not feel like their lives have improved. And in addition to that is less affluent Americans, minorities, younger Americans, all of them are feeling the pinch.
The jobs report we saw yesterday, the highest unemployment rate in 4 years. Black unemployment specifically above 8%. Are we starting to connect the dots on what this speech might be about tonight?
Well, he definitely has a problem, and the Republicans more specifically have this problem, have this affordability problem. Americans not only are worried about that, they're in a surly mood, they don't feel like the administration has taken action on it. Now, the question is, will the speech be about the issue of affordability directly? Will it be perhaps trying to focus the American population on another issue like Venezuela? We have to wait and see. But without a doubt, the administration has hit choppy waters.
What are you learning about Venezuela? What do people think about what's going on down there?
It's just sort of middling. Overall, Americans don't like foreign intervention.
Especially MAGA.
Yeah, especially MAGA. They voted for him to take American troops out of harm's way. They don't want a muscular foreign policy. They don't like Gaza. They don't like Ukraine. And they really don't like Venezuela. Wow. Now, I wouldn't say they are rejecting it, but it's a very lukewarm, vanilla feel for it. Nothing that an administration would want when and if they go into harm's way.
Boy, it speaks to the whole national security, America First issue when it comes to this president. Does a speech like tonight move the needle on an approval rating, or do not enough people watch this in real time anymore? I mean, I just went through this alphabet soup of networks. Most people, let's be honest, are going to watch this on chopped up on Twitter tomorrow morning, right?
Yeah, it's all going to be on X. They're going to be looking at it there. But these sorts of speeches typically never had an impact.
Is that right?
With public opinion in general, where they have an impact is among elites. So it's signaling to donor class, signaling to sort of political elites that you're taking the action they expect, that you're aligning in certain ways. Typically, a speech like this does that. We'll have to wait and see.
You're running numbers on the ballroom. You see the ballroom's going to get more expensive? I'm being half serious here. But this idea of private funding, crony capitalism, whatever your headline's going to be here, $400 million in private funding raises a lot of questions. Do people care about this, or is this inside the Beltway talk?
No, it goes to the notion that the system's broken. Supermajority of Americans believe the system is broken. The details are less important. The fact that the administration's focused on something that no one would say was important, and it's front and center, it's very symbolic, is not good. Is it a death knell? No, but it doesn't help.
When you go to the big White House Christmas party this year, check on the East Wing for us and let us know what's going on.
Yeah, I will. It'll be quite cold there.
I believe that's true. It's just wide open now. Cliff, thank you. Cliff Young, Ipsos, with us live in Washington. Okay, that sets the baseline. Remember this conversation at 9 o'clock tonight, 9:01:30, when the president starts speaking. I'm still curious about the venue. Is this an Oval Address? It's not his preferred venue. Maybe we've got the podium set up in the Cross Hall. I don't know. We'll get an office pool going on that in time for the late edition of Balance of Power. I'm Joe Matthew in Washington. Thanks for being with us here as we turn to Wall Street. Of course, well, the markets are going to be watching this too, but more specifically, we've got a lot of concerns about the AI unwind. As Charlie Pellet tells us every 20 minutes that these things keep reaching lower. We've also got our eyes on crypto, though. Yeah, that's down too, risk off. You've got a VIX at 17. The only thing moving higher, ironically, is oil, which has been in the tank lately. Good opportunity to check in with Christine. Our managing editor for Bloomberg Markets Live blog, Christine Aquino, in the Fishbowl, live in New York. Christine, what's going on here? Are we going to set a floor? I thought we were supposed to have a Santa Claus rally.
I know, Joe. There's a lot of things that are really getting in the way of that Santa rally. And today specifically, once again, AI worries coming back to the fore, primarily because of news tied once again to Oracle. So I think the latest is, again, concerns around its ability to deliver on these data centers. Now that we've heard about Blue Owl pulling out from one of the deals that they have, the Oracle trying to reassure investors that they're going to be able to deliver this. Remember also that the last, I guess, bout of air worries that we got was also tied to news about Oracle potentially having to delay some of its delivery of these data centers due to shortages regarding manpower and things like that. But overall, this is really just adding up to, okay, is the AI trade still going strong or not? And, that's just putting a bit of a damper on the Santa rally that we were supposed to have.
Yeah. Well, it's like the old saying, when America sneezes, the world catches a cold, and Oracle's sneezing. The question is whether it should be looked at in the same way as all the other companies in this space, right, Christine? I mean, the balance sheet at Oracle is a big question right now. The company's taken on an enormous amount of debt in trying to facilitate the build out of all these data centers. But we've got another important name coming after the bell, and I'm wondering what you're looking at when it comes to Micron Technology, because its memory products are used in all these same data center build-outs, but it's also not laying out billions and billions of dollars the way Oracle is.
Absolutely, Joe. And you're exactly right? It really is all about the balance sheet questions. And Oracle seems particularly vulnerable to that. I think the good news is that, people are starting to recognize, okay, there's a bit of a differentiation here based on balance sheets, based on free cash flow abilities that a lot of the hyperscalers, like a lot of the big companies involved in this, isn't necessarily a problem for them. And I think now we're starting to see that divergence in the AI trade, the winners and the losers, right? As far as Micron is concerned, I mean, big focus, of course, is whether they're going to be, what their CapEx looks like for the year, whether they offer guidance that is good enough for investors. But these days, good enough means you have to clear that bar, right? That's already high in terms of expectations. You have to clear that with a wide margin for investors to consider it good enough. So we'll see if Micron is able to do that tonight.
Well, that's a great point. Is there any truth to this broadening out narrative here? We hear this so often, Christine. I'm sure you start rolling your eyes after a while, but, the RSP is actually pretty close to all-time highs here. And maybe we focus a little bit too much on these AI stocks because other parts of the market are feeling the love, right?
Yeah, absolutely, Joe. I mean, we have seen more signs of a broader stock rally, right? A lot of kind of more traditional names, consumer discretionary names even. That owes a lot of it to the fact that we have seen, even though it's been a mixed bag of data this week, since we finally got data, it is still pointing to a resilient consumer, right? And so I think that's benefiting a lot of these kind of more traditional stocks.
I was supposed to ask you about Medline. We got a big IPO today. It's the biggest one of the year. Christine, I know you're going to be watching it, and we will too. MDLN, when Medline starts trading, well, we'll call Christine because she's the one you need to talk to at times like these. We thank you, as always, Christine Aquino. Bloomberg Markets Live blog. We'll assemble our panel next, only here on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Still awaiting the start of trading in the Medline IPO. We'll keep you updated as we learn anything. We have got the Dow, the S&P, NASDAQ all in the red right now. S&P down 52, 67.47 where we stand. That is a drop right now of just about 0.8%. Dow Industrials down 100, a decline of 0.2%. NASDAQ is down 1.1%. The NASDAQ 100 index down 1.3%. NASDAQ moving lower as AI winners lead a tech rout. Our Mag 7 index is down 1.2%. The 10-year 4.15% with the 2-year that's yielding 3.49%. Gold up $37 the ounce to $43.40, up 0.9%. West Texas Intermediate crude up 1.5% now, $56.12 the barrel. And Bitcoin lower by 1.4%. Bitcoin at 86,561. Federal Reserve Governor Christopher Waller is backing further interest rate cuts to get the central bank setting back to neutral, while saying policymakers need not rush to do so.
The labor market is very soft. The jobs numbers are around 50 to 60,000 the last couple months on average. We know that that's too high, and those are more likely to get revised down.
Governor Waller made that comment in a CNBC forum. He is under consideration to be the next Fed chair and is expected to meet for an interview today with President Trump. Micron Technology reports earnings after the close of trading today. We are seeing Micron shares decline now by 3.2%. Last week, you'll recall, we saw dual disappointments from Oracle and Broadcom. Disappointments that sent both stocks tumbling 11% in a single session. Oracle down now by 4.8%, Broadcom down 5.3%. Again, we will be hearing from Micron after the close of trading. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Balance of Power continues right now. Once again, your host here is Joe Matthew.
Okay, Charlie, thank you, sir. We'll be looking forward to Micron Technology after the bell, and Romaine Bostic will be talking to us about that in the late edition of Balance of Power. Here we go again, another data center name with earnings. They better knock the cover off the ball. Charlie will have more on the markets coming up at the top of the hour, 1 p.m. Eastern Time, as we welcome our global television audience to the conversation. They won't believe what's going on Capitol Hill. We can't either. How many people have told us this was over? That we already went over the cliff is what Troy Downing told us in our conversation here just a couple of days ago. But by God, I guess there's been another jailbreak. First, it was Democrats in the Senate, remember? Just enough to get the government to reopen. They crossed the leader, and now we have a Republican jailbreak in the House. Moderates in frontline districts. Folks like Mike Lawler, the Republican from New York, other Republicans from Pennsylvania on here, Fitzpatrick, and so on, who could be punished in the midterm election cycle for not extending Obamacare subsidies. Fitzpatrick, Bresnahan, McKenzie, meet Mr. Lawler. There's your 4 if you're with us on YouTube. And so that forces a vote here. This is a done deal in the House. The question is what happens after that, because we are going over the cliff. And the Senate has no plans, at least now, to take this up. In fact, a very similar plan has already failed in the Senate. This would extend Obamacare subsidies by 3 years. President Trump, by the way, has just touched down. He's on his way to Dover with the First Lady. Has just touched down at Joint Base Andrews. If something comes from his walk to the jet, if he decides to talk with reporters, we'll let you know. I want to play this to the panel, though, because we've got a live wire here. This happened just a couple of hours ago. When we woke up this morning, we did not know this would be our top story of the day, but it came from the Speaker's decision to not bring this vote to the floor. So now he's being forced once again by the hands of his own membership. Bloomberg Politics contributor Rick Davis, our Republican strategist and partner at Stone Court Capital, is back just in time with us. And Arshie Siddiqui is here, Democratic strategist, former aide to House Speaker Nancy Pelosi, the founder and CEO of Bellwether Government Affairs. Great to see you both. Rick Davis, if you're one of these frontline Republicans, are you more concerned about your constituents than the angry phone call from Donald Trump?
At this stage, yes, because you want to continue to get angry phone calls from Donald Trump over the next 2 years, which means you got to get reelected. And so that's going to come first. We're already turning the page on this Congress. You're going to have a really intense midterm election cycle coming up, advantage Democrats. And these guys are scraping for their lives right now. And that's why they've signed on to this discharge petition, because, as Lawler says, doing nothing is idiotic.
Yes, he did. He used another word that we can't say on the air to describe the Speaker's decision to not bring this to the floor. We know that Mike Lawler doesn't like Obamacare, and he never liked the idea of extending these subsidies. Is it his own personal belief that caused this to happen, or he'll have a bigger revolt on his hands if he did bring this to the floor, the Freedom Caucus and all the rest?
I mean, I think it just illustrates that on the ground, this is such a huge issue in terms of how the cost of living crisis is impacting American families. So I think it really underscores a problem, and there has been a little bit of a disconnect with a number of Republicans in terms of the saliency of this issue. There's a very easy way to do a short-term extension, a bridge to something bigger, and litigate this in the election. And to Rick's point, go into the next, in next Congress with some decisions, but to go home for Christmas without doing this, I think there's real political liability. Even with this vote, I think there's a serious conversation that at least must be happening to some extent about, well, if they have to vote on it, do they just let this die in January, or do they just put something up for a one-year extension, a clean extension, to give that bridge to the midterm elections?
And bring that to the floor of the Senate, you mean?
Bring it. I would. I mean, honestly, I think in leadership, it's a live question on whether they should think about whether they could actually bring something up in the House and not have the discharge petition force our hand. And the only way they can do that is with the president's blessing, as you know.
That would be a moment. And look, he might call for that tonight. Rick, I'm just curious how far you can see beyond the valley here. When you were working for John McCain, he was part of any number of gangs of 8 or 6 or whatever to solve a major crisis here. Now that this has happened, is that the next phase, as opposed to John Thune taking this and throwing it on the floor? There's John McCain right now as we speak. Rick, does this become a conversation where senators and members of the House get together behind the scenes and craft something new that can then be voted on in both chambers?
I would say, and, not to oversimplify the situation, but the days of having major personalities with power outside of leadership in the Democratic and Republican parties in the Senate has waned a lot. There used to be great lions of the Senate who never held leadership, but who could put together deals anytime that would be honored by the leadership, right? And whether it was a Democratic group led by a Ted Kennedy or a Republican group led by a John McCain, sometimes it's easier for them to do a deal like that than it is the leadership itself, because they're balancing a lot of other interests. It's very hard these days to see that happening. Kudos to Susan Collins for using her perch as chairman of the Appropriations Committee, very, very powerful senator, to try and craft something, around this. Of course, she's running for re-election in a tough election year, so a lot of motivation on her part, too. So, yes, I could see a gang of 6 emerging in the Senate to try and bridge this, because even if this discharge petition passes, a 3-year extension is not something the Senate wants to vote on. And so I do think the question is, can they find some common ground where, there's a shorter extension, maybe some limitations on enrollment, and then send that back to the House for final approval. And I think if something like that did happen in the Senate, you would get House approval.
Okay, there you go. Rick just made it nice and clean for us, nice and simple. These 4 names, Archie, Fitzpatrick, Lawler, Bresnahan, McKenzie, speak for how many other Republicans do you think?
I think this is very much front and center a moderate marginal district issue, because I think in other districts, as we know, they are so heavily tilted Republican, there's a lot of latitude. And the Affordable Care Act has become so ideological on the Republican side. I remember when there were some internal discussions, buzz about whether Democrats were making it too easy for Republicans by solving the ACA problem, by pushing it. Right. But it's just turned out that there's such a strong contingent that wants to, really weaken and repeal the ACA. We've seen 70 votes, as you know.
That's right. Rick, the president's speaking to the nation this evening, and, we're all going to spend the whole day trying to figure out what he's going to say. It does present an opportunity for him, does it not, to speak to this and give direction to his own party?
I think so. He has assiduously stayed out of this issue, which is a little bit surprising because he's had firm command on virtually every legislative item that's happened in the last year. And so, yes, it does give him a chance to signal. But I'm not even sure Donald Trump has the level of power today that he had even just a few months ago to get something through the House. I mean, conservative Republicans have staked out a very hard position that adding another $70 billion in the deficit is a bad strategy by extending these ACA subsidies for 3 years. And they're really grumpy about doing anything. It looks like we're signing on to Obamacare. And so I think that's one of the reasons why Trump has said nothing. And I wouldn't be surprised that it doesn't get a lot of discussion other than, we need to replace Obamacare tonight, which is what everyone's been saying in the Republican Party for almost 2 decades.
Well, he did try to say something, though. Remember the week of Thanksgiving, he was floating, maybe putting something out there and got pushed back.
He suggested there might be a deal.
Right.
Does a move like this maybe warm him up to this idea again?
I think possibly. And I think the other piece here is that I think if the notion of a 1-year kind of bridge, a clean 1-year bridge, you then get that's the bipartisan aspect of this. You don't need the hardcore Democrats who want the 3 years. You don't need the hardcore Republicans who want to focus on, repealing and replacing ACA. So you come into this the center to pass policy.
So we can do this a couple of ways. The way Rick just described here with the Susan Collins bill, maybe we get back to something that looks like a negotiation, a compromise, maybe a new law is written. Or we continue down the road we're on now, where the only way you get to the floor is through discharge petition. The only way you move new money or fiscal policy is through reconciliation. And maybe we extend that. The only way you move a bill in the Senate is to kill the filibuster. Is that what's coming next?
I wouldn't go as far as the filibuster because I do think there's still some institutionalists in the Senate that would protect that, hopefully. But obviously, we've seen the president has been very opinionated on that front. Yeah. And, in this era that we're living in, all roads lead back to Donald Trump.
Rick, what was going on in the offices of Republican members in the House of Representatives today? How is it that we get 4 exactly? How does this stuff work? Because people hear stories like this and they, well, wait a minute. How did this land on the penny? These guys called around and said, look, I'm going to sign on to the petition so you don't have to. How does it work like this, and how many other Republicans do they represent?
Yeah, there's a lot of self-awareness amongst the membership. They know who's talking to the Democrats about signing on to petitions like this. And nobody wants to be the extra vote, right? Why pay the price? And so, there's probably a couple calls. I know Congressman Valdedano from California would probably been an extra vote and said yesterday publicly that he was inclined to sign up. And I'm sure someone called and said, hey, we got 4, you don't need to walk the plank. And so he gets the vote that he wants without having to actually look like he's jumping ship to do business with the Democrats. So, yes, there is a ballet going on in the House of Representatives these days, and it's not the Nutcracker.
Well put as ever. With Rick Davis and Archie Siddiqui on our great panel, I just want to turn you quickly to the markets because our biggest IPO of the year has just gotten off the pad. This is Medline, the medical products company that distributes medical supplies. This is not like a medical device maker. Think gloves, gowns, exam tables, this type of thing that are actually used by doctors and hospitals. Medline, right out of the gate, lower left to upper right, we're up 22% right now at just above $35, having been indicated to open 24% higher at a way oversubscribed event here. The IPO price was $29, and it was 10 times oversubscribed based on Bloomberg's initial reporting. So 29 at the IPO, we're above 35 now for Medline, up 21% in real time here with a market cap, as we see on the screen, of about $46 billion and rising. If you're with us on Bloomberg Radio, we're just going through a couple of charts here for the benefit of our viewers here on YouTube. So there you have it. Not bad. And it was kind of interesting to hear, by the way, that this was the biggest of the year, coming in the wake of CoreWeave and some of the others that we've been talking about. Medline open for business and up sharply here in Producer James, it looks like we've got another one here. Another jailbreak on Capitol Hill. Thanks to our panel, Rick Davis and Arshie Siddiqui. We'll have more in our second hour as we welcome our global television audience to the program. I'm Joe Matthew. This is Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
President Trump goes prime time as moderate Republicans break from the speaker. Welcome to the Wednesday edition, with now enough signatures in the U.S. House to force a vote on extending Obamacare subsidies past this year, a story that's evolving now in real time as we count down to the president's address tonight from the White House. With analysis ahead from our political panel, we'll get an update from the North Lawn of the White House, Tyler Kendall, and we'll have insights this hour from Democratic Congressman Suhas Subramaniam of Virginia and from former Republican Congressman Patrick McHenry, Bloomberg Politics contributor. All after we turn to Wall Street. Let's get an update on the Wednesday trade right now with Charlie Pellet. He's at World Headquarters in New York. Hey, Charlie.
Well, hello there, Joe Matthew. Prime time for Medline. Up and running right now, looking at a gain of 23.6% above the IPO price on Medline shares. They're up and trading right now. Medline out the gate at right now at $35.98. I'll keep you updated throughout the day on how the Medline IPO is faring. By the way, if you don't use their products, you certainly know their products. Medline manufactures and distributes medical supplies such as gloves, gowns, and exam tables used by hospitals and doctors. Stocks lower across the board. The Dow, the S&P, NASDAQ, all in the red. Stocks are falling amid continuing skepticism about the AI trade. NVIDIA, Alphabet leading mega caps lower. S&P right now down 0.7%. Dow Industrials down 79, drop there of 0.2%. The NASDAQ Composite Index right now down 1.1%. The Bloomberg Mag 7 Index down 1.1%. 10-year 4.15% with the 2-year 3.49%. Gold up $42 the ounce, up 1%, 43.45 on the precious metal. Silver surging now by 4.8%. West Texas Intermediate crude oil up 1.6%, 56.16 right now for a barrel of WTI. Bitcoin, meanwhile, at 86,521. Bitcoin down by 1.4%. Updating you on Warner Brothers Discovery, the parent of HBO and CNN, it is advising its shareholders to reject that hostile takeover bid by Paramount Skydance in favor of its original agreement with streaming giant Netflix. Warner Brothers Discovery down 2%, Netflix up 1.3%, Paramount Skydance up 2.6%. And again, we'll keep you updated on any and all developments involving Warner Brothers Discovery. One more time on Medline, now trading at $36.26, S&P down 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. Balance of Power continues right now. Back we go to Washington. Once again, your host, Joe Matthew.
Okay, Charlie. Bumpy market today. Thank you so much. Charlie Pellet will have more on Wall Street just about 20 minutes time here on Balance of Power. We've got our eyes on Micron Technology as well as the AI trade shrivels. Micron reporting results after the bell. It's down right now about 3%, and we'll have more on Micron's results in the late edition of Balance of Power when we do Power Moves with Romaine Bostick. All this counting down to the big primetime show tonight live from the White House. President Trump, right around this time yesterday, announcing his plans to address the nation, and he will do so roughly 8 hours from now. We'll bring you that address live here on Bloomberg TV and radio with big questions about what he will be discussing. With affordability, the key buzzword in town recently, the same reason why Donald Trump went to Pennsylvania 1 week ago and why J.D. Vance went just yesterday. The president's been seizing on this term with his eyes on Democrats as well, as we recall. Listen.
They gave you high prices. They gave you the highest inflation in history, and we're bringing those prices down rapidly. They say, oh, he doesn't realize prices are high. Prices are coming down very substantially. But they have a new word. You know, they always have a hoax. The new word is affordability. I have no higher priority than making America affordable again. You can give up certain products. You can give up pencils. You don't need $37 for your daughter. 2 or 3 is nice.
All right, I'm giving up my pencils. Is that what he will say tonight from the White House? Will it be a message about affordability, health care possibly, with what we've seen already today on Capitol Hill? We're going to get there in a moment. Republicans signing on a discharge petition to force a vote to extend Obamacare subsidies. Maybe it will be an announcement about the Venezuelan blockade he posted about last evening. It's quite a menu of options as we turn to Bloomberg Washington correspondent Tyler Kendall at the White House right now, joining us live from the North Lawn. Tyler, are we hearing anything from the president about this speech tonight?
Yeah, hey, Joe. Well, you really gave a good outline there that this could span a range of topics. We have been going off of an interview and preview that the White House press secretary gave yesterday, where she said President Trump is expected to tout his policies from the last year, but that he could also preview new policies, as it appears that the White House has been trying to dictate and change that narrative as we head into the midterms, particularly around affordability. Because as you're talking about, this has been that issue that the White House has, I think it's fair to say, been on defense over in the past few few weeks after Republicans lost a slew of elections just last month. And since then, we've seen President Trump go out on the campaign trail, Vice President Vance go out on the campaign trail, and the administration push forward some new policy ideas, such as refloating the idea there could be tariff revenue rebate checks. So it's going to be something that we are going to watch very closely here, how the president navigates this, considering we know in his speech in Pennsylvania last week, he did veer off topic and hit on some other key issues that we know are important to his base, such as immigration policy as one example. But you hit on it at the top of the show. We are going to be watching really closely, at least I am personally, what he says when it has to do with health care, because while this president has given us some indications on the type of support, the type of plan that he would support, we know that he wants to see less subsidies going to insurance companies. He hasn't really weighed in when it comes to the plans that are circulating on Capitol Hill. And Joe, as you know, as of now, it looks like Congress is set to adjourn and leave town without extending those expiring premium tax subsidies under the ACA.
It would be a big deal if you gave some direction to the Republican conference this evening. Tyler, I have to ask you about this post on Truth Social, because indeed we're looking for details about Venezuela as well. We're now using the word blockade, or at least the president is, and we want to be careful here because semantics mean a lot. The president on social media, Venezuela, he writes, is completely surrounded by the largest armada ever assembled in the history of South America. It will only get bigger. And the shock to them will be like nothing they have ever seen before. Tyler, is this about regime change? What's about to happen?
Well, Joe, you'll recall last week, Bloomberg News had this incredible reporting, people familiar telling us that we are about to enter into a new phase when it comes to the U.S.'s strategy against Venezuela, designed to get Nicolas Maduro to relinquish control. And that news phase started when the U.S. seized a foreign oil tanker for the first time last week since 2014. And now this latest move, you did mention semantics. It is important for us to make the distinction. According to Bloomberg Economics, this actually isn't a full blockade. This is what's known as a quarantine because it is narrowed into only sanctioned oil tankers. This does not extend to all vessels coming in and out of the waters around Venezuela. But this really does mark the latest escalation in the U.S.'s pressure campaign, trying to now threaten to deny those important oil revenues for the country, which is already facing financial strain. So we're going to watch really closely how this ultimately does evolve, because it's not totally clear right now how this quarantine is going to be implemented, when exactly it does start. But we're already starting to see potential buyers steered away. Right, yesterday on the program, we spoke about how these 4 super tankers headed for Venezuela ultimately turned around and reversed course because the administration had been telegraphing that this move was going to happen. Joe, I'll point you to one other thing from our analysts at Bloomberg Economics, who we love to cite all the time. They say that when there is a pressure campaign, if that intended goal is not reached, there's normally only one direction of travel, and normally that direction of travel is up the escalation ladder.
Well, pretty remarkable moment we're in, Tyler. Thank you so much. Tyler Kendall at the White House. The speech is set for 9 p.m. Eastern time, as we mentioned. We'll carry it live here on Bloomberg TV and radio. Unclear what the venue will be, whether the president will be behind the Resolute desk in the Oval Office or somewhere else in the White House in the Cross Hall, as he's been preferred to use more recently. He hasn't had a very heavy string of primetime addresses. Then again, this is a different White House. This is a president who addresses the nation just about every day, if not multiple times a day. What's happening now on Capitol Hill is important. If you're just joining us, we've seen a remarkable turn in the debate over extending Obamacare subsidies, realizing there will be a vote later today on a Republican plan that does not address Obamacare subsidies. That may or may not pass, and likely will with the Republican conference, or will it be that easy? Because we saw a jailbreak earlier today with 4 Republicans who crossed the aisle in frontline districts in states including, well, it's just New York and Pennsylvania. If you're with us on Bloomberg TV, there's the lineup. Brian Fitzpatrick, Republican, Pennsylvania. Robert Bresnahan, Republican, Pennsylvania. Ryan McKenzie, Republican, Pennsylvania. And Mike Lawler, the Republican from New York, all sitting in districts that lean blue and wanted at least a vote on an Obamacare extension. When it became clear the speaker was not interested, they moved to a discharge petition that will force the vote. Those 4 brought that number to 218, and they are now in business. Right at this time yesterday, I was talking about this matter with the chairman of the House Ways and Means Committee, Jason Smith of Missouri, and asked him, about the outcry from constituents that many lawmakers talk about. It doesn't seem that he's hearing from that many in his office. Listen.
The person who would be calling me from Missouri would be someone on employer-sponsored health care. And everything the Democrats is talking about has nothing to do with lowering the cost of premiums for people who are on employee-sponsored health care. And that's 164 million Americans. All that they're talking about is the 24 million people on exchanges. We need to lower the cost of health care for every single American, not just the people on ACA.
Mr. Smith, of course, is not in a frontline district and sees things differently than the four I just mentioned. We had the voice of a Democrat now in Congressman Suha Subramanian, the Democrat from Virginia's 10th district, with us live from Capitol Hill. Congressman, thank you for being part of our conversation today. This discharge petition will hit the floor. We will also go over the cliff. What happens then?
Well, we'll see. I believe we'll be able to vote on this at some point. I don't know if it'll be before the end of the year. But I know that there are Republicans, more than 4 Republicans, who have supported the ACA tax credit extensions and understand that without them, healthcare costs will go up for millions of Americans, including many in their district. And so, yes, we do have a cost issue when it comes to healthcare. Healthcare costs way too much right now. We need to do a lot to fix that. But the solution to the cost issue isn't what Republicans are putting forward, which is to take away care to a lot of people, access to care, quality of care. That's their solution, and that's not a real solution because people will die under that solution. We have a solution where we can continue to figure out a long-term solution, but in the meantime, also fund these tax credits that have been so essential to so many Americans getting healthcare access.
Well, it's interesting that you mentioned that because a solution is going to have to follow a gap of some sort, right? It's clear that we will go over the cliff. This discharge petition would bring a vote to the floor. I'm guessing, Congressman, correct me if I'm wrong, likely mid-January. Then something's got to happen with the Senate, and I know that there's a bill over there that's not too far apart from what the moderates have been looking at in the House with a smaller extension and some eligibility requirements. When could there be a law? How long will voters need to wait?
Well, remember, for there to be a law, the president needs to sign it, right? And so, yes, the Senate needs 60 votes to pass it. This president has not shown a willingness. Not only that, he shut down the government so that we wouldn't have a conversation about these tax credits. We had that conversation anyway, but he still refused to reopen the government and have this conversation about health care. So I am a little pessimistic about these tax credits passing, but I'm still going to push forward. I know my colleagues are not going to stop. Colleagues now on both sides of the aisle are not going to stop until we make sure that health care is affordable for millions of Americans.
Well, this is where I ask you what you're hearing, behind the scenes. What's happening in the cloakroom when you talk to other Republicans? Because clearly, you already said it, it's more than 4 here. What would this vote look like if it actually hit the floor? How many Republicans do these 4 members speak for?
Well, I know far more than 4 wants to vote for them. I would say dozens want to vote for them. But the reality is when Donald Trump calls them, they switch their votes based on what Donald Trump says. Now we have 4 Republicans who have changed their tune. And so maybe that could embolden more to follow. But this speaker and this Republican Congress has followed whatever Donald Trump has said to do. The Epstein files, even by the end, he said to vote for, and so that's what they did. But we're at a place now where Republicans are starting to break away from Donald Trump because they know that he's toxic to our country and to even their party.
Well, I know he's also got a lot of loyal members up there, Congressman, so it was a pretty remarkable moment when so many Republicans put their name on a discharge petition to release the Epstein files. We haven't talked about this for a minute because that got the clock ticking. I think it was 30 days. Friday's the day that the files are supposed to be released. And yes, the president did sign that discharge petition, now law. Congressman, you're on the Oversight Committee. Should Americans prepare for this release, or is there going to be some reason at the 11th hour why they are not made public?
My crystal ball is foggy. I will say this, that if they do release something, I believe it'll not be a full release, that it'll be a partisan release. They'll try to find Democratic names in it. But if the president hasn't released the files by now, I don't think he will release the full files like he promised he did during his campaign last year, or that he's required by law to do now. I'm a little skeptical at this point. If they wanted to release the files, they could have released it well before this coming Friday if they really wanted to be transparent with the American people.
It is coming at the last hour. Is there anything that the Oversight Committee can do to further compel the Attorney General to make this public?
Well, now, you know, with the Oversight Committee, we have had a subpoena out for these files for 4 months now, and they gave us one production that was 97% public documents. The other 3% weren't that helpful, and then that was it. And then there was radio silence from them. Now we're at a point where this is law, and so someone can go to court, and the courts can compel the administration to release the files, and we'll see if the administration wants to ignore court orders. We've had that conversation this year before.
Well, we're about, 48, 72 hours away from that being the case. Congressman, you must have seen this Susie Wiles interview. I can only imagine the conversations among members of the Oversight Committee. The White House Chief of Staff telling Vanity Fair that the president was just wrong when he invoked Bill Clinton as being complicit in the sex trafficking scandal surrounding Jeffrey Epstein. She said there was absolutely no evidence pointing to that. Will we hear from the Justice Department that it's an ongoing investigation all the while, and therefore these files cannot be released?
Again, the Justice Department works for the president at this point. He controls it, and he's going to try to control what's released and how it's released. Another thing that she said in that interview was Trump is in the files, and that he and Epstein were friends, and they were, I think, playboys together, single playboys together. And so it's pretty clear that there was a close relationship there, and that must be part of the reason why he hasn't released the files. That's at least what I see from my vantage point. But I'm glad she did that interview, because it was pretty incredible how she said all the quiet parts out loud about this president.
Well, interesting moment. He's going to be speaking to the nation this evening, Congressman, and I'm wondering your thoughts about another potential government shutdown. You're in Virginia, teeming with federal workers who just endured the longest federal shutdown in American history. Is there anything the president can say this evening to get the healthcare debate back on track and keep the government from shutting down when we run out of money at the end of January?
Yeah, the president can say, I want to work across the aisle to come up with a healthcare solution that's long-term. And in the meantime, we can pass these tax subsidies to be able to help Americans afford healthcare. I think that alone will solve 90% of the problems we're having right now on Capitol Hill related to healthcare. I think the other thing he should do is try to figure out how to work together with us next year, because otherwise 2026 is going to be a long year. I do not want a shutdown. I did not like this past shutdown, but we have to continue to fight for the American people.
Well, 25 was a pretty long year, Congressman, so I guess we'll find out together. Thank you for being back with us on Bloomberg TV and radio. Live from Capitol Hill, Congressman Suhas Subramanian, the Democrat from Virginia, with us here on Balance of Power. We'll hear from a Republican later on this hour, one with experience, Patrick McHenry, former Republican congressman, former Speaker Pro Tem, now Bloomberg Politics contributor, will give us the lay of the land here. He predicted all of this was going to happen as we walked up on the shutdown. We'll have much more ahead with our political panel as well. A blockade, as the president calls it, in the waters off Venezuela. We'll get to it next on Balance of Power on Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all in the red right now. Do want to begin, however, with Medline. Stock is surging after raising $6.26 billion in the year's top IPO. Right now, taking a look at Medline shares, they are indeed surging. Medline right now up by just about 26%. S&P 500 index down 57, decline there of 0.8%. Now it's 67.42. We've got the Dow, as I mentioned, lower by 0.3%, down 156. Tech stocks, though, where the real damage is being done in this session. NASDAQ now down by 1.2%. The NASDAQ 100 index down 1.4% as big tech sells off. Our Mag 7 index down 1.2%. 10-year 4.15% with a 2-year, 3.49%. Gold now up 0.9%, 43.41 the ounce. West Texas Intermediate crude up 1.6%, 56.16 a barrel on WTI. Under retreat for Bitcoin, down now by 1.3%, 86,652 on Bitcoin. Oracle shares down 4.4%. Oracle says final negotiations on an equity deal for a data center project in Michigan are on schedule and does not include Blue Owl Capital, a firm that has helped finance massive data center projects for firms including Oracle and Meta Platforms in recent months. Again, Oracle right now lower by 4.4%. Medline up by about 26%. Recapping, S&P down 0.8%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back we go to Washington. Balance of Power continues now. Once again, your host, Joe Matthew.
Okay, Charlie, making Blue Owl Capital a household name. Once it comes across Charlie Pellet's lips, it's real. Thank you. He'll have more on Wall Street coming up, the Wednesday trade, in just about 20 minutes' time here on Balance of Power. Thanks for sharing part of your Wednesday with us on Bloomberg TV and radio, with a lot happening today in Washington, all leading up to the primetime address from President Trump this evening. Should I say tonight? Yeah, 9 p.m. Eastern time. We'll carry it live here on Bloomberg TV and radio with context and analysis. Having received a warning last evening about maybe something that the president will touch on beyond affordability or the many domestic issues he could bring up, it's Venezuela and what he calls a blockade. On Truth Social, Venezuela, he writes, is completely surrounded by the largest armada ever assembled in the history of South America, followed by the threat. It will only get bigger, he says, and the shock to them will be nothing like they have ever seen before. Now, it's important to read further down on this very long post. When it goes to all caps, he says, today I am ordering a total and complete blockade of all sanctioned oil tankers going into and out of Venezuela. He does refer to the Maduro regime, the illegal aliens and criminals he says the regime has sent into the U.S. during the weekend and that Biden administration are being returned to Venezuela at a rapid pace. Of course, we've also been blowing up alleged drug boats at a rapid pace, adding 3 more just yesterday, and our political panel is watching all this unfold with War Powers votes set to be held this week on Capitol Hill as soon as today. According to Congresswoman Catherine Clark, the Democratic whip told us that last evening on Balance of Power. Bloomberg Politics contributor Rick Davis is with us, Republican strategist and partner at Stone Court Capital, alongside Democratic strategist Arshi Siddiqui, founder, CEO, Bellwether Government Affairs, former senior aide to former Speaker Nancy Pelosi. It's great to have you both with us here. Arshi, is this march to war, apparently in the Caribbean, going to be checked by lawmakers on Capitol Hill?
I think there are more questions than answers on this issue, so I think we will see more and more, and we've already seen it, I think, on a bipartisan basis. And the interesting piece of this is that Democrats actually could, they certainly don't support the Maduro regime, so we just haven't seen the president make a case.
Mm-hmm. Rick, you're no stranger to naval operations. The president using the term blockade, apparently quarantine would be the technical term here, as a blockade is seen as an act of war. Is this what's wrong with announcing stuff like this on social media?
Well, I think, the lack of precision has been a hallmark of the Trump presidency in the first term and obviously in the second term. So Donald Trump uses words as weapons. And there's no doubt in my mind that if he were sitting around a room of lawyers and saying, well, you can't say blockade because that's an act of war, he's going to say to them, screw you. I mean, I'm going to use it anyway because, this is what we're doing. And it'll have a bigger impact on the American public if they hear me say that and all those kinds of things. So, I mean, you can't take the Trump out of Trump. I mean, he's going to put it in all caps and talk about it in the best way we can. And, he always mentions sanctioned ships. So that's sort of his out on the technicality. But, he is promoting a conflict with Venezuela. And today, he's now talking about this as a way to get back stolen assets. When the Maduro and the Chavez regime nationalized oil fields and producing facilities from U.S. companies, now he's talking about wanting that back. So this thing is escalating, and maybe we're escalating to de-escalate, but right now I would bet escalation is the number one issue.
Well, to Rick's point, he writes again in this long post, for the theft of our assets and many other reasons, including terrorism, drug smuggling, and human trafficking, the Venezuelan regime has been designated a foreign terrorist organization, and therefore the blockade. That would be the grounds for regime change, right?
Absolutely, but we haven't seen a more robust case that's been made. And I think that at the very least, with the resources that are being expended here, and also you look at the time he's spending on these outside international issues versus I think Democrats there are a lot of questions on how does this fit into America first when you have we still haven't seen him weigh in on healthcare, right? Yeah, right. These subsidies are lapsing. So I think there are questions on all sides of this. And I think hopefully the president will make that case to the American people and Congress.
Will that be part of the speech tonight, Rick? When we were in this time yesterday before the jailbreak and the discharge petition on health care and everything else took place in the House, this was the big story, and it was followed by the post last evening. Are we going to have the strikes begin in 3 minutes kind of speech, or will he take the time to try to lay the foundation for what could be a looming operation?
That's a really good question, Joe, because obviously this is all with the backdrop of the release of the Epstein files on Friday, so he wants to get ahead of it, create some news. Nothing would create news more than some kind of an operation onto the landmass of Venezuela. And obviously they're not going to forecast that punch out of the press office a couple days in advance. But I very well could imagine a scenario where he talks about helicopters are now, entering Caracas airspace. I mean, it is what George Bush did with the taking out of the leader of Panama during his term. And so there's some precedent for this. And I would say backed up by his own constituency. I mean, there's a lot of polling data that shows this is a way to get right with MAGA. I mean, even though the concept of foreign entanglements is sounds like it's outside the American First dictates, the reality is American First kind of likes the attacks on these drug boats and keeping America safe from the kind of pernicious drugs that they're shipping into it.
Yeah, really interesting, Rick. Let's say that does happen, Archie, if some sort of military operation were announced. Would that excite the MAGA base, and what would be the reaction from the Democratic Party?
So I don't see myself as a MAGA expert.
No, I get that too.
But certainly I think there is to the point on drugs, Venezuela, there is a contingency, and also you look at South Florida. There's a very big echo chamber on these, right?
Marco Rubio has tried to make that case to this president,
and I think Marco Rubio, the Secretary of State, has been very pivotal in this strategy. So I think for Democrats, it's again the questions and it's the checks and balances, because I think even when you look at blowing up. On these drug smugglers, nobody knows who are on these boats. The Congress still has not seen the second tape as was promised by the president. So again, it goes back to all of these questions and checks and balances, and having that, even if it is, top security clearance, but just the tried and true nature of these briefings are not happening.
You bring up a great point. That video, they said, would be shown to senators and members of Congress at the end of this week or second half of the week. That could be tomorrow, Rick, and it would be interesting timing if that did coincide with the address. How about dumb question time, Rick Davis? I don't know what's happening on the ground in Venezuela. Obviously, the president has, in fact, confirmed that there was some sort of CIA covert op that was underway on the ground. Why not offer Maduro $100 million to leave. He could go live with his friend Vladimir Putin, probably somewhere really nice. Wouldn't that be a lot cheaper than what we're doing right now?
I don't know if it's an economic issue. Honestly, my own view is it's a moral issue. He's a really bad guy. He's done horrible things to his own population, and he's been one of the most outspoken anti-Americans in the hemisphere, if not the world. I'd have a problem with paying a guy to go away. You know, we have other ways of doing it, and frankly, what we want to do is create a lesson here for other malcontents in the region who might say, oh, I could get paid if I just give the U.S. a hard time. I know there have been conversations with Maduro folks to get him out of there, and he's rejected some of these forays, including going to Turkey, which is, you know, at least you don't risk falling out of a fourth-floor hospital when you're in Moscow like that.
That's true.
And so, you know, there may be an exit plan for him, but I think the door is going to close on that pretty soon if he doesn't look out, just like it did on Noriega.
Wouldn't he be smart to take an invitation like that if we've got the biggest armada in South American history at his doorstep?
I mean, based on what we know about Maduro, also getting run out of his own country by Donald Trump also might be, it's not a great look. So I think that's also probably in the mix.
You just wonder what we're spending on a daily to keep this armada afloat here. I'm guessing it would be a lot more money than what I just suggested. Big picture this evening. The president's going to be interrupting the season finale of Survivor. This is not the White House of when we were whatever, younger, okay? The people watch the president clipped up on Twitter. Does the primetime address on three-letter networks actually have an impact anymore?
I believe it does.
Yeah.
I believe Donald Trump knows how to create a spectacle. He knows how to create drama. And everybody's talking about what is he going to actually really talk about tonight. I think the challenge on the Republican side is there seems to be this assessment that this is a messaging problem across the board in terms of the agenda versus a substance problem, a policy agenda problem. And I think on the Democratic side, first and foremost, I think there's a case that's being made and will continue being made that this is more about the policies, and these policies, whether it's tariffs, whether it's healthcare, whether it's the high price of food in the grocery store, all of these policies are making things worse, not better.
Rick, you have to have a good reason to interrupt people in their living room at 9 o'clock at night. Will the president have one?
You know, look, I think that Archie's right. This is still an important thing when the president speaks to the American public. How many times did we have shows where we said, oh, you know what Biden's got to do is go talk about why there's so much inflation and how he's going to cure it, and he never did. So I think it's good that the president is taking the time before the end of the year to make the case for the administration that he's had and actually give us some sense of what's going to happen next year, because it's been a roller coaster, and I don't think we would have thought that this year was going to turn out the way it has. And any insight that he can give the American public on what next year is going to look like would be very reassuring.
We're going to find out together, 9 p.m. Eastern Time. Join us here on Bloomberg TV and radio for The Real Thing. Big thanks to our great panel, Rick Davis and Archie Siddiqui. We appreciate the insights. Our conversation straight ahead with Patrick McHenry, only here on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with Medline. Stock now surging 27.2% after its IPO. Right now, we do have Medline trading at 36.90. The Dow, the S&P, NASDAQ, they're all in the red right now. S&P 500 index trading lower by 1%, down 65 at 67.34. Volatility hitting Wall Street, pushing high valuation tech stocks and crypto lower. Bonds paired losses after a senior Fed official signaled room for rate cuts. The S&P now down 1%. Dow Industrials down 201, down 0.4%, while the NASDAQ Composite Index is down 328, a drop there of 1.4%. The 10-year 4.15%, with the 2-year 3.49%. Spot gold is up $33 the ounce to $43.35, up 0.8%. Silver up 4%, $66.30 the ounce. Bitcoin, meanwhile, trading lower by 1.7%, 86,260. West Texas Intermediate crude at 56.13 a barrel. WTI up now by 1.6%. Among the names reporting after the close of trading today, Micron Technology. Investors growing increasingly skeptical about the AI trade. Micron down now by 3.3%. We'll keep you updated on Bloomberg and television and radio after the close. Last week, by the way, you'll recall we did see dual disappointments from both Oracle and Broadcom that sent their stocks tumbling 11% in a single session. Today, Oracle down 4.8%. Broadcom down 5.6%. Micron certainly will be closely watched again. Micron down 3.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And Balance of Power continues right now. Back we go to Washington. Once again, your host is Joe Matthew.
Okay, Charlie, many thanks. Charlie Pellet will have more on Wall Street coming up at the top of the hour here as Bloomberg Business Week Daily gets underway. And, of course, we're going to be tracking Medline all the while. Biggest IPO of the year in a year that has seen hundreds of IPOs. Pretty remarkable, up 29% now. Look at that, topping $37 on a not great day for the market. So clearly a big appetite here. In fact, we were reporting at Bloomberg that it was oversubscribed by some 10 times. Before we get back to politics, the Republican jailbreak, and the future of health care in America, in our conversation with former Congressman Patrick McHenry, former Speaker Pro Tem, we want to bring in Bailey Lipschultz for more. He's been watching Medline since it went public here. Medical, not so much device maker, but medical supply maker. Think gloves, gowns, and masks. Bailey is Bloomberg Equities reporter live in New York. Says a lot to be this popular on a tough day on the markets like this, doesn't it?
It does, and it also says a lot when you're an IPO that, with the green shoe being potentially exercised, you get close to $7 billion. So the biggest U.S. IPO since Rivian, as you mentioned, up close to 30%. I would say for all intents and purposes, this has been a far better success in day one than I think even the sponsors who backed this company would have expected.
Pretty remarkable considering the fact that I don't think there's any tie into AI here, Bailey, unless I'm wrong. This is a company that makes old-fashioned stuff, and I guess maybe it's appropriate or on brand for this market right now for investors to be chasing an actual profitable company with a track record.
No, certainly, and we've seen that play out really in the last few months. If you look at their leaders in the S&P 500, we've seen investors rotating to healthcare companies and more defensive plays. And when we caught up with Medline's CEO this morning, he painted a vision that they should be compared to Costco. And at first you say, I don't know how a healthcare company is going to be related to Costco, but their vision is they have a private brand. Kirkland obviously has their, Costco has their Kirkland brand. Medline is really touting their ability to own their supply chain and do a number of their logistics in-house. So when you think about it, it's not your typical supply chain company because they produce so many goods. They have over 300,000 products that they distribute, and they are a key player within the healthcare space. So if you look at kind of the fundamentals, talking to investors, this is what people want to see more of as opposed to excitement around what AI could bring 5 years from now.
Well, I guess that's kind of refreshing. 300,000 products? That's incredible. Just give us the 30,000-foot view, Bailey, because it has been a pretty big year for new issues. And remembering when Donald Trump took office, we heard all about animal spirits. This is go time for the Goldman Sachs of the world, isn't it?
Yeah, we've seen about $45 billion raised in IPOs here in the U.S., so that lags, call it $50 billion, what we would see in a typical year, the decade before COVID. But you have to keep in mind, nobody for all intents and purposes, wanted to go public in April and May because of the tariff turmoil. And it was very difficult to get public when the SEC was shut down. So if you say $45 billion raised and we remove 3 or 4 months, that's actually quite good. And a lot of investors and bankers obviously are very keen for what 2026 can bring. And there's a lot of excitement, whether that's private equity portfolios or the SpaceXs of the world.
Yeah, great. Bailey, thank you. Bailey Lipschultz, Bloomberg Equities reporter, live from New York as we track Medline on a pretty big debut here on Wall Street today, even as markets sag. If you were joining us after we heard from Charlie Pellet, the S&P 500 is down about 1% right now. The NASDAQ down a little bit more than that. So pretty remarkable to see an IPO up 30%. And we'll be tracking it throughout the day for you here. The big news as we came to air around noontime was 4 moderate Republicans crossing the aisle to sign on to a discharge petition. Couldn't this have been a lot easier? Then again, I think back to our conversations with Patrick McHenry. Before the government shutdown, before we entered autumn even, remember the way he described what would happen starting in October and, of course, bleeding straight into the new year? It's happening. Bloomberg Politics contributor, former Republican Congressman, former Speaker Pro Tem, Patrick McHenry with us in studio. It's great to see you.
Great to see you.
Does it get worse?
Oh, yeah, it gets worse before it gets better. John McCain had a line that is the darkest before it goes full black. It feels like that. There was an easier way out of this than what has happened in the House. The Senate process is working actively to resolve health care. But let's just step back on health care.
Okay.
Here we are in America today where almost all the health care laws, and in fact, every major health care law in America was written by Democrats. The American people do not like the health care system we have. The laws are written by Democrats. And then the third fact is the American people prefer the Democrats on health care. So it's a complicated thing. Yeah. It's a complicated thing, and it's an opportunity for Republicans to actually have a message and a policy set on health care, and Republicans, my friends, and me included, have failed to do it. And it's not that they lack a plan. It's just that they have an infinite array of plans, none of which is sufficient to actually answer the question of the cost of health care, the access to health care, the things the American people care about, nor is there a sufficient plan that would get all Republicans to support. And so here we are today where the Democratic alternative is more favorable in the American people's eyes than the Republican alternative on health care. And now you have moderate Republicans saying, actually, I'm going to side with my constituents over the powers that be in Washington, and that's why we have this breakpoint today.
Right. So a discharge petition rules the day once again. What will happen to these frontliners, the Mike Lawlers, the Fitzpatricks? They've crossed the speaker. Is there a penalty for that, or are they speaking for a much larger group in the Congress?
Well, traditionally there's a penalty for that, but in a narrow House, it's a very difficult thing to police, number one. Number two, the White House doesn't seem to be stepping in here. And so I think the White House would like to see a resolution rather than allow 10 million American people to see their health care costs go up dramatically. They would prefer that to not happen. And so they're letting this happen on Capitol Hill and asking the leaders to resolve it. And it's not being resolved by the leaders. I think you see a process in the Senate blessed by Thune and the Republican leadership. But in the House, you've had these moderates break because of the failure of the leadership decisions in the House. And I think we're just going to see this story continue into January when the vote actually happens in the House.
Wait, so if you're Mike Johnson, I mean, I guess you just explained why he is bringing this bill that he's bringing to the floor today. It's a lot of components that were rejected by the Senate that have been floated before that don't address Obamacare, but also do not include the health savings accounts that Bill Cassidy made fashionable in the Senate. So this is just an effort to put something on the floor?
It is. It's an effort to put something on the floor. And to be quite frank, this issue, this challenge for Republicans on health care predates Speaker Johnson.
Sure, of course.
He's just trying to resolve something in a very tough situation. And an administration that would rather not touch it would rather let the legislative branch go work their will on it. But this bill that's on the floor is a pale comparison to what traditional Republicans would like to see on a fulsome health care package. But it's the best they could do in a short period of time.
Yep. President's going to speak tonight. I'm sure you'll have the chair in front of the tube at 9 o'clock. Does he get into this? Is that what this is about? Or is it sort of broad affordability theme? Or does he say, after what happened today, I'm calling on Republican members of Congress to extend the Obamacare well, we won't call it that, but something like that.
We shall see.
Yeah.
I think they want to make a break on to something more optimistic than rear-facing. And I think this will be the opportunity for the White House to pivot into a set of issues that are more favorable for Republicans going into
So this is like a State of the Union preview kind of thing.
Look, President Trump is always there to capture attention and redirect it. So I don't think it's going to be a straight line going. I don't think there's a straight line going into tonight or coming out of it. And we're going to see what the twists and turns are.
Wow. All right. Well, this is going to be fun, and I guess that's why everybody's carrying it. Remember when networks used to argue with presidents like Biden and Obama about going on in prime time?
It used to matter.
Those days
and
are
now
over.
This president knows how to captivate attention.
Well, they'll probably have better
every day.
ratings with the speech anyway, right? I don't know what they're in. It's prime time.
It's all about the ratings, right? Isn't it?
That's what they tell me. I don't know. That's why we're on right now with Patrick McHenry. Is January going to be worse than December? Was worse than November? We're going to go over the cliff, as they say. You'll have this discharge petition. You'll also have a government funding deadline.
Yeah, so Leader Schumer has tried this both ways, where he rolled over in March on a government funding deal, and he got slayed by his party. Then he went and fought valiantly and it created the longest government shutdown in American history, and the resulting effect was he got slayed by his party. So he's tried it both ways, and both ways he's lost political cover and political leverage. Wow. So there's no third way here. Okay. So I think January 30th is more likely to be a normative thing where we fund part of the government and have a continued resolution for the rest. But between now and then, I think you're going to see a resolution to this healthcare debate. Sure. It has become a healthcare debate that's this massive, when in reality it only deals with 10 million of over 300 million Americans, an important slice, but just a slice, and not a full resolution to healthcare. I think we have healthcare, we go into government funding, and then what comes thereafter is digital assets, cryptocurrency, the market regulation bill that's working its way through the Senate.
Understood.
So I think you have a bill signing for the president on government funding, on healthcare, and on crypto in the first quarter of next year, which is wildly different than what we've seen over the last 3 months here in Washington.
We'll play that back, James. You got to grab that. I have to ask you, you might not know the answer, but as we consider Donald Trump's thinking through how to handle Congress right now, when he emerged from the Oval Office this morning on his way to Dover, he was there for the dignified transfer in Delaware, the two Iowa National Guardsmen who were killed in Syria. Kevin McCarthy was with him. They were in the Oval together. They walked over to the Marine One and they took off together. Is he getting advice from the former speaker?
I think so, and I think well, broadly speaking, the president keeps counsel in a very different way than previous presidents. He talks to a lot of people, makes decisions for himself. Speaker McCarthy has shown, and he's a dear friend of mine, but he's shown himself to be a very adept political mind, knows how to handle the party as it is today, not as it was a decade ago, but Trump's Republican Party, and he knows the president's equities. He knows politics, and he knows the president's equities, and knows the party. And so I think those things give him a favorable voice and an active input to the president in a direct way, as well as a high regard by his team writ large.
That's fascinating, though, to think that that's the conversation being had on the chopper today and may inform what he says tonight.
Well, it could, but also, I mean, Speaker McCarthy is well sought after as a political advisor.
Understood.
And so I think the president is using his his player the best way he can.
Sure.
But Speaker McCarthy's maintained great relationships with this Trump team and the broader administration. He knows his way around Washington really well. And I think he's enjoying being in the private sector as well, rather than the glare of the House floor lights.
You must have read this Vanity Fair interview with Susie Wiles, right?
Hard not to.
I'd love for you to
Hard
say
not
no.
to.
I dare you to say no.
Yes.
Is she going to ask
By
Kevin
the way,
McCarthy?
far more readable than the Crystal is Olivia Nunzi thing. That's far more readable.
Well, that's been making the rounds, too. We have less than a minute.
What I would tell you
Are they going to ask Kevin McCarthy to be chief of staff?
Don't know. But what I do know is this. Okay. I'm going to dismiss that one quickly. But what I would tell you is this: the response, the response from of rallying around Susie Wiles is amazing. Is not your standard response from a Trump administration or any other administration. Shows her strength and capacity. Also, this flight with Speaker McCarthy shows that he's really tied in. Anything could happen.
All right, that's closer to an answer. So you're saying there's a chance. Patrick McHenry with us. How about that? We'll play this tape back as well, and I'll meet you on the late edition of Balance of Power with much more to talk about ahead of the big speech, 5 p.m. Eastern, here on Bloomberg.
Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody across Bloomberg platforms. Yes, indeed. Carol Masser, Tim Stenivek, live here at Bloomberg headquarters in New York City. S&P 500, kind of a bummer, down for a fourth consecutive day here.
If you're long this market.
That is true.
If you're short over the last 4 days,
I like that you think
smiling.
about those who might be shorting the market.
Two sides to every trade, Carol.
Very true.
S&P 500 down about 1% right now. The NASDAQ composite down 1.5%. Mega cap tech really taking a hit today. We're going to have much more from Charlie Pellet in just a minute.
Yeah, I'm looking at the S&P 500, though. You know, you dig inside the index, kind of an even split, 252 names to the upside, 249 to the downside. So we're going to talk about the trade, as you said, in just a sec. Also ahead this hour, you know, IPO market, not so shabby. The biggest IPO of the year getting out of the gate, rallying on its first day of trading. We're going to get a look back at the year that was and a look ahead
one of your gainers.
to 2026. It is.
It is. Okay, good. Just making sure.
It was a late ad.
Okay, plus a strategy session on the next Fed chair and policy and how it could affect the investing landscape.
Matt Lazzetti's in the house, and so is Ali McCartney. So we'll talk about the Fed, fixed income side of things, expectations for monetary policy, and then we'll talk broadly about financial markets. Hey, we're also going to get into what the New York Times has called, they've called her actually the connector of New York's powerful. They've also talked about her as like another, I think, report, the billionaire whisperer in New York City. We're talking about Kathy Wild. She's the outgoing president and CEO of the Partnership for New York City, but she's part of the transition team for the New York City mayor-elect. So curious to see what she is hearing. We know the New York City economy is so important, not just for the financial community, but really for the overall country.
Yeah, we're going to talk to her in just a few minutes. First up, though, as promised, to check on the day's trade and top business stories, here he is, Charlie.
All right, I thank you very much, Tim. Stocks lower across the board, but Carol was alluding to Medline. Do want to bring you up to date right there because Medline shares, they're up right now by 31%. We are tracking it on Bloomberg Television and Radio. Biggest IPO of the year. If you don't use their products, you certainly know their products. The company manufactures and distributes medical supplies such as gloves, gowns, and exam tables used by hospitals and doctors. Out the gate at 29. Right now, Medline 38.01, looking at a gain right now of roughly 31%. This on a day when stocks are selling off. The Dow, the S&P, NASDAQ all lower. 4 declining days in a row on the S&P right now at 67.32. We're down 67 on that index, a drop of 1%. Dow Industrials down 194, a decline of 0.4%. The NASDAQ Composite Index down 340, a drop there of 1.5%. 10-year 4.15% with a 2-year 3.49%. Gold up $31 the ounce, 43.33, up by 0.7%. West Texas Intermediate crude oil up 1.4%, 56.04 the barrel, and Bitcoin down 2.4%, 85,600 right now on Bitcoin. Recapping Medline, surging now at 37.99. We'll be hearing from Micron Technology after the close of trading. Ahead of earnings, Micron down now by 3.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, folks. Well, Fed Governor Chris Waller backed further interest rate cuts to get the central bank's setting back to neutral, saying policymakers need not rush to do so. He made those comments earlier at a CNBC event.
I believe inflation is under control. Inflation expectations are anchored. Standard central bank wisdom is you look through one-off price effects like a tariff would be if it has inflation effects. Then the labor market's telling me we should continue cutting the rates. And that's kind of my view about things.
All right, that again was Fed Governor Chris Waller at an event earlier today. He is under consideration to be the next Fed chair, expected to meet for an interview with President Trump later on today. Asked about that, he quipped, that's kind of what he had heard.
What else
They're a little cagey. Exactly.
What else are you going to say? Meantime, at an event, Treasury Secretary Scott Bessent again rejected reported concerns about the qualifications of National Economic Council Director Kevin Hassett as a candidate to become the next chair of the Federal Reserve.
All right, so let's talk about the next era of the U.S. Central Bank and more. Here with us once again in studio, Matt Lazzetti. He's Chief U.S. Economist, Head of U.S. Economic Research over at Deutsche Bank. Good to have you back with us.
Good to be back.
It does feel like we're trying to figure out who's next. You do actually write specifically about a Warsh nomination and what it would mean for the Fed. Does it really matter who ultimately will be as Fed chair, since it is one vote, an important vote? But
yeah, so, we've had to, as this news evolves, write just about everybody that's a front runner. So we wrote a Hassett piece before, months ago. I think we were talking about Governor Waller and why we thought he could have been a very good candidate for Fed chair. But to the question of does it matter? I mean, the market is pricing it like it does matter. There's a premium in the June FOMC meeting. We're building in more rate cuts at that meeting than the surrounding meeting. So the market is pricing something happening as that transition takes place. I think we're a little bit more skeptical of how much it can matter. You know, clearly, I think Chair Powell has mattered recently. I think you don't get the December rate cut without Chair Powell essentially pushing it through what is a very hawkish committee at this point in time. But I think he built up that confidence, the credibility within the committee over a period of time. Just somebody coming in from the outside with a more dovish view is not going to be able to get this hawkish-leaning committee to cut rates aggressively up front.
Of the candidates who are the reported frontrunners, is there one who it would send a signal to you or maybe send a signal to the markets that the Fed's independence is at stake?
Yeah, I think that there's lots of questions around this. I think when you kind of see surveys, Kevin Hassett raises some of the most concerns around Fed independence and kind of commitment to get inflation back down to target. And I think that's somewhat quite natural. I mean, he's been in the president's orbit for a period of time here. He's been an economic advisor for the president. He's been calling for aggressive rate cuts at this point in time. All these candidates are doing so at this point, as we heard from Governor Waller recently. And so I think whoever it is, the next Fed chair is going to have to earn the market's trust that they are going to commit it to bring inflation back down to target. And I expect the market to challenge that a little bit.
Hey, Matt, you know, the New York Times writes, next Fed chair in a no-win scenario, a selection process draws to a close. And they go on to say the person picked to replace Jerome Powell will be thrust into a credibility problem that will be difficult to escape. Is that the case? And I also wonder, you know, sometimes you get into a position and you realize the weight of a position. And we know what the Fed does means a lot, not just to the U.S. markets, but to global markets.
Yeah, so I think it is the case that there's going to be a challenge for this next Fed chair coming in. They come in almost with a mandate to cut rates meaningfully. The president has called for the Fed funds rate to be down close to 1%, near the lowest in the world. And yet, even though Governor Waller said that inflation is under control, core PCE inflation is at 2.8%. It's still 80 basis points above their target. We're now 4.5 years in well above target inflation. And although the market's pretty sanguine about the inflation outlook, you know, we do have a stronger growth outlook next year. We have fiscal stimulus that's coming through the pipeline.
Sounds pretty good to me.
It actually looks like a pretty good outlook from a growth perspective. And then a question of does that feed through into higher inflation pressures?
What about the labor market, in your view? We got some data yesterday. It was weird to say Jobs Tuesday over and over again.
It was.
It's partial data, and we'll get some inflation data tomorrow. But the jobs market, how does it look in you?
So the way we've been describing it, and I think yesterday was another case of this, it's a Rorschach test for how you think about the labor market. Each of these reports has good elements and bad elements. I think yesterday's report had strong job gains. It had a broadening out of job growth. We've seen the private sector rebound. We had negative job gains in June. Past 3 months have been 75,000 plus in terms of private sector job growth. So that's all quite solid. The weakness was in the household survey. You saw the unemployment rate rise to 4.6%. Broader measures of labor market slack actually picked up more. I think importantly at the December meeting, Chair Powell highlighted why we should discount that data. It's coming right around the government shutdown. We thought that there was going to be distortions to that household survey. So Fed pricing hasn't really moved all that much on the data. I think far more important will be the December jobs report that we get in early January.
So the worst case scenario is we've got inflationary pressures, which sound like they could be coming in the new year because of some of the stimulus measures that we're certainly getting from the White House, Matt. But if we have more inflationary pressures, but we continue, if we get some confirmation in the December numbers that yes, indeed, there is job weakness and maybe it's continuing, that's a tough predicament.
It is. I think it's a direction of travel towards stagflationary type impulses for the economy. It is what most economists and we thought you would get out of very large tariff increases. And so I think it is beginning to work its way through the economy. I think what we've learned, though, however, is this Fed under Chair Powell and undoubtedly I think the next Fed, if you have weakness in the labor market, they will respond. They responded last year by cutting by 100 basis points. They responded this year by cutting by 75 basis points. Our base case is that the labor market stabilizes enough over the next several months that the Fed does not cut in the first half of the year. But look, if you get confirmation that the unemployment rate is 4.6% or above, I think the Fed cuts in the first quarter.
All right, good stuff. Getting ready for 2026.
Come hang out with us in the first quarter.
I would love to come back.
We would love to have you back. Matt, thank you so much.
Thank you.
Happy holidays. Happy New Year. Matt Lazzetti, he's Chief U.S. Economist, Head of U.S. Economic Research for Deutsche Bank. We're going to talk more about Fed policy, the economic data, and what that means for markets in just a moment. Having said that, we are seeing stocks under pressure today.
Yeah, taking a look at the S&P 500, down about 1 full percentage point right now. If I go deeper into the S&P 500, it's information technology, communication services, and industrials that are all taking a hit. The industrials move, Carol, is really interesting. If you look at the worst performers in the S&P 500, these are all companies that are tied to, in sort of a tertiary way, the AI boom. So you have GE Vernova down 8.8%, Constellation down 8.1%, NRG Energy down 7%, Vistra Corp down 7%. Oracle is the first big name that is sort of like, okay, this is an AI, primary AI company now, or seen as like a bellwether for AI. That's down a whopping 5% today.
And rode a wave up in a big way because of its connection and kind of lean in, if you will, into AI in a big way. But now that, we're watching in terms of what it's doing to the company's balance sheet, investors are maybe saying, well, if this doesn't all come to fruition, what does it mean for a name like Oracle and some others? Let's not forget, we'll get a read on AI once again when Micron Technology reports after the closing bell. That stock up 165% so far here in 2025. And in today's session, we're seeing it down about 4% ahead of those markets.
Well, we just talked to
release.
Deutsche Bank's Matt Lazzetti all about the Federal Reserve and his view on what the next Fed chair has in front of him or her, depending on who it is. I'm guessing our next guest has some thoughts on the Fed and what it means for financial markets. Back with us, Ali McCartney, Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners at UBS. Just over $1 billion in assets under management. She joins us here in the studio. We're going to talk about the markets and today's moves and sort of big picture what you're looking at. But we got to start just with the Fed and how you're thinking about the next Fed chair.
Next year, and the Fed is going to depend all about, it's going to be policy and politics, right? I'm not sure which comes first. Market seems to be about 50-50 on whether we have a cut in January. We think you see 2 cuts next year, one in the first half of the year, one in the second. Okay. I think it will be largely dependent on who's in charge, what the inflation is that we see coming into the market, whether it's from healthcare. We were talking in makeup chairs about the increase in cost of healthcare for average people going up almost 100%, as well as tariffs push through from like later this year. But it is, in a sense, it is anyone's guess. The markets seem to be pricing and playing as if they know there are further cuts. It's just not clear when or how profound. If you look at the last Federal Reserve dot plot, you could sort of drive a truck through whatever neutral is. I think it was 2 to 4% was about a little bit of a range. So I think you basically have tailwinds that are, we know that earnings are going to be, decent to good. We know those are going to broaden out a lot just from the IT trade. So that's, one of the things. Fiscal policy, especially in the first quarter, is going to be major as a result of both income tax sort of rebates as well as corporate spending initiatives and accounting issues that are going to propel both earnings and cash on balance sheets. And then again, the Fed will be part of this for sure.
Ali, when you look at 2026, and I want to think about this year, like how we thought things were going to go initially when President Trump came back to the White House, how it played out, April Liberation Day. Like, I think we were all whipsawed in terms of our expectations and ultimately kind of how it all laid out. And I think we thought this was going to be a disastrous year. And yet I look at the major equity averages, not so shabby. Certainly, again, if you're a bull in this market. So, I mean, I don't know. Is this a reminder that it's going to be maybe hard again next year to make calls, or is it different?
Well, was it hard to make calls this year? So you had to get 2 things right. You had to understand 2 things. You had to understand what AI was going to become in terms of a movement from the chief constraint being chips to the chief constraint where we now sit, and I think what's moving the market today, which is energy and land for data centers. And you had to get Trump right.
So, okay, those are difficult.
Those are very difficult. You also could have simply been long beta on the concept of earnings.
Meaning you just throw money in the S&P 500.
Exactly.
And you're good.
And
tough moments, but you would have done well.
Exactly. Next year, I think it becomes, actually, if I'm thinking back to where I was a year ago, it becomes a little easier in the following. While I can't say that I or we can get Trump right. I think we can get directionality and maybe short-term volatility we can dampen, because we know it largely leads to what he wants he gets, which is mid or longer term markets up. I think
he does care about market direction.
He does care very much about market direction. I think, you know, the craziest thing about getting Trump right or wrong was he told us exactly what he was going to do. You know, he told us via press conferences, via other people, via, you know, social media. And so if you went with him, you got things right. I think this year, things are going to be a little... So I think they're going to be a little easier in the broadening out of earnings, right? So if you look at, for example, the S&P 500 or the NASDAQ this year, what you got was the AI trade contributed to about 75% or 80% of what ultimately became the upside. So if you look at the next best contributor, it's financials at 1.7%, right? Next year, I think you're going to get some broadening in that. I think industrials, materials, financials, healthcare are going to play into that.
What happens if the promise of AI doesn't come to pass?
That's the biggest risk case. I think the biggest risk case for next year is for investors or economists or policymakers is that we got AI wrong. The infrastructure, it's not if you build it, they will come. It's not that we start to democratize and deepen.
It's a big bet.
It's a big bet. And today, that bet in terms of what's been coming out around Blue Owl and financing, because one of my biggest takeaway from a 4-day AI conference 2 weeks ago that UBS threw is that this is all about debt financing. There is not enough private debt and there is not enough capital on the balance sheets of the non-hyperscalers to get us where we need to be in terms of AI. And so it has to be debt capital markets.
Oracle is Exhibit A.
This is, so to me, this is, I literally left there going, oh, I understand what the constraint is now. I understand the difference between a, let's say, a CoreWeave and how they talk about how they finance asset-backed, you know, AAA companies, and how the market has been responding to that finance. I understand the private debt market and the private equity market saying we can only do so much in terms of what's needed. And so capital markets and public individuals have to come in. And so I do think that's the biggest risk, but I can also tell you from that conference and the conversations I've been having that this is truly revolutionary and moving to the bottom line in a way we've never seen before. And that whether it's creativity in the financial markets, in the structural markets, that the productivity increases and the changes to both costs and revenue generation are, you know, we really are at an inflection point that can support different multiples.
And the Oracle story is Oracle's financing for data center in Michigan progressing, but Blue Owl Capital, which has been a longtime partner in Oracle's rapid AI infrastructure build-out, opted not to contribute equity. So it's
that's exactly what we're talking about. Right now, it is a closed, finite ecosystem.
Right.
And in order to get where we need to be going, it has to get much bigger.
Allie McCartney, Managing Director of Wealth Management and Private Wealth Advisor for Alignment Partners over EBS. Thank you so much. This is Bloomberg.
Wall Street, we do check markets all day long. Here at Bloomberg, we have got the Dow, the S&P, NASDAQ all trading in the red. Right now, the S&P 500 index is down 63. That is a drop of 0.9%. Volatility lashing Wall Street, pushing high valuation tech stocks and crypto lower. Right now, the Dow is down 171, a decline there of 0.4%. The NASDAQ Composite Index down 342 points, down 1.5%. The Bloomberg Mag 7 Index is slumping by 1.6%, 10-year at 4.15%, the 2-year currently yielding 3.48%. Gold is up 0.8% at $43.38 the ounce. West Texas Intermediate crude advancing 1.4%, $56.05 a barrel, and Bitcoin now down 2.2%, 85,813 on a Bitcoin. Earnings news, we heard from Lennar last night. Its forecast for quarterly home orders missed analyst estimates. Lennar shares, they're down 4.8%. Among peers, D.R. Horton down 2.2%. Pulte Home down 1.5%. Toll Brothers, the luxury home builder, up now by just about 0.5%. First day of trading for Medline, shares are up by 32%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Carol Master, Tim Stanovic, live here at Bloomberg headquarters in New York City. Now, many, including those that are wealthy, are concerned about some of the priorities of incoming New York City Mayor Zohran Mamdani. Now, weighing on this was one billionaire who does not call New York City home. We're talking about Citadel founder Ken Griffin. He talked about the city yesterday at a conference in Paris.
I think that New York City is a red flag because people put aside good sense and common sense to elect somebody who is incredibly charismatic, who ran a really powerful campaign on social media, but who ultimately doesn't have the ability to deliver on the promises that he set forth. New York took a big step back during the de Blasio days, and I hope that Mamdani starts to think about how to pivot to a more thoughtful set of policies that will allow New York City to maintain its position not only as one of the greatest cities in America, but one of the greatest cities in the world.
And that, of course, was Citadel founder Ken Griffin there with Danny Berger of Bloomberg News. We want to get into our guest, Kathy Wild. She is president and CEO, outgoing president and CEO of the Partnership for New York City, which represents much of the city's corporate leadership. So we're talking about real estate developers, private equity firms, banks, many, many companies. Bloomberg LP, by the way, is a member of the Partnership for New York City. She is also, though, part of New York City Mayor-elect Zohran Mamdani's transition team, and we have a lot of questions to ask her. Also with us is, of course, Bloomberg News senior reporter Miles Miller, all of us here in studio. I told you, as you sat down, that we have about an hour of questions. So we're going to start and cover.
We'll talk fast.
We will talk fast. Why did you want to be a part of the transition team for the mayor-elect of New York City?
Well, I think to the point that Ken Griffin of Citadel just made, and he's one of our members as well, and is a great corporate citizen of New York and Miami. He made the point about the concerns about the high expectations that Mayor-elect Mamdani gave to his voters, and he, to his credit, brought out 170,000 new voters, mostly young people in the primary. The cutoff age for his voter support was 45. So many of us are beyond that point and looking around and saying, oh dear, does he have the seasoning to be able to do this? And I think that he's got the energy and the intelligence, and it's up to all of us who have a little more seasoning to be helpful. And so that's why I joined the transition team and was happy to do that. And I'm working on the economic development workforce activities there. But in general, I think working with him to capture the enthusiasm and the energy. We came out of the pandemic very negative.
Yeah.
And we lost 1 million jobs, and then concerns about the cuts from the federal government on entitlement programs, whether it's Medicaid and health insurance, that is the fight going on now. This casts a real pall over New York City, which is very dependent on those funds. So I think that what he's brought is a positive energy, and we ought to capitalize on that, and hopefully he'll be the best marketer this city has ever had.
Your role on the transition team, does it turn into a full-time job? in the Mamdani administration?
I am definitely not at my age looking for a full-time job. I'm trying to get away from a full-time job.
Right now you have more than a full-time job because you're outgoing president of the partnership.
I am outgoing, and I do not plan to take another job, but I do plan to help the new mayor if he wants it.
So beyond the transition period, you would stay on as an advisor?
Well, I don't know. I don't know in what capacity. As I say, I'm there. I'm certainly going to help Governor Hochul deal with her challenges. I've worked closely with her. She's done a great job, and I think we're counting on her to continue to manage New York's relationship with Washington and the relationship between the state and the city, which is very important. Our affordability problems will not get solved by the city alone. This is going to take federal, state, city cooperation. And so I think all of us who are committed to New York City in the future, we have to be thinking of all three levels of government and how we work with the leadership at all levels.
You brought Mamdani to meet with business leaders on several occasions. I wonder if you can talk about what his demeanor is in these meetings, right? I've talked to Bill de Blasio about, how he works a room, how Mamdani works a room and really gets the business community to be comfortable around him, but also talk about some of these policy proposals that business leaders wanted answers to. What are the things that business leaders said to him? Well, that sounds like a lofty thing that won't get done, or, hey, that sounds like something that is much more than we're willing to back.
Well, there's been quite an evolution since he won the primary. So in terms of his having a more nuanced position on a lot of the policies, during the primary campaign, there were a whole slew of candidates and everything was one-liners. And the social media stuff was one-liners or, show and tell. When you get into conversation with CEOs, they want to hear data, they want to hear facts. And I have watched him evolve and grow over the last 8 months, where we had conversations last week, one on housing, one on childcare, where he was there with a pen and a notebook, taking notes, asking questions, and coming back with very substantive responses. So he has absorbed a lot and is now digging deep on these issues that, Ken Griffin expressed concern about the fact that he made a lot, raised a lot of expectations, created a lot of idealistic notions about housing and childcare and how we can do all this for free. I think he's very quickly figuring out none of this is free. Raising taxes creates real issues. You may raise the rates of taxes, but that may not result in more revenues if you scare people away, or if you scare companies away, or as we've seen lately, we're seeing a real threat to jobs in New York. We, for the first time in my experience over 50 years, are seeing a decline in the number of jobs in our financial services industry. Scary thing, that's 40% of our state income tax revenues. These are, we've got to pay attention, and I think he gets that. But we've got to be at the table discussing these issues and helping figure out how do employers help solve the child care problem.
Kathy, one of the things I think about, and I remember, being at Milken years ago and talking with very wealthy investors who said, yeah, it's about time we pay more taxes. So what is the balance? And I am curious, among those folks that you talk to who are very wealthy, and a lot of times their wealth is not in income, it's assets and it's investment gains. What do they think, though, should be maybe more of their contribution? And I know they often contribute in philanthropy and so on. I know that. But I'm just curious, what is the balance of willing to pay more? When, again, I've had side conversations with folks who are surprised that they aren't paying more in taxes.
So what I've found, and for somebody who's upper income, earned income in New York, which is our biggest taxpayers, we're paying 55% of our income to the federal, state, and city government, if you all in. So we're paying more than half my paycheck goes to the federal government. So it's not like we're getting away with something. For the very wealthy who are capital gains, et cetera, the big problem there is if they move their legal residence out of New York City, we don't share or get taxes. They aren't taxed here on the basis of their global income, and so we may get a piece of their paycheck, but not their wealth.
Right.
And that's a big question. It is. But what I found is over many years, when business leaders and the big taxpayers are at the table, and they see that, number one, government is doing what they can to figure out how do we offer the most efficient, the most effective services at the lowest cost possible? How do we make government more efficient on the one hand? Then you begin to narrow, so what's the delta in terms of what do we need to raise revenues for? So for example, when Dick Ravitch in 2007 for Governor Patterson led the effort to figure out how are we going to pay to upgrade our subways, which were falling apart. We supported, and the business community supported, creating a payroll mobility tax, where a portion of payrolls of corporations, employers who were in the metropolitan region would go to that. 82% of the employees who work for our companies based in Manhattan take the public transit to get here. That was something everybody signed off on. We supported an increase in that tax twice. Same thing with congestion pricing. We supported congestion pricing. Obviously, a user fee where you get something, reduced congestion, more time in your day is easier to sell. So it is not, and actually when Mike Bloomberg was elected mayor right after 9/11, the city had to raise real estate taxes in order to rebuild and recover from the 9/11 shock. We supported that 18% tax increase in real estate taxes. So it's not that we're anti all taxes.
Yeah.
Is government doing what they can to keep costs down, to be responsible in what they're spending, and then what is the contribution and how do we make it that makes the most sense, gets the most bang for the buck?
Just very briefly, because you spent such a big part of your career working on affordable housing, I'm wondering if the mayor is sticking to freezing rent as his solution for affordability, because not one person that we have spoken to over the last few months thinks that not increasing supply and rather freezing rent is the right way to approach the affordability crisis with housing.
Well, the new mayor is very well aware that those are not mutually exclusive options, and that if there's no economic return, nobody's going to build housing. He's figured that out. So he has said really since pre-primary that he understood the private sector had an important role in the supply side, and he was going to work on that. So I think that, again, his view is much more nuanced when he says, now when he talks about freezing the rent, he says, and one thing that will enable us to do that is if we do reduce property taxes on rent-stabilized, regulated buildings. So he gets it. He can add and subtract.
So can you come back?
You said we had an hour. We had an hour's worth of questions.
Barely scratched the surface, but we so appreciate it. Kathy, thank you. Good luck.
Thanks for having me.
Kathy Wild, President and CEO, outgoing President and CEO of the Partnership for New York City, part of the transition team of the New York City Mayor-elect, and of course our Bloomberg News senior reporter, Miles Miller. This is Bloomberg.
Street. We do check markets all day long here at Bloomberg with the Dow, the S&P, NASDAQ, all in the red. Volatility lashing Wall Street, pushing high valuation tech shares and crypto lower. Here's where we stand. The NASDAQ 100 index right now is down by 413 points. On that index, a decline now of 1.6%. Keeping it all in context, the S&P is down 0.9%, NASDAQ down 1.5%, Dow Industrials down 141, a decline there of 0.3%. The 10-year currently yielding 4.14%, with the 2-year 3.48%. Gold is up 0.9%, 43.38 the ounce, and West Texas Intermediate crude up 1.4%, 56.05 a barrel on WTI. Warner Brothers Discovery, the parent of HBO and CNN, now advising its shareholders to reject that hostile takeover bid by Paramount Skydance in favor of its original agreement with streaming giant Netflix, deeming the Paramount offer inferior and inadequate. Shares of Warner Brothers Discovery today, right now they are trading lower by 2%. Netflix up 0.8%. Paramount Skydance down by 4.3%. First day of trading for Medline. Medline shares right now advancing by 30.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pallett, and that is a Bloomberg Business Flash.
All right, everybody, another IPO getting it in just under the deadline of 2025. I mean, the end of the year. It's the biggest initial public offering of this year. We're talking about Medline. It makes and distributes medical supplies such as gloves, gowns, exam tables. You've all worn them probably at one time or another. It's used by hospitals and doctors. I mean, it's just kind of like plain vanilla in terms of a company.
Yeah, but this one is widely anticipated. The stock just surging in its first day of trading. It was up earlier more than 20%. Carol, now 31% higher.
Yeah. Just out of the gates, here. So we wanted to talk a little bit about it. There you can see the real trade, 32% to the upside. Bloomberg News equities reporter Natalia Kenijevic is with us. Why were investors just so interested in this IPO? I mean, it was oversubscribed, according to those in the know, many times over.
Exactly. I think like every IPO, most of IPOs are oversubscribed, but this one in particular shows that investors really want to see established businesses with clear profitability. Of course, it is a profitable business. It's been here for a while. The company was founded in 1966. So yes, it was oversubscribed. Demand was really strong across long-only investors as well. And the company marketed shares between $26 and $30, priced at $29. Now it is trading at $37. It is a pretty successful story.
Yeah, and a lot of big-name Wall Street firms, private equity investors involved in this one. The backers and firms who were involved, it's pretty much everybody.
Exactly, yes. And this is also a very good signal for 2026 because many people expect more private equity-backed companies going public. Again, of course, it depends on stock market volatility and other factors, but this is a very good signal for the stock market and IPO for 2026.
You know who hopes that those PE firms go public? Private equity firms, right? Because they have been trying to exit for a while. Natalia's staying with us. Let's bring in Mike Bellin. He's the U.S. IPO leader at PwC. He joins us from Denver. Mike, good to have you here. The IPO year overall, give us some numbers, how we're ending up and how it compares to years past, because I think the peaks were back in, 2020, 2021, back in the pandemic days.
Yeah, well, thanks for having me. And I would say 2025 was the first true reopening of the IPO window in several years, but it was a selective one. Year to date, we've seen about 75 IPOs, including the one you were just talking about. That sounds good compared to the 62, 35, and 28 IPOs that we've seen in 24, 23, and 22 respectively, but a good IPO year in the U.S. is anywhere between 100 and 150 IPOs, so we're well behind that, but overall, 2025, we've been largely in line with expectations, and in some areas, it's exceeded them. We've seen activity spread across sectors rather than concentrated in just one area. That kind of dispersion is a strong sign and speaks to improving investor confidence. I would say the performance has been differentiated. Higher quality companies like the one you're just talking about with strong fundamentals, solid revenue growth, path to profitable or a path to profitability, reasonable leverage, and a compelling long-term story have generally performed well in this market. On the flip side, IPOs with higher debt loads, more aggressive pricing. They've struggled in this market, especially in a volatile macro environment. So that outcome has not been surprising, but it reinforced how selective investors are right now.
Okay, Mike. Everyone just wants to talk about with regard to 2026, SpaceX, and what that IPO could look like if the company decides to go public next year. Does that make or break 2026?
Well, look, I think when you look at the IPO pipeline for 2026, we see over 200 potential issuers in line that could go public in 2026. The SEC shutdown that took place in October, November pushed a lot of companies that may have had the opportunity to issue in 25 into 26. So number one, I think there's a deep pipeline of quality companies that are looking to go in addition to some of the big names.
For example?
I think we read them all in the headlines. Some of the hyperscalers that are out there supporting the strong markets. In addition to those, there's a lot of PE-backed companies that the one today they got a lot of attention. They priced well. They're trading well, as you noted. And I think the backlog of PE-backed companies, sponsor-backed companies in the market is as stronger than ever. They have been a quieter part of the IPO cohort for the last couple of years. So I think 2026 is ripe for strong sponsor-backed companies that have been creating value in the background through M&A, through scaling, et cetera. So I think we'll have a very active IPO market in 2026.
Mike, if we look at performance of IPOs in 2025, it was really mixed. And overall, people think that AI names or crypto names have the biggest kind of, the best case for success. For 2026, what kinds of sectors you think would benefit, where you see the biggest potential? If we set aside some fundamentals or leverage, like where do you think investors should focus on?
I think it's going to be pretty wide sector representation in 2026. You mentioned AI. I think that entire ecosystem, despite the last few weeks or a month where there's been some pressure against it, there's a deep pipeline of strong companies in that area, from a data center, from a fiber perspective, and then just broader, the energy ecosystem that's required to power the data centers, and we need to catch up in that area. I think that's going to be very active as we look to 2026. Insurance was an active asset in 2025. Dependable cash flows, which investors like in a volatile market. We'll continue to see strong performing cash generating companies like an insurance company go well. And then I think other areas you mentioned, crypto, fintech, with the rise of digital assets and some healthy regulation, the tailwinds in that sector, we expect that to continue to move forward a lot. So again, I think it's going to be a broad sector representation, which to me represents a really strong IPO market.
All right, so strong IPO market maybe to come in 2026. I looked at the IPO index, and I think it was up 5, 6, 7%. I mean, it's definitely underperforming the broader market. I mean, we had dismal debuts of StubHub, Navin, Gemini Space Station, and so they have all contributed to IPOs underperforming as an asset class, certainly compared to something like the S&P 500. It kind of sits with the notion that companies that go public are supposed to have cheaper valuations than their listed peers. Getting pricing, Mike, will be key in 2026?
I'm with you. When you look at the cohort of 2025, about 50% of the IPOs priced at the top end or above the range those initially set. So some pretty aggressive pricing there. I think many of the companies that have struggled in 2025 are companies with, debt that's, above 4 times EBITDA leverage, which is tough in a dynamic environment when there is uncertainty still in the marketplace. So I do think companies that are going out in 26 have to be conservative on valuations. They have to look at their debt loads going in. And some of those key metrics that I mentioned earlier around revenue growth, customer growth, some of those key metrics that really show a powerful return will be important. When you look at, again, the cohort of 2025, 65% of the companies that went out had positive cash flows. That's a stark difference than when you back up over the last 5 years. So the quality is definitely being raised.
Hey, Mike, 10 seconds. SpaceX going to happen in the first half of the year. Do we even know? Have we heard anything? Do you hear anything? Real quickly.
I see the same things you see in the headlines. I think 26 will continue to be an exciting year, and hopefully we'll see some really big names go.
Mike Bellin, U.S. IPO leader over at PwC. Bloomberg News equities reporter Natalia Kinijevic, thank you so much. Happy birthday, too.
Thank you.
All right, we're coming back. Stocks on the move.
is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we're coming up on the last hour of trading on this Wednesday. What date is it? December
It's Wednesday.
17th?
Yeah, the 17th. Why?
God, it's just flying, man. Yeah, as we remind everybody, it's the last full week of trading here
I hope you've done your
in
holiday
2025.
shopping.
I've done enough.
Enough. I mean, it's
I'm just saying, I've done enough.
enough. Okay.
Have you done?
Yeah, I think we're good.
Oh, okay.
I think we're good.
Aw.
Thanks to my wife.
Yeah. All right. Quick check on the markets. S&P 500. We're hovering near our lows of the session, everybody. S&P 500 down about 61 points. That's a decline of about 0.9%. Dow off 131 points, just down about 0.25 percentage point. Nasdaq 100. Those tech names really having a tough time getting it going. Overall, that average is down about 1.6%. Tim, 395 points to the downside.
Well, a lot of stocks are making big moves. Let's take a look at some stocks on the move today. I'm Tim Stenovec, along with Carol Masser. With us is Bloomberg News equities reporter and deputy team leader for U.S. equities, Carmen Reinecke. Carmen, we got to start with the IPO, the big one today.
Yeah, so Medline, biggest IPO of the year, $6.26 billion is huge. So the stock is, I'm just going to try to calculate it live. The stock is up about 35% right now from its IPO price, is trading at about $39 per share. IPO was $29. So we're seeing, just lots of enthusiasm.
Nice math there, by the way. Well done. Nice math.
Oh, well, I'm not going to lie. I have a calculator open.
Oh, you did? Okay.
She is a professor.
I prepared.
She made it sound like she was like...
I prepared, but I did not do it in my head.
Okay.
No.
But listen, a good debut, right? Obviously, the pricing was right. Investors were into it on a day where the markets are down. So that's interesting.
Yeah,
right?
very, very solid start from Medline. Should we switch to a part of the market that's not doing so hot today?
Yeah, where do you want to go?
Mostly other stuff.
All right.
Yeah.
Let's look at Oracle. This is ticker ORCL. So shares are down about 5% right now. The most since December 12th, but this is looking like the lowest since June 11th intraday. So there's just been a lot of nervousness around this company, and sort of the latest thing is that it said while final negotiations on a deal for a project in Michigan are on schedule, they don't include Blue Owl Capital, which has been involved in the financing of a lot of other data centers.
It's a longtime partner of Oracle, so it's interesting to see them pull out or pull back.
Yeah, exactly. So shares not looking so great for Oracle. It's had such a long fall, and we're actually watching for it to go negative on the year.
Yeah, it's only up about 7.5%. Go back, a few
go to
months.
September 9th, September 10th.
Right?
It's down more than 40%.
Yeah.
It's really rough. We're next. NVIDIA?
Yeah, so NVIDIA is having a sell-off today as well, about 3.5%, which isn't the biggest number, but this accounts for almost $150 billion of market value. So what we're seeing is that it's probably reacting to news that OpenAI is in discussions to raise at least $10 billion and from Amazon to use its chips. So this just adds some competition to NVIDIA, and it's just we're seeing some broad-based weakness across the AI trade today in general, and NVIDIA is kind of always the leader there.
What's interesting is we're also seeing the companies that have benefited from the AI trade that are not, AI-focused companies.
Exactly.
Like energy providers, builders of data centers, they're taking a big hit today, too.
Yeah, they all are. It's really across the board, even some of the big gainers. So
NVIDIA is down about 17% from late October. I mean, it's still got a decent gain on the year. I mean, it's still up almost 28% to be close to exact, but we've definitely seen a retrenchment in that name. So, I feel like every time we would talk about like competition to NVIDIA, people would be like, there's plenty to go around. There's going to be lots of demand. But I don't know, as you get more players.
I think there's also just so much nervousness right now. And we also just had, the earnings reports from Broadcom that didn't look good. There's Micron tonight. So people are just really watching this space to see what's going to happen next.
All right, you got one more for us?
All right, yes, I have Lennar, ticker LEN. So this is down nearly 5% right now. The company gave a first quarter forecast for orders, deliveries, and margins that all fell below Wall Street expectations. Signals that there's just strains on the housing market in general, even with a lower interest rate. Some of its fourth quarter line items also fell below expectations, including orders and margins.
Yeah, it's dragging down the entire sector, right? We've seen Lennar lower. We got those results after the close. I'm looking at home builders in the S&P 500 Composite Home Building Index. 18 names, 15 are lower, only 3 are higher. Toll Brothers among them, and just slightly higher. Yeah, so we're seeing it just drag down the entire group. Great stuff. Thank you so much. Really appreciate it. Carmen Reinecke there with Stocks on the Move. Be sure to check out our Stock Movers podcast, 5-minute episodes, biggest winners, losers in the stock market, and you can find it on Apple, Spotify, or anywhere you get your podcasts.
Well, Carmen just mentioned Lennar. That's kind of where we're going to start in just a few minutes when Katie Hubbard joins us. She's president of U.S. Capital Markets over at Walton Global. This is a land banker.
Yeah.
They've got land in the U.S. and Canada and other parts, too. And what they do is they sell to the Lennars of the world. So they got a really good idea of demand. We're going to check in with her about what the real estate industry looks like next year.
Well, and I thought it was interesting what Ali McCartney said with us at the top of the hour, or near the top of the hour, about this kind of land grab for data centers and maybe the impact on housing, or whether or not there's a little bit of a battle. So I'm curious to see what she has to say. We're going to get into that. We're also going to remind everybody that Micron reports after the closing bell. We'll be breaking those results.
End of earnings season just before the big banks report in a couple of weeks, when we're going to be back here in 2026.
End one.
Yeah, that's how it goes, Carol Massar.
I love earnings season. What's not to love? All right, folks, if you're watching on TV, the close coming your way in just a moment. Tim and I continuing, though, right here on Bloomberg Business Week Daily.
News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. The son of director Rob Reiner made his first court appearance today as he faces charges of first-degree murder in the killing of his parents. Reporter Amanda Starantino.
Was brief, but it was significant as well. It's the first time the public has seen Nick Reiner since the murders of his parents from over the weekend. And also, he did not enter a plea, and it's going to be pushed to January 7th to give prosecutors more time in what they're calling a very complex case.
The 32-year-old Reiner was wearing a jail suicide prevention smock. The Reiner's other 2 children have issued a statement. It says words cannot even begin to describe the unimaginable pain we are experiencing every moment of the day. They called their parents their best friends. Senate Democrats blasted FCC Chairman Brendan Carr today for pressuring broadcasters to remove Jimmy Kimmel from the air, among other things. Here with Senator Ed Markey.
He is turning the Federal Communications Commission into the Federal Censorship Commission. It's a betrayal of the FCC's mission. You should resign, Mr. Chairman. You are creating a chilling effect. Do you regret
Former Special Counsel Jack Smith appeared in a closed session with lawmakers to talk about his past investigations of the president. Stacey Lynn reports.
The House Judiciary Committee is probing Jack Smith's actions during his time as special counsel during the Biden administration. He led the investigation that resulted in the president being indicted on more than 40 federal charges. The committee claims Smith's prosecutions were politically motivated, but during a closed-door interview on Capitol Hill today, Smith told lawmakers, quote, the basis for those charges rests entirely with President Trump and his actions.
4 moderate Republicans have joined Democrats in the House to force a vote to extend Affordable Care Act subsidies, among them New York's Mike Lawler.
I think everybody recognizes the fact that there needs to be an extension, there needs to be reforms, and we'll see where this goes.
CBS's Nicole Killian.
What remains unclear is if and when this will come up for a vote. Normally with these discharge petitions, because they don't go around the normal process, they do have to sit for a period of 7 legislative days, which means this may not come up for a vote until early January.
The Oscars are moving to YouTube. Matt Wolf reports it's a sign of the times.
Look at everything that Netflix has been doing the last couple of weeks, especially with the moves with Warner Brothers and them taking on big events now and everything. And the Oscars, it shouldn't be as much as a surprise, but it is going to turn a lot of heads.
The show will remain on ABC until 2029. On Wall Street at this hour, stocks are lower. The Dow off 147 points. This is CBS News. worth every penny? You'd have to be a collector or an investor to think so. The very last pennies pressed at U.S. mints have sold for a pretty penny. The Treasury Department has auctioned off 232 sets of 3 coins for a total of $16.76 million. The final set, containing the last 3 pennies ever made after they were discontinued in November, went for the most $800,000. Each is marked with the Greek letter omega, signaling the capstone to a 2-century-long legacy. Deborah Rodriguez, CBS News.
A measles outbreak is growing in South Carolina. Between last Friday and yesterday, there were 27 new cases. More than 250 people are in quarantine. Nationally, measles cases are nearing 2,000. I'm Cammie McCormick, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Massar and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everyone, live on Bloomberg TV, radio, YouTube, and Bloomberg Originals. Well, it depends on how you're watching TV, I guess. It is Bloomberg Business Week Daily. We're in the Bloomberg Interactive Brokers studio in New York. The S&P 500 down right now by 1%. The NASDAQ Composite down by 1.5%. Carol Massar, the Dow down by 0.4%.
Yeah, interesting, right? We're seeing some pressure here, certainly in the market. You dig a little bit deeper into the S&P 500, kind of an even split here, 252 to the upside, 249 to the downside. So there are buyers, there are sellers, but if you look at the major averages, especially when it comes to those tech names, certainly under pressure. We had a lot coming your way in just a couple of hours. We've got Micron earnings after the closing bell, so we'll be breaking that one down, but we're going to talk real estate, which you and I love talking about.
Yeah, Katie Hubbard's going to be joining us in just a few minutes. She's president over at Walton Global. She's president of U.S. Capital Markets. Earnings from Lennar is certainly a part of it. There's a question about affordability next year. Some Bloomberg.
When isn't there ever a question?
Bloomberg has this great story out that says that, they spoke to a bunch of housing economists, and the predictions are we could actually see an affordability increase next year.
So people can go and actually buy.
Home prices will rise, but wages will rise more.
All right, that's interesting, especially when there's some concerns about the labor market.
Ever so slight.
I can't figure out the puzzle yet for 2026. All right, so we're going to get to that. We're also going to talk about planes, trains, and automobiles and EVs.
Yeah.
Kind of?
Okay.
Planes and automobiles.
Yeah, we're going to skip the trains part, but it just sounds too good.
For the moment. Yeah, exactly.
It doesn't have the same ring to it. eVTOLs, too.
We are going to talk. We're going to talk Waymo, some news late last night. We're also going to talk about, are we going to see Frontier and Spirit?
I think many would say the regulatory environment is much more favorable now than it was back in 2022.
They've been trying for a long time.
Yeah, there's a whole timeline
together
in the Bloomberg News piece that we're going to get into.
All right, so we got a lot coming our way.
All that and more up next over the next 2 hours right here on Bloomberg Business Week Daily. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Miller.
Thank you very much. We got 53 minutes to go ahead of the closing bell. Got to begin with Medline because right now it is up by 34.7%. Medline shares surging in their trading debut after the medical supplier raised $6.26 billion in the year's biggest IPO. The company manufactures and distributes medical supplies such as gloves, gowns, and exam tables used by hospitals and doctors. The Dow, the S&P, NASDAQ, they're all lower right now. 1% drop on the S&P, down 66, 67.33 where we stand. Dow Industrials down 178, decline there of 0.4%, while NASDAQ, the composite index, down 354 now. That is a drop of 1.5%. The 10-year, 4.14%. The 2-year, 3.48%. Gold up $33 the ounce, up 0.8%. West Texas Intermediate crude up 1.8%, 56.25 a barrel. And Bitcoin now down 2.3%, 85,763. Bottom line here, volatility lashing Wall Street, pushing high valuation tech shares and crypto lower. Up next for Wall Street, a reading on inflation tomorrow morning when we get the CPI report, 8:30 a.m. Wall Street time. Lindsay Piegza is chief economist at Stifel Nicolaus, and on surveillance this morning, she said no question consumers are feeling the impact of inflation.
Consumers are increasingly bearing this sizable burden as cost increases have just mounted substantially over the past 5 years. We look at food, we look at energy, we look at medical care costs. These are all up double digits in just the last 5 years. Household energy alone up near 40% over the last 5 years.
Lindsay Piegza of Stifel Nicolaus interviewed on surveillance. Briefly, Oracle says final negotiations on an equity deal for a data center project in Michigan are, quote, on schedule and does not include Blue Owl Capital, a firm that has helped finance massive data center projects. Oracle shares today, they're down now by 6.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We'll be back to Charlie a little bit later on. Hey, Bloomberg Business Week is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility of some investors turning to gold for stability. We've seen that trade big time this year. To get a free gold and silver info guide, learn how to add metals to your IRA or 401k tax and penalty free. Just head to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide.
Well, Lennar shares lower today, down right now by 4.8%. This after the home builder reported adjusted earnings per share for the fourth quarter that missed the average analyst estimate. D.R. Horton, Pulte Group, Toll Brothers also lower in after-hours trading.
Yeah, and we're seeing the home builders as a whole. Most names in that index are down today. I'm just looking at the index. It's down about 1.8% in today's session. So that Lennar news, no doubt about it, Tim, definitely dragging down the trade.
Yeah, so that was the write-up last night, like down in after hours. Down today, too. Like that continuing into today's trade.
Yeah, totally.
Also, I mentioned this aspiring home buyer should find the U.S. housing market slightly more affordable in 2026, even without the benefit of lower mortgage rates. We're going to bring in Katie Hubbard. She's president of U.S. Capital Markets over at Walton Global. It's the privately owned asset and real estate investment company. More than $4.5 billion of land assets under management and administration, and more than 89,000 acres of land under ownership and management throughout North America. Close to 89% located here in the U.S. Remember, Walton Global, they operate in retail, industrial, and commercial sectors. Katie joins us this afternoon. Katie, good to have you on the program. How are you?
I'm doing well. Thanks. Great to be here.
I don't know if it's too early to say Happy New Year.
Happy New Year.
At this point.
Never too early.
Happy New Year.
Okay.
Happy New Year.
You know, so the first question I always like to ask you is like, are things better or worse than we last spoke to you? In terms of, you know, and we do get to check in with you every couple months, and we're grateful you take the time to do that. Are they better in your world than they were a couple months ago?
Yeah, speaking of, Lennar's earnings that you guys opened up with, I mean, the market read their headline financials as a profit and margin miss, although they have a revenue beat. And as you saw, their stock dropped 5%. And the demand is there. So are things better or worse? The demand is still there, but while at a much lower profitability. And as we see from their earnings, their Q4 earnings came in at $490 million. And same quarter last year, they were at $1.1 billion. However, they delivered more homes this year. And the reason that their earnings are down so much is because they are having to offer major incentives. So are things better? It's really the same, where in order to get the volume for the top builders, they're having to offer incentives and drop their prices.
So, okay. So what does that mean then? I don't know. How do you describe then the housing market? Is it good? Is it bad? Is it still kind of trying to find its way, struggling a little bit?
Yeah, I mean, the overall fundamentals are there where people want to own homes and demand is there. So the builders that are able to meet buyers where they're at and offer the incentives, the mortgage rate buy downs, building smaller homes, they're doing fine. So the housing market's doing well there. However, it's an affordability constraint problem right now. As Lennar talked about quite a bit on their earnings call, affordability is the challenge. The mortgage payment for people has increased 82% since 2020, while income's only up 26%. So people are really sensitive to those monthly payments. And if the builders can get those down, then they're doing fine and they're able to sell the homes. On the resale market, 75% of mortgages are still locked in at 5% or lower.
Well, Katie,
40% of people.
That's where I have a hard time. Like, I have family members, and I remember working with someone who's like, listen, I remember the 70s, and my mortgage rate, it was like a 17%, something high. I have a sister who often talks about, like, her first mortgage in the teens. So what's different? Because it is still
It's the
historically low. Huh, okay.
Income has not kept up with that.
And everything else has gotten more expensive too. Like if you were to look at the cost of healthcare back then, the cost of educating or paying student loans, or like what it costs to actually get a 4-year degree, all those costs have gone up too.
Exactly. So it's really affordability, where people are spending 40% of their income on their mortgage payments, and it's keeping a lot of people out of the market. If we could get rates to 5%, that would mean an additional 8 million people could afford a $400,000 house, which is just about what the average of the median new home price is.
Well, what? Who was on our program this week? I don't even want to say a name because I don't want to get it wrong, but we were talking about high prices. An economist said, well, we like to hear about high prices because then it'll bring in more people into the market. And Mike McGlone of Bloomberg Intelligence always likes to say the cure for high prices is high prices, but that's not necessarily the case when it comes to homes.
Right? Like Uber, the whole metric is when prices start to go up for rides, right? You bring more drivers into the market.
Yeah,
like it's that concept kind of ish.
But the problem is in real estate, and Katie, you can, correct me where I'm wrong, it's such a local issue that has to do with zoning, it has to do with finding people to actually do the building, it has to do with materials costs. I mean, if housing, if we have such a shortage, why isn't it being solved by the free market?
And so what is happening is people are moving to secondary markets, and builders are moving to secondary markets. So if you're in Austin, you're going to San Antonio. If you're in Denver, you might go to Colorado Springs. You're in San Francisco, you'll go to Sacramento, because the housing is significantly cheaper there. And so that is one of the solutions, is to go further out. And so it's not like the end-all solution, but going to where the governments are pro-development and houses are more affordable is making it more palpable for some people to be able to buy homes.
Katie, one of the things I wanted to ask you, and Allie McCartney, who we just had on over at Alignment Partners at UBS, she talked about kind of the land grab for data centers versus, I think, home builders. Is that part of the problem, part of the issue?
I would not say that's really an issue, because in order to have land for a data center, you have to have a significant size of land, but you also have to have extreme amount of energy and a substantial amount of water, which most people don't think about. So to find the land that fits the data center model, that has the energy and the water, and is far enough that you're not going to have the NIMBY mentality that they don't want the data centers, it's a limited, there's limited resources for data center sites. Walton has some sites that are allocated for data centers, but it's not really the same land that would necessarily be alternatively for residential housing.
That's a good thing.
Well, open the door though. So the land demand for data centers, is there any kind of trailing off or weakness that you're seeing?
No, we are getting calls every day from people that are wanting to look at the land that we have earmarked for data centers. So I think the demand is there, whether it's, a bubble and what we're going to see from the fallout of that. There is definitely the demand for the land is there, because it takes a long time to get the zoning and the infrastructure in place, the local government, municipalities, utilities, everything in line. That can take years. So people that are starting now are not going to have data centers on those sites for, probably 4+ years.
Wow.
If you can get them hooked up to the grid.
If you can get it, yeah.
That's the key.
Well, it might take 4 years to build out the grid and have the power there.
Or they could be done and just sitting there like those in Silicon Valley.
Unbelievable.
Yeah.
Katie, always get some insight when you join us. Thank you so much. Happy holidays, Happy New Year, and look forward to continuing our conversations with you into 2026. Katie Hubbard, President of U.S. Capital Markets over at Walton Global.
I'm looking at shares of NVIDIA down more than 3% right now, trying to drag in mega caps lower, down more than 17% from those all-time highs back in October.
Yeah, there's definitely been kind of a rewrite when it comes to some of these AI plays. Don't go anywhere. This is Bloomberg Business Week Daily.
Street. We do check markets all day long here at Bloomberg with the Dow, the S&P, NASDAQ all in the red. 39 minutes to go ahead of the closing bell. S&P down 63 at 67.37, drop there of 0.9%. The Dow down 151, drop there of 0.3%. NASDAQ down 343, a decline of 1.5%. 10-year at 4.15%, the 2-year 3.48%. Gold up $38 the ounce, 43.41 on the precious metal, up 0.9%. West Texas Intermediate crude oil up 2.1%, 56.45 a barrel. And Bitcoin now down by 1.8%, 86,171 on Bitcoin. The Russell 2000 index of small cap shares currently trading lower by 0.9%. Victoria Fernandez is chief market strategist at Crossmark Global, and on Bloomberg Intelligence, she told us she would like to see a pickup in small cap earnings.
We like to see the breadth open up. We like to see small caps do well. Obviously, it's positive for the economy. What we need to watch for, though, is earnings for small caps. They have not been producing on the earnings side, and so you're not going to get these positive movements in pricing really sustained unless they can support it with earnings.
Victoria Fernandez of Crossmark. Speaking of earnings, Micron Technology reports after the close of trading. Micron right now ahead of earnings, down 2.6%. Last week, you'll recall, we saw dual disappointments from Oracle and Broadcom, which sent both stocks tumbling 11% in a single session. Oracle right now down 5.6%. And also, we've got shares of Broadcom trading lower by 4.1%. Again, Micron, the big event after the close of trading. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Well, the queue for power-intensive customers looking to tap into New York's energy grid has surged as the boom for AI and growth in large-scale manufacturing has driven demand for electricity. You remember earlier this week, Carol?
Mm-hmm.
National Grid New York President Sally
interview.
Librera was on with us. That was a great chat.
It was.
She said that so-called large load connection requests over the next 5 years has jumped 10 gigawatts, tripling in just a year. Here's what she told us on Monday.
New York is also very attractive to manufacturing, and large-scale manufacturing, particularly some of the modern manufacturing we see around semiconductors and computer components, it's very energy intensive, and companies with big power needs are drawn to New York, and we are working to make sure that they have the power that they need, not just today, but well into the future.
That was National Grid New York President Sally Librera on our show on Monday. Curious what Neil Chatterjee is seeing. He's the Chief of Government Affairs over at Palmetto. It calls itself a, quote, energy marketplace dedicated to accelerating the transition to a clean energy future. He's also a former commissioner and chairman of the Federal Energy Regulatory Commission. That was during the first Trump term, but you were also a member, it went into Biden's term as well, just for a few months. That's when you're...
I mean, just for clarification, the Federal Energy Regulatory Commission, or FERC, is an independent agency. Its commissioners are appointed to staggered 5-year terms. The idea being you can outlast the president.
Well, there are a lot of independent agencies right now that are looking less and less independent, I think is fair to say.
Yeah, FERC's been pretty good.
Has it?
And I think it's actually been a beacon of stability in an otherwise volatile regulatory landscape.
Why? Okay, so we're going to talk about what you're doing at Palmetto in just a minute. But first, I want to talk about the affordability issue here, because for so many years, we thought that in the U.S., power demand would kind of just be stable. And then this whole AI thing happened. Data centers started getting built. People started buying EVs. Now demand is just going up and up, and it's hitting customers' wallets, and affordability is becoming a big issue. How do you view it?
Yeah, no question. So we have been the beneficiaries in the U.S. of a period of relatively flat demand for about 2 decades. And unfortunately, what happened was during the course of that 2 decades, we allowed politics to interfere with what otherwise had been the dominion of engineers and economists.
How so? What do you mean?
So suddenly, complex decisions around plant retirements and things like resource adequacy that used to be made by engineers were being made by politicians. And you had celebrities weighing in on their preferred sources of fuel, whether it's Billy Bob Thornton for Landman, or, I mean, obviously that's more recent, but, you know, I'm using that to be illustrative, or others who were saying we want to see the retirement of fossil generation.
And nuclear, too, was a few years ago, you had celebrities, a lot of celebrities weighing in on nuclear
One way or the
too.
other,
Yeah.
right? And so, to me, we need to get back to a place where we focus on what will it take to make sure that the lights stay on and they're affordable for Americans.
Yeah, but, you know, to that point, I mean, I want to throw in climate change is a real thing. And so you've got to think about what are the best energy policies while making sure that, you know, Mother Earth is here in 50 years. And, you know, we've all seen the fires, the climate adjustments that we're making. We're living increasingly in a tougher environment. So I do wonder, you know, how, you know, if we just go to the lowest power source, that's not necessarily going to be good for life on Earth. So, like, what is the balance? How do we move forward? Because we have an administration that's turning its back in a big way on renewables. And so I just do wonder, how do we find the right policy going forward?
Yeah, I love that question. And I want to be clear from the onset. I'm a Republican from Kentucky who worked for Mitch McConnell and was appointed chairman of FERC by Donald Trump. I made very clear from the moment I had a platform of my own that I believed that climate change was real, that man had a significant impact, and that we needed to take steps to mitigate emissions. And so why I am actually optimistic about the current scenario that we are in is we've got kind of locked into this antiquated notion the last 15, 20 years or so that if you're for fossil fuels, you're the political right, and if you're for clean energy and climate solutions, you're the political left. AI, data centers, streaming services, crypto, Bitcoin mining, vehicle electrification, building electrification, all these things that are going to put intense pressure on the grid, it's going to require every available electron.
Even wind?
Wind, solar, storage, geothermal, nuclear. Beyond that, negawatts. Have you all ever heard this term? Negawatts.
No, but I'm guessing it's big.
Demand response, energy efficiency, virtual power plants, grid enhancing technologies. I don't want to bore your listeners to death, but things like dynamic line ratings, which enable us to get maximum efficiency for existing clean energy infrastructure. This is all cool stuff.
So negawatts is the idea to shift the focus from producing more energy to using less.
To using it more efficiently.
Or using less.
Or using, sorry, I want to be very clear.
Yeah.
We're going to need a tremendous amount of energy to meet this coming surge in demand. We need every available electron. I was frustrated with the Biden administration because I thought they took steps, including my former colleagues at FERC, to suppress capacity prices, to accelerate the retirement of certain older forms of fossil generation. I thought that was bad policy. I am not happy that the Trump administration is blocking clean energy deployment. Both strategies frustrate me. We need all the electrons and to preserve the ones that
Okay, don't judge me. Cole?
So, look, in the grand scheme of things, and I'm from Kentucky, right? I grew up in Kentucky. I understand the pain that people in coal communities feel. There may be steps that the administration's taking, and they are taking, to keep existing coal-fired generation online a little bit longer than it otherwise would have. But it's not additive. It's just keeping. It doesn't get us the new electrons. The new electrons, I'm telling you right now, if I could tattoo it onto my arm, I would. Solar plus storage with gas peakers to balance the grid.
Why not wind also?
Wind is there. I just don't think it's as deployable as solar. So you mentioned at the onset, you know, I'm at this residential rooftop clean tech company, Palmetto now. I think there's a huge opportunity in residential rooftop solar because we offer the alternative to folks who are concerned about higher electricity bills. It's quicker, it's easier to deploy, it's financeable. Wind is expensive, and that's the challenge.
Well, let's talk about Palmetto, because my understanding is that it's much more than just rooftop solar. It's this whole platform for clean energy, and I think people have a hard time understanding even where their energy comes from, and the grid versus the two, the delivery charge versus the actual electricity charge on a bill. How does Palmetto fit into all this?
Yeah, look, nobody thinks about this, right?
We do now.
We do now.
When we get the bills every month.
We hit the switch and the lights come on. What attracted me to Palmetto as a conservative from Kentucky, as I mentioned, was this is the future, in my view. You've got your phone right there. There's so much information available through software and platforms and the ability to track our energy consumption and utilization. By moving to solar plus storage and smart plugs and HVAC and other clean energy, advances that enable us to, not just bring down the cost of our bills, but to enhance our quality of living. And oh, by the way, it happens to benefit the environment, but that's not the selling point. The selling point is, quite frankly, the economic one. We save you money. Yeah, we help the environment in the long run, but the bottom line is, the reason I went to Palmetto is the business case, not the environmental.
So make the business case. Tell us about, give us some, we're Bloomberg, so give us some of the financials in terms of people you've signed up, people that, just give us some idea of the growth, the interest.
I think generally, as an American, I don't like high electricity prices. I don't. It's uncomfortable. As a regulator who is responsible for monitoring the reliability of the grid, it was hard for me when prices went up because I had to balance the interest between maintaining reliability and controlling consumer costs. I love the idea that consumers now have an alternative option, that they can turn to residential rooftop solar and storage and smart plugs and these alternatives. And I do think, unfortunately, because of this coming surge in demand that the country is going to see from all of the variables that I laid out earlier, prices are going to continue to tick up. And I think more and more you're going to see consumers saying, hey, I don't want to be paying a bill to my monopoly utility.
They said that in November.
Well, yeah, listen.
In terms of affordability.
Yeah. I mean, we've made some adjustments because we had an $800 a month power bill, and it was kind of crazy.
What did you do? Did it work though?
Turned off a heated floor. We made some changes because it was ridiculous.
And it came down?
I think we're working on it.
Yeah, it's hard, but it's hard to control that.
But so again, your company, give us an idea. Customers, growth, profitability.
All of the above, because the demand is
What's the growth?
There.
What's the growth of customer and your top line?
I'm the policy guy, so there are others who are smarter about this kind of thing and should be on this program. What I can say is that there was a existential threat to the business in the OBBBA, the One Big Beautiful Bill Act, and we were able to beat it back. Yeah. And we had conservatives. If you had asked me at the beginning of this process to rank 100 United States senators on who might come to the rescue of residential rooftop solar, I would have probably at the onset put Ted Cruz of Texas in the bottom 5. Ted Cruz stepped up and fought for
He saw what happened to Texas's grid a few years
ago.
He
understood it, and he understood this as populist.
Neil, we got to run. Come back soon. Neil Chatterjee. This is
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower across the board. This Bloomberg Business Flash is brought to you by the Jewish Communal Fund. New tax laws take effect in 2026, reducing some charitable deductions benefits. Open your JCF Donor Advised Fund now to maximize tax savings. Call 212-752-8277. Now, let's head over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks are under pressure from the start today as Oracle rattled the markets. The Dow's currently down 200 points. S&Ps are down 1%, and the NASDAQ, that's lower by 1.6%. The U.S. 10-year is at 4.15. Gold and oil are in the green, and Bitcoin, that's down by 2%. Among the main 11 S&P sectors, leaders were energy and materials, tech and telecom were under pressure, and leaders to the upside in the Dow, Salesforce and Procter & Gamble, while Caterpillar fell 5% and led to the downside. In the tech space, Oracle fell as much as 6.1% on a report that Blue Owl Capital will not back a $10 billion deal for Oracle's next data center. And regarding IPOs, Medline opened at 35, was priced at 29. Wrapping things up, Micron reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Daddy, can I drive?
Yeah, sure, why not?
Do I look like I drive a minivan?
Shut up and drive.
Don't drive angry. Don't drive angry.
I'll drive. Shotgun.
This is the drive to the close.
If you had access to a car like this, would you take it back right away?
On Bloomberg Radio.
All right, everybody, we are just about 18 minutes away from the closing bell on this Wednesday. Happy Hump Day, everybody.
I thought, for like a few hours this morning, I thought it was Thursday.
And then you were like, it ain't.
It's fine. Our Thursday is going to be very busy.
It's going to be a really busy day.
Yeah.
And, I look at the market averages and just kind of bouncing around our lows. We're just about at our lows of the session. So down about 1% on the S&P 500, NASDAQ 100 down 1.6%. So we continue to see some pressure here in the markets, although we keep reminding you as you dig a little bit deeper. Let me just pull it up here and just see the split on the S&P 500. You still have 260 names to the upside, 241 to the downside, 2 unchanged. So
I like that screen. What is that custom screen you have?
You
have some great.
It's an NW screen that I made years ago.
Carol's got like the best Bloomberg Launchpad screens.
We used to put this on air, and I would do a market
cool.
hit, and I I would go through all the markets. I love it.
I'm gonna connect with
pictures.
you later and figure out how I can get those screens.
It's gonna cost you.
Okay. Hey, you're talking equities. I want to talk fixed income with Karen Vera Perry. She's head of U.S. iShares fixed income strategy at BlackRock. She joins us this afternoon. Karen, I want to know what you're seeing in terms of flows. Like, what are investors buying right now? What are they selling right now?
We've seen just a record-breaking year in terms of fixed income flows, particularly in the ETF market. I think a lot of people are getting ready for year-end, and they're doing some slight repositioning. We've seen a big interest continue within income-focused asset classes, so that includes emerging markets, high yield. We've seen people just looking across more securitized assets. And in general, we've been talking to institutional investors who've been slowly adding more duration to portfolios. So we're seeing just broad market treasury allocations and people actually adding into longer duration treasuries and even munis this week.
Ooh, Karen, how much further are they going out in terms of duration?
Well, we've seen the average portfolio was maybe at like a 4 to a 5.
Okay.
If you look at the aggregate and some of the other major indices around 6.2. So we are seeing some people doing a little barbelling where they're adding more like 20 plus treasuries, but I think most people are getting their durations back in that 5 to 6 range.
What about munis?
Munis have been a kind of an asset class that have really come back at the end of this year. I think people were really light on their muni allocations. We've seen some tax trades coming back in, but I think the best bang for your buck right now is actually long duration munis. You're getting a lot of yield pickup because that muni curve is pretty steep. And so we're seeing people typically stick to their home states, but I think national munis have gotten some love this week as people are looking to add some more.
So talk to me about, I want to go back to, what we saw in fixed income 2025, according to some of the notes that you shared with our team, we're talking about global bond ETF year-to-date flows, $621 billion. And that's a record. U.S. bond ETF year-to-date flows, $408 billion, excuse me, I think I'm reading this right. That's up from the record set in 2024 of $291 billion. I mean, these are big, big jumps. Do we see this kind of flow? Are you anticipating next year? And if so, why?
I think we are. I think we're going to keep up this trend for a couple different reasons. I think people have recognized the ETF wrapper, low cost, transparent, efficient, which is even more important in fixed income, which can be kind of an opaque market. I think there's a lot of exposures, whether you're looking at index or active. So people are building very customized portfolios, but at the same time, they can tap into their favorite active managers. So I think we're seeing this trend continue just as people are looking to that ETF as their one-size-fits-all solution. We also conducted a recent People and Money survey, and there's about 22 million Americans who are currently using ETFs inside their portfolios, and we expect another 19 million in the coming years to start using ETFs. And they kind of get started maybe with some of the big equity asset classes, and then slowly they move into fixed income over time as they get more comfortable managing their portfolios. So we see this trend, staying on the next couple of years.
The S&P 500 up 14.5% this year. Last year's up more than 23%. 2023 was up 24%. 2022 was down 20%. But given the gains that we've seen over the last few years, is it hard to attract money to fixed income, especially with older demographics who should have more in fixed income because the S&P 500 has just performed so well?
I think a lot of people are still looking to balance out those portfolios because they're worried. A lot of the people that we hear are worried about getting in at the top of the market, so they don't want to get in at the top, but then we keep reaching new highs. I think there's about $8 trillion sitting in money market assets that need to move out of cash and move into fixed income. So we're actually predicting that's really where a lot of the rotation is going to come from. People are not going to abandon equities, but they're going to, put their cash to work and step out of cash and add some duration to that.
Or possibly keep it in cash. I mean, we always, investors keep, to be fair, investors keep a big chunk of money. I know, but they still keep but it's very liquid, right? And they keep a chunk of money in cash no matter what cycle. Rainy day. Right, Karen? I mean, right, that's fair, Karen.
A few $1 trillion for a rainy day.
Just saying,
$5
keep
trillion.
waiting for this money. But I'm just saying, right, for a rainy day. Like, people keep investors, smart investors, keep a lot of money basically in cash or cash-like investments.
The way I would think about it is cash has done really well, but it's coming down. So we're thinking the Fed could cut another 1 or 2 times in 2026. That would bring your cash rates to 3% or less. If you could, let's say, lock in a bond ladder, doing something with our I-bonds ETFs, SGov, which is our 0 to 3 month Treasuries ETF, has actually been the most popular with over $36 billion of flows. So even just sticking to short-term Treasuries as opposed to even money market funds has a spread to it. So I think we would just ask investors, think about what's the purpose of that cash. If you don't really need it over the near term, then adding a little bit of fixed income, adding some duration can actually give you more total return even over the cycle with booming equity markets.
What about active versus passive fixed income?
We've seen active perform pretty well this year. In fact, our iShares Flexible Income ETF, the ticker BINC, has done really well this year. It's allocated to a variety of income-producing sectors. It's up about 7% this year. So I think if you had a fixed income portfolio that was comprised of some core bonds and some income-producing assets that are up pretty well, and I think in general, we've seen active managers doing well this year, albeit because of credit tilts. And then we'll probably continue to see people using index funds for those core low-cost exposures, and then layering in some active managers who can access some asset classes that maybe aren't so easily indexable.
Hey, Karen, just 10 seconds. Based on the flows that you're seeing as we get ready to wrap up a year, how would you describe kind of the market psyche of investors at this point? Are they more upbeat? Are they more cautious? And again, just got about 10 seconds.
Cautiously optimistic and on the hunt to keep those yields high.
All right, going to leave it there. Happy New Year. Have a great holiday. Karen, Vera Perry, she's head of U.S. iShares Fixed Income Strategy at BlackRock, joining us from San Francisco.
On the equity side, I'm on the equity side of things, just looking at the NASDAQ, down 1.5%. The S&P off its worst levels of the day, but still down 0.9%.
All right, folks, we are counting you down to the close. Heading over to our TV colleagues in just a moment. This is Bloomberg Business Week Daily.
This is Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, everybody, we're under 7 minutes to go until we wrap up the trade on this Wednesday. We're going to head over to our TV colleagues in just a moment. We're going to count you down to the closing bell, look at some of the movers. We also have Micron earnings coming out after the closing bell.
Do we?
We
More
do.
earnings. You know,
Are you kidding?
Well, I know, I'm just kidding. I have to correct myself because
what?
Just at our worst levels of the day now on the S&P 500.
Yeah, we've seen
I move away for 1 second and I say we're off our worst levels of the day because that's where we were 30 seconds ago. Now we're at our worst levels.
Just moved down, right, to them. So
yeah,
all right.
Down a little bit of selling.
All right, so we'll see what we get.
No, there's more selling. I'm just watching the tick, tick, tick.
Focus back here.
Is that good radio?
All right, let's get to some stories on our mind as we get to the closing bell.
That's an hour from now, Carol.
This is something a little bit different here. The Oscars show, a little bit different, but really feeds into what's going on in terms of where you find content. And we know YouTube has exploded and has so many viewers. Well, the Academy Awards is going to move to Alphabet's YouTube service in 2029, so not quite yet, but a few years from now, ending more than a half a century on the ABC network and more than 70 years on broadcast TV.
Yeah, the Academy of Motion Picture Arts and Science is announcing today that the streaming platform will take over the show when the organization's contract with Walt Disney's ABC expires. That deal with YouTube will run through 2033, the parties said in a statement. Bloomberg News reported back in August that YouTube was bidding for the program.
Listen, this has been a program that people have wanted because of the audience, but apparently the audience has dwindled with the declining popularity of broadcast TV and movie theaters. The audience for this year's show averaged 18.1 million viewers, down from the 1998 peak of 55.2 million when Titanic won the Best Picture. Don't we all remember that?
I knew you were going to do that.
But is that, I'm assuming they're talking about, is that a U.S. audience or global? Because at my understanding, the global audience, if you throw all of that in, is a lot larger.
You always ask me these questions that I just cannot answer.
Don't you love that I do that?
Yeah, it's great. I will go to something I do know.
What?
The terms of the deal.
Okay.
They were not announced.
Surprise.
Disney had reportedly been paying about $75 million a year for the rights. It's a lot of money to pay. You know what I think of, though?
But you typically would get it back in the commercials.
Yeah.
Right? Or you would
traditionally,
because it had big audiences.
Yeah, that's why the Olympics cost so much, for example.
Right.
Live events, live sports, those are the things that are supposed to still drive
gets the
viewership.
audiences, right?
Well, not as much as it used to.
Yeah.
And think about it. How do you see how do a lot of people see what happens at this stuff? They see it clips on social media. They see it on Instagram. They see it on other platforms too. See it on TikTok.
Yeah.
After the fact.
Or we record it and then fast forward through the commercials.
Yeah.
Or something like that.
But that's for people who have pay TV.
I just think that's a big deal.
So I'm interested to see what viewership numbers look like from YouTube, but also makes me think of the Netflix Netflix Warner Brothers Discovery.
Yeah.
And Paramount Skydance saga.
Because
Netflix says, hey, we compete with YouTube.
Right.
So if you put us up against YouTube, then we're still a small share.
I was listening to Tom and Paul this morning. I think it was on Surveillance. Yeah, I mean, it was on Surveillance. But they were talking about the media deal and the pursuit of Warner Brothers Discovery. And Paul was talking about valuations for cable channels as a result of the Comcast, spinning off. And they're just so much down from what they were in their heyday. He was talking about, I don't know whether it was 5 times EBITDA or whatever the metric was, but it's just so much of a lower valuation than what they used to be. And that's the changing, our world in terms of content distribution and where people are watching.
Yeah, I would also suggest to check out Geetha's research on this, Geetha Ranganathan on Bloomberg Intelligence. She was on Bloomberg Intelligence with Scarlett and Paul a little later. And she was talking about the updated deal and what that looks like and if Paramount Skydance could come back. She said, if they come back, they got to really up the price to compete with Netflix's bid.
But I just think about us right now. I mean, we're on YouTube, we're on our streaming network, we're on radio, but YouTube has become quite a force. Yeah. And there's a lot of folks that are getting information, content, news, you name it. And that's where they're turning. My household watches a lot of YouTube.
Do you have it on the TV?
We do.
Yeah.
Yep.
Watch us on the YouTube TV.
I hope you are. Yeah. You better be. I'm just saying. All right, don't go anywhere. The closing bell starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld, taking you through to that closing bell with the global simulcast. We're joined now by Carol Masser and Tim Stenovic from the radio room. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A decidedly down day. Stocks at session lows right now as we get just less than 2 minutes to those bells. And Carol Masser, we're going to close below some key moving averages unless something turns around in the next minute and a half.
I heard you talking about the 50-day on the S&P 500 and the significance of that. And so, yeah, you wonder if you're a technician, you're thinking, okay, if we break these levels, does that mean we go another leg down? Or do, buyers come in because it hit a certain downward point? So we'll have to see, but you're definitely seeing that selling into the close, and it does feel a little bit negative here.
Yeah, I mean, it's also just interesting to look at the biggest movers in the S&P 500 on a percentage basis today. I mean, at the bottom of the pack, you have those companies that have benefited so much from the rise in energy demand and the rise in data center demand, taking a real hit today. So it's not just the mega cap tech stocks, but it's also the sort of tertiary ones that are connected to the AI trade too.
Though old school energy stocks certainly higher today. I'm sure we'll talk about what's going on with oil. We've been talking about it on the close, how you think about the risk-off day that we're having. Okay, gold is getting a bid, but the bond market not really acting as the haven that you might expect it to. So a lot of pain certainly being felt today across asset classes.
And I just want to point out, too, we are waiting later tonight, of course, that speech by President Trump at 9 p.m. Washington time. He's currently speaking to reporters right now. And his words, the message this evening is our country will be strong. Of course, the implications for what he says may not have an immediate market reaction, but certainly when it comes to policy and the potential economic fundamentals, it certainly could. Right across the screen here on this Wednesday afternoon, the Dow Jones Industrial Average down more than 200 points or 0.5%. The S&P down 79 points or 1.2%. The NASDAQ Composite down about 400 points or 1.8%. The NASDAQ 100 down 1.9, just barely touching that 100-day moving average. The S&P closing firmly below that 50-day moving average, and the Russell 2000, that was also lower, 22 points or about 1.1%.
All right, so that's your major averages. We've been talking about this all day. Maybe you guys have too, but the S&P 500, you go in though, and you see almost an even split between winners and losers. 257 names in the S&P 500 gaining ground today, Katie. 244 to the downside, 2 unchanged.
It's slightly uglier if you take a look at the circle, which shows us what the sectors did today. Certainly, that doesn't look too great. In terms of what did outperform today, as I mentioned, energy as a sector higher by about 2.2%. We did see a rebound in oil. We are watching the geopolitical environment. Tech having a terrible day, off by about 2% as a sector.
Well, speaking of tech, a lot of focus on the AI trade, and one of the biggest memory chip makers out there, Micron, reporting earnings right now. The shares, the knee-jerk reaction to the upside here, as the company said EPS came in at $4.78. That's a big beat. The street was looking on average for $3.95. Revenue in the quarter on an adjusted basis, $13.64 billion. The street was looking for roughly about $13 billion even. So a beat on that. Operating income, a beat as well. Cash flow from operations, a massive beat, $8.4 billion. The street was looking for $6 billion. And the guidance going forward, the company says that for the current fiscal quarter, the second quarter, adjusted revenue, $18.3 to $19.1 billion. The street was looking for $14 billion.
All right, so this is an important one. I mean, this stock's up 169% year to date. It's down about 14% from an all-time high back on December 10th, but this is an important indicator. This is a dynamic random access memory company, but it's also going to give us some indications into also the AI trade that we've all been seeing under pressure as of late. So maybe some confirmation. Keep in mind, this plays into a lot of different markets, but it also plays into the market for AI servers. So to see that upbeat, we want to know the breakdown in terms of its markets to get an idea of what it says, again, on the AI trade.
I just want to put out, too, some more headlines coming out, Carol. The adjusted EPS figure that they're giving, the guidance for the current quarter, basically $8.62 at the top end. The street was looking for $4.71. So you're talking about basically estimates coming in at almost double what the street was looking for. It's also saying that its gross margin is going to expand to 67 to 69%. That gross margin right now tracking less than 60, but right now in the mid 50s.
Yeah, what a world. I mean, margins in the high 60% range. Hey, Sanjay Mehrotra, the chairman, president, and CEO of Micron Technology, out in a statement where we're getting a little more color on how the company is thinking and positioning itself right now. He said that Micron's technology leadership, differentiated product portfolio, and strong operational execution position Micron as an essential AI enabler. He said, quote, "We are investing to support our customers' growing need for memory and storage."
I do want to go back to those forecasts. That is the red headline across the terminal right now. Second quarter adjusted revenue coming in at $18.3 billion to $19.1 billion. That's the guidance there. The estimate had been for $14.38 billion. As Romain said, adjusted EPS, that second quarter estimate, also much higher than expectations. We were actually having a conversation with Matt Bryson over at Wedbush, and he said that, built into some of his forecasts was the expectation that management was going to be a little bit conservative with their guide, but taking a look at some of these numbers, so exceeding these forecasts, not seeing that conservativeness come through necessarily.
Yeah, and just like the headline on the press release, AI demand acceleration, along with other things, but they talk about it, driving record fiscal first quarter results, including highest ever free cash flow. Again, shares of Micron bouncing around, but mostly higher. The stock right now up about 4.5% here in the aftermarket. What?
And we were talking, you mentioned the fact that this is a stock that basically has almost tripled on a year-to-date basis, could potentially triple. But I was looking at some of the biggest winners on a year-to-date basis in the S&P 500. If you had ran this chart, the function on your terminal a few months ago, all the names would have been the bigger chip makers, the NVIDIAs, the Broadcoms of the world. At the top of that list now, it's a SanDisk, it's a Western Digital, it's a Seagate, it's a Micron. Basically, 4 of the top 5 names in the S&P 500 on a year-to-date basis are memory makers, Carol Masser.
Which is fascinating, right?
Yeah, well, all that data has got to be memorized somewhere, right?
Yeah, exactly. All right. Nice.
You don't want it to forget it.
Yeah, no, exactly. I want ChatGPT to remember everything about
Can someone install one of those Micron chips in my brain?
It's
I forget a lot.
All right. We're going to watch for some more headlines on Micron. Right now, it's up more than 6% here in the aftermarket. Let me go to some of the gainers in today's session. Got to talk about an IPO today. It's been a pretty good year for IPOs in 2025. Medline, maker and distributor of medical supplies, gloves, gowns, exam tables, all those things we love that are used by hospitals and doctors, making its public debut today, oversubscribed, raising $6.25 billion. Year's biggest initial public offering. You can see that stock finishing the day up 41%. So many would say interest certainly among investors and maybe priced really well.
We have one of their gowns at home, by the way.
Do you like to wear those gowns at home?
Well, yeah, I was very comfortable, and we asked the hospital, could we take it? And they were like, sure.
They are kind of comfy, aren't they?
They are.
All right, good to know about.
Not very stylish, but comfy.
I'm trying to get my head around you wearing them at home.
I think they make the classic swap.
And I wear the little booty socks,
right?
with the little skid things on, so I don't slip.
Oh,
Yeah.
Who doesn't love those?
Yeah.
Right? You don't fall down the stairs. You don't slide on the floor. All right, let's go to another gainer, Texas Pacific Land Corp. TPL is the ticker. This one finishing the day up about 7.6%. Company announced a strategic agreement with Bolt Data and Energy. They're going to develop large-scale data center campuses across TPL's West Texas land holdings, with TPL investing $50 million in Bolt as part of the deal. So we saw some momentum there. And then Udemy, check this out, guys. Up more than 33% at its highs today, intraday, finishing with about a 13% gain here at the close on a deal with peer Coursera to merge the two companies in an all-stock transaction. The combined entity with an implied equity value of about $2.5 billion. So Udemy, definitely an outperformer.
All right.
Session.
You got the outperformers.
Don't you like to say Udemy? Don't you like to say Udemy?
Udemy.
I like Udemy. Udemy. It's like my jersey comes out. Katie, your jersey comes out.
Exactly. You read me.
Let's talk about some of the decliners today. Stocks in the red include NVIDIA, down 3.8%. This was the biggest decliner on a points basis in the S&P 500, responsible for 19 points to the downside in the S&P 500 today. That tech rout hitting stocks amid skepticism about the AI trade. NVIDIA leading megacap stocks lower today. Broadcom also fell by 4.5%. Tesla down by 4.6%. NVIDIA down close to 17% from that October all-time high. So quite a decline in a short time. Shares of Oracle also taking a hit today. Speaking of the AI trade, down 5.4% on the day. This after it was confirmed that Blue Owl Capital is not contributing equity to a data center project in Michigan. That project progressing with Blackstone in talks to provide equity capital, and Bank of America leading a debt deal to help finance the project. Also watching the cost of protecting Oracle's debt against default. That was on track earlier to reach its highest closing level going back to 2009. And finally, GE Vernova shares taking a hit. Weakness in AI-related stocks certainly on my radar today. GE Vernova down 10.5% today. The concern was that the weakness in AI-linked stocks spread to companies that are expected to benefit from electricity demand. So GE Vernova fell along with Caterpillar. Makers of data center products and power equipment also fell, and those companies too involved in building power and data center infrastructure also taking a hit today.
All right, take a look at yields. A mixed state there. Here, you had some comments earlier in the day by Christopher Waller that did move the market, but some of those moves really kind of reversed or at least settled down just a little bit. Slightly lower on the longer end of the curve and slightly higher on the shorter end of the curve, excuse me, and slightly higher on the long end of the curve. The net effect of it all is basically where we've been now for the last couple of sessions.
All right, guys, as we wrap our cross-platform coverage, just want to mention Micron still up now about 7.3% here in the aftermarket. So we'll continue our coverage, I'm sure, on both sides. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine continuing there on the close on Bloomberg TV. Tim and I on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you again, same time, same place tomorrow.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Can I say up and away?
Yeah, are you talking about Micron shares in the after hours?
7.25% to the upside.
Yeah, those shares surging higher in the after hours. This after the company gave a rosy sales forecast after the AI boom spurs demand. It's the largest U.S. maker of computer memory chips. It gave an upbeat forecast for the current quarter. It's a sign that surging demand and supply shortages are allowing the company to charge more for products.
Yeah, it's really fascinating. There was a little concern because the stock has been on such a tear this year. It's up 168% year to date. So we have seen this stock, one of the top performers in the S&P 500, but what it would say about AI and certainly its role in it was kind of key, considering some of the concerns we have over Oracle and the AI spend overall. We've seen some of those AI names retrench a little bit.
Not based in San Francisco or Silicon Valley.
No.
Not based in
Makes me think of potatoes when I think of
Based
Micron.
in Boise.
Yeah, Boise.
But here based in New
Idaho.
York is Jake Silverman. He's Bloomberg Intelligence Semiconductors Analyst. He joins us here in the Bloomberg Interactive Brokers studio. Jake, if you were to take out the whiteboard and sort of do the whole web of where all of these companies exist in the supply chain, where does Micron sit?
Yeah, Micron is a pretty critical supplier in terms of not just AI, but they're pretty ubiquitous across all sorts of consumer electronics and PCs, smartphones, all those different products. So one area we've focused a lot on AI recently. AI is certainly one of the major drivers of price increases. However, some of the reasons for upward estimate revisions recently for Micron, and obviously with this very strong outlook, is actually just driven by the fact that there's a limited amount of supply in the market, and so AI is sort of exacerbating the situation. But as long as there's fairly strong demand for products like consumer products, PCs, smartphones, that can actually drive price increases as well, not just AI.
So it's not just stronger demand, it's that the cost of what they sell has gone up.
Yeah, right. So, I mean, if you look at some of the spot contract pricing, it's gone up quite a bit. Now, contract pricing is probably the more key metric to look at. But if you look at DDR5, for example, between January of this year...
What's DDR5?
It's the most recent sort of generation of products that they sell that's DRAM-based. Most of their revenue now, at 80+%, is generated from DRAM versus NAND, which is more like your storage products, like SSDs, stuff like that. Yeah.
I thought it was interesting. I mean, I'm going to the supply chain function, which we always love on the Bloomberg, but NVIDIA is about 16% of their revenue. Apple's about 4%. WPG Holdings is the biggest, it looks like. They're about 9.8% of their holdings. But that they are being able to charge more, is that why margin has gone up so much? I mean, it explains so many of the metrics here then.
Yeah. So margins are really heavily impacted by pricing. So obviously there's sort of input cost, and in the last downturn, as pricing started to collapse, you saw gross margins, operating margins get razor thin. But now as we're starting to see supply crunches, the exact opposite's happening. One of the key reasons that this is occurring actually is because high bandwidth memory requires more wafers than a traditional DRAM die. And so it's going from 1 to 1 to 3 to 1, and then with HBM4 it's actually going to about 4 to 1. So as demand shifts over to AI, it's taking away from capacity for traditional products, which is exacerbating, as I pointed before, the supply situation. The major reason for price increases, because we have seen PC smartphone refresh cycles.
So we pay more. So everybody pays more.
Everyone pays more.
Because they have the power to charge more. The margin's close to 70%.
Yeah, no, that's the thing. The gross margins are directly related to supply demand. High bandwidth memory does have higher margins than the standard products, but we're actually starting to get into an environment where the standard products have very strong margins as well.
So I feel like, an AI story, the demand, but that whole supply, it comes down to basic supply and demand, right? There's just so much demand. There's just so much supply. Prices go up. And as you said, plays into why the revenue numbers are higher, why the margins are better. So does this necessarily, I guess, then does confirm the AI boom story? Like, or how do we have to be smart as we read through?
Yeah, it's a great question. I think it's a little bit complicated simply because AI is sort of a structural supply limiter right now for the industry, for the memory industry. What we need to see is whether or not these companies decide to invest in capacity. If they invest in more capacity, which they are to some degree, technology upgrades, but really like adding to the shells that they have now, and if they decide in the future to expand to more shell capacity.
What does that mean, shell capacity?
So basically, I got a little technical, but basically just the manufacturing lines, how many wafers they can run through all of their total manufacturing facilities. So if they add more wafer capacity, they can basically, the supply and demand dynamic will improve a lot, and there won't be as much of a supply crunch.
Do they want to do that, or do they like that they can charge more and their margins are like, whoa?
That's the question, is how long do they allow a supply crunch to occur, because they have incentive to have very strong margins, but with such a supply...
There's also cycles, right? We always get this from Ian King, that there are cycles
with such a supply crunch, though, the thing is, at some point, someone wants to take market share as well.
Like a Samsung?
Yeah, Samsung has really strong opportunities to do that because they have such amount of leverage. They have so much more available capacity relative to the other players in the market, like Hynix and Micron.
But politically, in an administration such as this, that's, quote-unquote America first, does Micron have a better opportunity? Is there a U.S. competitor, or is Samsung the biggest competitor?
No, there's really not. I mean, it's mostly Korean, Chinese, and so for the most part, they don't really have a major advantage in that sense. I think they have a limited amount of capacity. If I were just to look at HBM specifically, even if NVIDIA wanted to source all of their HBM from Micron or asked to, Micron can't really supply all of it right now. But ultimately, NVIDIA and other AI server makers are going to want to diversify their supply. It's a commodity-like business. HBM is a lot less commodity-like, but at the end of the day, the differences between some of these products it's not as extreme as what you would see between different types of GPUs, for example.
So what's the number one question we should be asking Micron, like on the call today?
I think the biggest question is just going to be, there is a supply crunch right now. There's not enough. There's a lot of demand. There's not enough supply. At what point can we expect to see capacity start to increase across the industry? What's the discipline that Micron maintains in order to sustain strong pricing and margins?
Right, because I feel like when we talk with Ian King, and he talks about the semiconductor cycles, and then there's always, at some point an imbalance where there's a lot more demand, and then there's the build out, and then all of a sudden you have a lot more supply, and then prices go down.
We just don't know where we are in the cycle.
Right. And so, and I think with the questions that are out there, especially when it comes to the AI side of things, I would assume companies are going to be very cautious.
Yeah, we are getting past the point
doing
of
too much build out.
Yeah, we're getting past the point of historical precedence in terms of the length of up cycles. Tends to peak around 10 quarters, and we're definitely getting beyond that now. And so the question just becomes, how disciplined are these companies going forward?
Really smart conversation. Thank you. Really appreciate it. Jake Silverman, Bloomberg Intelligence Semiconductors Analyst. It's why we love our BI team, right? Love.
Speaking of that,
They're
we got
ours.
another member of our BI team coming
Yes.
up right after this. George Ferguson, we're talking planes, no trains, but automobiles.
It's 421 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by Jewish Communal Fund. New tax laws take effect in 2026, reducing some charitable deductions benefits. Open your JCF donor-advised fund now to maximize tax savings. Call 212-752-8277. Moments ago, we heard from Micron Technology, which is the largest American maker of computer memory chips. It gave an upbeat forecast for the current quarter, a sign that surging demand and supply shortages are allowing the company to charge more for products. After hours, Micron shares, they're up now by 1.8%. Down day for Wall Street today. Volatility, in fact, lashing markets, pushing high valuation tech shares and crypto lower, while bonds pared losses after a senior Fed official signaled room for rate cuts. Today, we did see the S&P 500 index declining, along with the Dow and the NASDAQ Composite Index, a 1.2% drop on the S&P, down 78. The Dow was down 228, down 0.5. NASDAQ today lower by 1.8%. 10-year, 4.15%, with the 2-year, 3.48%. Gold up 1%. Spot gold at $43.45 the ounce. West Texas Intermediate crude up 3%, $56.91 a barrel. And Bitcoin down 2.2%. Bitcoin at 85,769. So again, after earnings, Micron Technology shares up today by 1.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie Pellet. Really do appreciate it. All right, so planes, trains, automobiles. It has a nice ring to it.
Maybe not trains.
We're not going to do it that way. We're going to do planes, autonomous vehicles, and eVTOLs. Well, doesn't have the same ring to it, but it works.
Nice job.
I want to talk about bankrupt Spirit Aviation Holdings. The shares just surged today, up 20%. But to be fair, trading at what, 24 cents a share? No,
Yeah.
up 24 cents. So, yeah. Pretty. Confirm that for me while I read the rest of this. How's that?
You want me to look at Spirit?
Yeah. This after Bloomberg News was first to report that the company is in revived discussions to merge with Frontier Group Holdings in a deal that could rescue the deep discount airline from insolvency at a time of stiff competition from larger U.S. airlines.
It was up 15%, up 35% at its highs, but again, it's a 23-cent
Okay,
stock.
good. 23%.
Because remember, it's, not
Okay,
doing well,
and Frontier Group Holdings shares were up earlier in the session as much as 9% today.
But they also ended, I think, kind of mellow on the day.
George Ferguson is Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence. He joins us from Bloomberg Intelligence headquarters
George is like,
Princeton.
come on, you knuckleheads. You got a Bloomberg right in front of you. Come on, just read
I know,
read the ticker.
I sometimes message George with questions, and he sends me back how to do it on the Bloomberg. So George, we've got this handy sort of timeline in the Bloomberg News story here. Thank God we have this, because it's great. The dates include February 2022, April 2022, July 2022. Frontier and Spirit agree to combine. Then JetBlue offers to buy Spirit. Spirit terminates Frontier deal, agrees to sell to JetBlue. Federal judge blocks JetBlue Spirit deal. Look, there's 5 more things that I could read right now. I'm not going to waste your time doing that. Is the regulatory environment such that this deal could actually happen this time?
Yeah, I think so, right? This morning, we were just playing around with schedules for the first quarter, the team and I. And, we took a quick look at where Spirit Airlines would shake out in size. And right now, I think it would be the 6th largest, Spirit and Frontier combined. They'd be the 6th largest U.S. airline, just barely ahead of JetBlue. And so I just don't see where, merging these two together, allowing these two to merge together, to create a 6th largest airline is really going to affect, competition significantly in the U.S. market. And look, I think the basic economy business, which is where these two largely live, they're trying to do some premium business as well. That looks overcapacitized, if that's the correct word, and if that's a real word. And so
we'll take it.
Why not put them both together and figure out if they can make a go of it?
Well, that's what I was going to ask you, right? There's the point, the regulatory side of it, which you addressed, but does it make more sense? Tim and I were talking ahead of chatting with you, George. It seems like the majors are doing okay. It's like everybody else is struggling.
Yeah, I mean, there is, like I said, it feels like too much capacity in the basic economy, lower end. That won't last forever. And look, Spirit's already shed a whole bunch of airplanes, right? So they think they're going to have about 100 coming out here, probably combined, I think, with about 250 of Frontier airplanes. You'd have an airline with about 350 airplanes. I I think that one, the combined airline could probably serve more markets and be more interesting to customers. And I think that maybe the combined customer base could provide a better loyalty program, right? Loyalty programs kind of key right now for airlines. You know, you pay to take a credit card, you buy your groceries on it, the airline makes a bunch of money off it. It's not going to be, you know, the Chase Platinum kind of loyalty program or the American Express loyalty program, but it could drive some extra revenue combining these two customer bases. So I don't think it's, you know, an impossible task to put them together and have them be profitable. It'll be challenging.
You know what we really want to know? Are they going to have a lounge? Are we going to have lounge access?
You may be surprised. You may. You know, JetBlue's talking about lounges.
Yeah.
They're talking about proper first-class seats at Frontier. I mean, the airline business is, you know, swapping a seat out of an airplane isn't a crazy expensive, you know, event. And so you can adjust those interiors fairly easily. And in the airline business, when something works, most things in the business are pretty flexible. Everybody goes there. And so, you know, as soon as something works, everybody goes there, and usually it gets stepped on and depleted before you know it.
Okay, so we're talking JetBlue. This is kind of a perfect segue.
I know.
Carol
You're
Master.
You're welcome.
On demand.
You're welcome. Thank you, George.
On demand and for next year, Lisa Abramowitz actually spoke to Joanna Garrity, JetBlue CEO, yesterday. Here's what she had to say.
2025 has been a very tough year, whether it was the macro setback or the government shutdown or the list goes on and on. We're really looking forward to the holiday season. Bookings are coming in strong. As we go into 2026, we're optimistic that the consumer is healthy and that we're going to start really ramping up the initiatives that we have been working really hard for the last year to execute to and seeing the benefit as we move through 2026.
Okay, so that's Joanna Garrity, the CEO of JetBlue yesterday. She's optimistic for next year. How does that gel with what we've heard from other carriers, just very briefly?
Yeah, so again, I think premium is doing better than basic economy, and JetBlue is definitely pivoting towards premium, talking about lounges. That should work well for them. They have a nice brand, and you know, we'll see how the consumer holds up during the year. But yeah, JetBlue could do all right. Again, Delta, American, United, I think, are leading the pack into 2026.
It is down 40% this year, and it's a $4.77 a share stock. Wow.
Getting killed.
It's been some challenging.
We had a couple of nice JetBlue flights this year.
No, I remember doing a big deep dive on them years ago when they introduced.
A different company.
Yeah, it was it was the airline it felt like to beat, and they just were so ahead of the legacy carriers. All right, George Ferguson, thank you so much. Always appreciate it. George Ferguson, of course, Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence out there at the BI headquarters in Princeton.
Okay, so planes check. Let's get to autonomous vehicles, and then we'll get to eVTOLs. Waymo is Alphabet's autonomous driving unit. It's in discussions to raise more than $15 billion at a valuation near $100 billion. This in a financing round led by its parent company. Sarah Fryer is big tech team leader for Bloomberg News. She's the author of No Filter, the inside story of Instagram. She joins us from the Bloomberg San Francisco bureau. Sarah, remind us of the structure here, because when I think of Waymo, I think it's you know, Google/Alphabet owned. How does this startup live inside this massive company and then go raise money from independent venture capitalists?
So it's known as one of the quote-unquote other bets that Google has, these businesses that they have really tried to structurally encourage to be more independent startups within Google. And that's why they're taking this external funding. They've done similar with Verily, working on a spin-off there.
That's life extension?
That's the life sciences business. They're trying to make, under Ruth Porat's leadership, they're trying to make these more futuristic bets a little bit more financially viable for the company at large. And Waymo is an extremely expensive business to run. You got to build these cars. You got to roll out these actual pieces of hardware in various cities. You got to troubleshoot it. You've got to train it further, update the fleet. I mean, this is a extremely capital intensive effort. And for years, Waymo was just draining a bunch of money from Google. Finally, now that it's deployed, working in cities across the U.S. and expanding, there is some revenue coming from that project. $350 million in ARR from what our sources have told us, upwards of that actually. And so we are starting to see Waymo as a potential significant contributor to Google's business perhaps in the future. But it will be possibly as its own startup or a separate company. Maybe they'll spin it off. Maybe they'll do an IPO. Maybe they'll have some other exit for Waymo, and that's kind of what they have said they will do with these so-called other bets.
I gotta say, Sarah, and we've said this a lot on air. I know I love Waymo. Full transparency, everybody. I've done it. I remember when you first did it, I was blown away because I thought you would never love it because I just thought you would feel like a little uncomfortable. But I've closed my eyes in a Waymo. I've been so comfortable.
not like that changes the experience at all. You're not in control whether your eyes are open or not.
No, I know, but I loved it. But I feel like, Sarah, there's still so many questions, like who will ultimately own these cars, or who insures these cars if they're like there are costs that I think, right? And maybe it doesn't work in every city because I know, isn't Waymo being tested around here?
Yeah, but with a driver still in New York City.
I don't know.
But here in San Francisco, I mean, anyone who lives here has seen it almost as frequently as they've seen Ubers and Lyfts. They're just everywhere. They're taking the same roads. You may feel they're less aggressive as drivers. In fact, like they're less likely to miss you as you're about to cross the street. That's just anecdotally. I don't have data on that. But it is starting to feel more normal in a way. And the contrast there is really striking too, because then you have companies like Tesla, where Teslas are so popular, but right now the California DMV is saying you have 90 days to fix the way you do self-driving or market it, or we'll have to ban you. So it's just a kind of a interesting time for Waymo to be expanding in this way as Tesla tries to roll out its own robotaxi fleet.
Yeah.
Waymo's the one that has done it a little less quickly. If you think about the amount of time they've been working on it, they've been really steady about it. And Tesla's been a little bit more brash, but Tesla's the one that still hasn't quite gotten to the ubiquity.
Yeah, it's interesting. And, I just think about Tesla, and we've been just watching the share price and what's been going, and it hit, was it an all-time high? Was it just in yesterday's set, right? So it's just like investors. I mean, the stock's up 16%. It's been quite a ride, but investors have been
down a little bit today.
Yeah, but have been interested. Hey, Sarah, I'm so glad we could check in with you. Be well. Sarah Fryer, big tech team leader, Bloomberg News, author of No Filter, the inside story of Instagram out there in San Francisco.
4:40 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by Harvard Business School Executive Education, a world-class learning experience for aspiring and established change makers. Prepare for the next elevation for your organization and yourself. Learn more at hbs.me/breakthrough. After the bell, Micron Technology, which is the largest American maker of computer memory chips, gave an upbeat forecast for the current quarter, a sign that surging demand and supply shortages are allowing the company to charge more for products. After our shares are higher, Bloomberg Intelligence Semiconductors analyst Jake Silverman was a guest right here on Bloomberg Business Week Daily.
Some of the reasons for upward estimate revisions recently for Micron, and obviously with this really strong outlook, is actually just driven by the fact that there's a limited amount of supply in the market, and so AI is sort of exacerbating the situation. But as long as there's fairly strong demand for products like consumer products, PCs, smartphones, that can actually drive price increases as well, not just AI.
Bloomberg Intelligence Semiconductor analyst Jake Silverman interviewed on Bloomberg Business Week Daily. Right now, we've got shares of Micron Technology after hours. They are trading flat after an initial pop. The Dow, the S&P, NASDAQ, all declining today. 78-point drop on the S&P at 67.21, a decline of 1.2%. Dow Industrials down 228, down 0.5. NASDAQ today down 1.8%. The NASDAQ 100 index down 1.9%. 10-year at 4.15%, with the 2-year 3.48%. Gold up $40 the ounce, 43.42. That was a gain of 0.9%. West Texas Intermediate crude up 2.8% on Venezuela tensions. WTI 56.84 a barrel. Bitcoin down today by 2.2%, 85,835 on Bitcoin. Cannot ignore the Medline IPO. Shares surged 41% in their trading debut after the medical supplier raised $6.26 billion in the year's biggest IPO. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Appreciate it. Well, the China-focused business news site Caixin today reporting that, well, it was actually this week, yesterday, that China has unveiled draft rules to speed up certification of eVTOL aircraft. We're talking about electric vertical takeoff and landing aircraft. You haven't been on one yet?
Not yet.
Yeah, no, neither have I. The story goes on to note, though, the regulatory competition with the U.S., citing industry executives. For more, we're joined once again by Lisa Wright. She's founder and CEO of Landings. It's a company that says it's building a landing and ground operations network of vertiports for eVTOLs. She joins us here in the Bloomberg Interactive Brokers studio. Welcome back.
Thank you for having me back.
The regulatory landscape is a really important part of this. And I think last time you were on with us, you said that the first passenger-carrying eVTOLs will happen in the Middle East. It won't happen here in the U.S. Is that still the case?
That is still the case. I mean, they are carrying passengers in China, but the Middle East will be next, and then the U.S. is coming pretty close behind.
Is it a disadvantage in terms of the regulatory environment here versus other countries?
No, the FAA has been working very hard. Actually, they've streamlined and done a lot of fast tracking and changed the training for pilots because there's going to be new pilot training, et cetera. So I don't think the regulations in the air has been an issue. It's just, in Dubai and the UAE, they were more excited about building the infrastructure first. So I'm very much about the infrastructure, so that's what we're trying to build.
Well, let's talk about that, because when we talk about electric vehicles, we just did a story this week about kind of how things are sliding backwards. And I think initially early on, Lisa, so much of it was the infrastructure wasn't there, the charging networks, and it created anxiety among the consumers. So talk to us about the infrastructure build out, where you guys are in this process, and what are some of the hurdles?
Yeah, no, there's definitely a lot of hurdles. Number one is energy. So getting access to energy is hard. We are not really competing with data centers, but data centers are looking for energy in areas that we're looking for energy as well. So what we're doing is we have 2 people on the team who are specifically looking at energy and getting the equipment financed and working with utilities, but also providing battery backup and energy systems in front of the meter in order to take up the slack for the charging. So charging is our number one issue, really. Finding land is great. We can do that. but getting the energy out. And to your point, there's a lot of attention being paid to EV networks right now that aren't necessarily succeeding.
Do you actually have to be connected to the grid in order to charge? Could you create a sort of self-contained off-the-grid landing area that uses renewable energy?
Absolutely. So we use about 1 or 2 megawatts of energy, and you can get that from 5 to 10 acres of solar.
Okay.
So there is a way that we can do with solar. We
And then
power
store it. You have to
Exactly, and store it with the
That's a big part of
battery, and then we can use it for the peak or the demand when they land and need it.
But you can't just rely on that alone, or can you?
We could do that. I mean, there's still a grid connection to most places.
Maybe
It's
in
just not
Arizona or,
yeah.
I don't know, parts of California.
Yeah.
Yeah.
So how do you see kind of this building out, and what's the cost involved? Like, how do you do it? Is it public-private partner? Like, how does it all get done?
Yeah, so the first network of 12 that we have in upstate New York is a mix of different use cases. So we have agriculture, we have entertainment and casino, we have existing airports. We also have some public-private partnerships going on with communities for like medical purposes and first responders. So there's a whole range of uses. Now, a lot of the vertiports that you see right now, they're very fancy. I call them Zaha Hadid buildings, right? Like they're amazing and futuristic, and they cost a lot of money.
Yeah.
We're going to build 2,000 of these, so we're going to not make them cost a lot of money. And how we're going to do that is because they're mini, they're very small, they're micro, they're about an acre and a half is the minimum space we need, and we're going to put so many of them out there. We're going to put 2,000. Not all of them will have charging. But by having such a dense network, we'll be able to guarantee landing spaces and charging within 30 minutes of any spot you are.
So I think about air traffic control in a situation such as this, and we spent a lot of time over the past few years talking about shortages of air traffic controllers. If we're sending more of vehicles into the air, there's more of a need for air traffic controllers. How does that factor into the estimate for how these things are going to be filling the skies?
Yeah, no, air traffic control is really overwhelmed right now with traditional flight. But because of the altitude that these craft fly in, it's a different altitude and it's a different wavelength for communications. So they do not have to use the existing air traffic control systems. There's a company, a nonprofit in Syracuse called New Air that is working on having all the demand for the airspace for heavy drones and eVTOLs. So it's going to be a completely different airspace.
Right, but you still have to have some coordination, don't you? Because eventually, even those that are flying much higher have to come down.
Absolutely, absolutely. And when they are near airports or towered airports, they still have to communicate with the tower and air traffic control like normal. Mine, because my locations are mostly rural, very remote, they're not having the same conflict. They're in general airspace. But also, one of the reasons that we chose the Mohawk Valley, upstate New York, is because this company, New Air, has 1,000 miles of airspace that they're already working in. So there's drones and all kinds of different things flying there already.
The real estate agreements that you have in place, what do they look like?
So we do 2 different types of real estate agreements, but what we're pushing for right now is just options. So we're not leasing and we're not buying the property. We're getting an option. It's much like a cell tower. So in essence, we will take on then the feasibility studies, the engineering, the build. We'll finance the equipment for the owner, and once we're operating, then we'll share the revenue with them.
So it's been how much? A month or so since we've talked?
Yeah.
What's the biggest change in that time frame?
The biggest change in the last month, there's been 2, but one is that everybody stopped focusing on individual vertiports and started talking about the network, which is really key for especially eVTOLs, is you can't just go from 2 points. It gets a little boring, right? You have to have a lot of locations.
I need one that goes from
home in Brooklyn?
Yeah, 731 Lexington Avenue. Okay, in Midtown Manhattan, just South Brooklyn a little bit.
Yeah.
Maybe.
Yeah. I mean, what do you envision that, like, we just got, 15 seconds. What's the view, you think? I don't know, is it 5 years, 10 years? What's the vision?
5 years from now, I believe everybody would have at least tried one.
Wow. Okay.
That's pretty cool.
That's very cool.
So first Waymo.
Sooner than I thought.
And then this.
Yeah, this has people.
This has people. Feel a little bit better?
Yeah, I do.
Close my eyes in a Waymo.
Lisa Wright, founder and CEO of Landings, joining us here in the Bloomberg Interactive Broker Studio. Coming up next, stocks on the move. This is Bloomberg Business Week Daily.
listening to Bloomberg Business Week Daily with Carol Massar and Tim Stenovic on Bloomberg Radio.
All right, everybody, if you're just joining us and missed how the markets closed on this Wednesday, let's just recap for you. Down 1.2% on the S&P 500. We did see selling into the close, so we pretty much finished at our lows of the day. NASDAQ 100, we saw big tech and tech names in general under a lot of pressure today. So the NASDAQ 100 down 485 points or down 1.9%. Again, selling into the close. We did, however, get some names that were moving in the aftermarket.
We did. We did. I'm not going to say them.
I know.
I don't want to ruin.
Did I jump ahead?
You did jump ahead, but that's okay. It's okay. We'll get there. Hey, I just want to speak a little bit more about today's trade as we do get set up for tomorrow. Yeah. This is the final trading week, final complete trading week of 2025. So far this year, up 14.3% on the S&P 500. The S&P did close at its lows of the session. We saw industrials, communication services, and information technology really take a hit today.
All right, let's take a little bit more of a look at the market. I'm Carol Massar along with Tim Stanovic. Let's get to some stocks on the move. Bloomberg News cross-asset reporter Isabel Lee. She's in the house. Where shall we begin?
We can begin with Micron.
Good.
Ticker is MU because it reported earnings, and the stock is actually rising by 13.5%. It pared back some of those gains, but still, those are double-digit gains. And Micron is the largest U.S. maker of computer memory chips, and they gave an upbeat forecast for the current quarter. Again, a sign that surging demand and supply shortages are really allowing the company to charge more for their products. So
up 6%.
6%.
I think it's up $13, but up 6%. 6%.
You were right. Yes.
Sorry,
yes.
I
Thank
just
you,
was
Carol.
like,
no. You're
it's
right.
just, I was like, whoa, what did they say?
13
maybe?
bucks, but up 6%. Okay, thank you for that on-air adjustment, aka correction. Okay, so
No,
which is
it's team
horrible.
effort. We want to make sure our team effort.
That's true. So the CEO said that
Fortunately, I'm never wrong.
you were convinced,
No,
though, Tim.
Fortunately, I am always wrong.
I'm always wrong.
Okay, the company
keep each
said
other honest.
it's positioned to be a
Let's
quote,
keep talking about it.
essential AI enabler. So again, the stock rose 6% in late trading, but it's already up 168% this year.
I know. I am blown away. We had a great conversation with a member of our BI team, and he talked specifically, Jake Silverman, about how the supply-demand metrics are off, and so because there's so much demand, not enough supply, they're able to charge a lot more for some of the chips that people want, and so that's why you see revenues up, you see their margins up. It's pretty impressive.
Okay.
Okay. You want to go to Medline?
I want to go to Medline because this stock just surged
I
today.
read your mind.
I will not correct you anymore.
No, please do if need be, but hopefully. So it's the first day of trading for Medline. They're a medical supplier. Shares surged 41% in their trading debut. And this comes after the company raised more than $6 billion in what is the year's biggest IPO, which is impressive. Or maybe for some people, maybe not quite because it's not like we saw a ton, but still, it's a superlative. So Medline counts Blackstone and Carlyle among their backers, and they sold north of 216 million shares in an upside offering that priced really at the top end of their range. So the trading gives the company a market value of around $51 billion, and Medline manufactures and distributes medical supplies like gloves, gowns, exam tables, all things that are important.
Also,
Don't you love
the
this
classic
story?
swaddle blanket.
Really?
Do they?
Oh yeah, the one that you see in every photo.
You bring your babies home in?
You bring your babies home in it, and the pro tip:
I just felt
get
my
as many of those as you can from the
I
hospital
just
before
feel
you
my
go home.
daughters, like I was going
Oh,
through
you
all
kept
stuff.
it?
Oh yeah.
That's so
Yeah, we
sweet.
still have a few.
Yeah, it's like
They're
That's so
it's like the
sweet.
sweetest thing, and it's soft.
You're a good
and
mom.
It's just, I try, but I just thought it's like a sweet memory. You know what I love about this? In a world where all we talk about is AI and like high tech and
That's true.
It's just like kind of a, they make
A classic, like it will
basic
never go away.
things, right?
Yes.
And it's just interesting to see this come out of the gate so strong.
I mean, I think many would argue that it's a growing business because medical costs continue to just grow, and given an aging population,
Yeah.
that's perhaps part of the bull case.
You need this stuff, right? And as we found out, Romaine Bostick apparently swipes the PJs at the hospital,
Those are not
or the
those are-
hospital
those are
gowns,
not PJs.
or the hospital what they wear. And
I'm not going to.
Are those even comfy? But okay.
Actually, I have to say, I remember a family member being in the hospital, and we're like, "Can we have some of those?" They were really nice, and they were like, they worked with a designer to create these really cool
I'm
patterns.
being told to move on.
Oh, okay.
Yeah.
All right,
Because
where
we
do you
got a
want to
few
go?
more. We probably don't have time for
Sorry.
3 more, but I want
Okay,
you to
pick your favorite. General Mills,
Yeah,
the
let's
stock
do that.
rose 3.5%.
Let's go old school. Let's talk
Yes,
cereal.
I know. And so after the earnings beat expectations, a highlight was the positive volume growth in North America retail segment. So this is kind of like a nuanced story because the CEO said North American consumers are buying food when they go on sale. So again, it just really emphasizes that households are feeling pinched. And no, companies, them included, weren't offering bigger discounts or more frequent discounts. It's just that whenever they go on sale, people buy more and more. And in an effort to boost sales, they've lowered their prices across 2/3 of their North American retail business. And when they did slash prices, that's when they saw an increase in volume. One thing that didn't do well is cereal, which I love. Anyway, the company said more and more people are looking to just consume protein. And remember, there's Cheerios with higher protein.
I know.
They expect that to be around $100 billion. $100 million with an M dollars by the
I
end
have
of
my
the fiscal year.
I have Cheerios every morning.
Yeah.
Wait, no,
You have
Carol.
Cheerios
Really?
throughout the day.
Well,
You look great.
Oh, thank you. Oh, you know who my favorite person is? Isabel Lee. No, but you know what? It's also supposed to be good for, I think, is it cholesterol or something? There's certain things you
Cheerios.
I think so. Yeah. It's like one of those foods that they recommend. So I just figure I'll just munch a little bit, in the morning.